Hello, and welcome to this preparatory course for the Securities Industry Essentials examination. Navigating the complexities of the financial industry requires a clear mental model of how capital flows and how regulations are enforced. This course is designed to provide you with that foundational structure, stripping away the noise to focus on the core mechanisms of the securities markets. By choosing this curriculum, you're investing in a systematic approach to passing the SIE, ensuring you understand not just the definitions, but how different market components interact with one another. We will cover everything from the granular details of equity and debt instruments to the broader regulatory frameworks established by FINRA and the SEC. Our journey begins with the basic building blocks of the capital markets, where we will examine the roles of various participants and the distinction between primary and secondary markets. From there, we will move into the regulatory landscape, economic factors, and the specific mechanics of investment products like options, bonds, and packaged funds. We will also spend considerable time on the rules governing professional conduct and customer accounts to ensure you are prepared for the ethical and legal standards of the industry. This logical progression is intended to turn abstract financial concepts into concrete knowledge that you can reliably apply during the exam. I look forward to helping you master this material. See you in the next lecture. Welcome back. Let's dig into the fundamental structure of the financial markets by examining how securities come into existence and how they circulate. The primary market is where the life cycle of a security begins. This is the only venue where the issuer of a security is directly involved in the transaction and receives the proceeds from the sale. Think of this as the original manufacturer selling a product directly to the first buyer. When a company decides to raise capital by issuing stocks or bonds, they utilize the primary market to reach investors. Because the issuer is creating new securities that have never existed before, these transactions are regulated under strict disclosure requirements to ensure investors know exactly what they are buying. The most common example of primary market activity is an initial public offering, or IPO, where a private company goes public. In this environment, the flow of money is unidirectional, moving from the investor's pocket into the issuer's corporate treasury to fund operations or expansion. Once those securities are issued into the hands of the public, they transition into the secondary market. In this venue, the original issuer is no longer a party to the transaction and does not receive any additional funds when the security changes hands. Instead, the secondary market facilitates liquidity by allowing investors to buy and sell securities among themselves. This is analogous to a used car market where you buy a vehicle from another owner rather than the dealership. The primary benefit of a robust secondary market is that it provides price discovery and ease of exit for participants. If an investor knows they can easily sell a bond to another person next week, they are more likely to participate in the primary offering today. Familiar entities like the New York Stock Exchange or the NASDAQ are prominent examples of secondary market structures where millions of shares are traded daily without the involvement of the underlying corporations. Understanding the distinction between these two markets is crucial for the SIE exam because it dictates which regulations and players are involved. In the primary market, the focus is on the Securities Act of 1933, which governs the registration of new issues. The secondary market, by contrast, is primarily governed by the Securities Exchange Act of 1934, which focuses on the conduct of participants and the fairness of the trading environment. You will find that investment bankers play a heavy role in the primary market by helping issuers structure and sell their new debt or equity. In the secondary market, the landscape is dominated by brokers and dealers who act as intermediaries to match buyers with sellers. Without the secondary market's ability to provide a continuous trading environment, the primary market would likely fail, as few investors would want to hold a permanent, illiquid asset. It is also worth noting that the secondary market is divided into different tiers or market centers that cater to different types of trades. Some trades happen on centralized physical floors, while others occur over the counter through purely electronic networks. Regardless of the specific venue, the defining characteristic remains the same. The trade is between two investors. When you look at a stock ticker on the news, you are observing secondary market price movements. If a company announces a follow-on offering to sell more shares to the public to buy a new factory, that specific event is a primary market transaction. Maintaining this clear mental separation between new issue and resale will help you navigate more complex topics like underwriting and trading mechanics later in this course. I'll see you in the next lecture. Hello and welcome back. When we discuss the structure of the financial markets, we must eventually address the entities that facilitate the movement of securities and capital. These entities are broadly categorized as broker-dealers, but their internal operations and responsibilities are not monolithic. In the context of the SIE exam, it is crucial to understand that a broker-dealer can function in several capacities depending on its size, capital, and the specific services it offers to its clients. The most fundamental distinction you need to grasp is the relationship between a firm that interfaces with the public and the firm that actually handles the mechanics of trade execution and asset custody. This brings us to the operational dichotomy between what we call clearing firms and introducing firms. A clearing firm, often referred to as a carrying firm, represents the high-level infrastructure of the brokerage world. These firms are substantial entities that have the regulatory permission and capital capacity to perform all aspects of a securities transaction. They do not just take orders from customers. They also maintain custody of the actual funds and securities. Because they hold on to customer assets, they're subject to much more stringent capital requirements than other types of firms. When a trade is executed, the clearing firm is the one responsible for the back-office work, sending out trade confirmations, generating monthly account statements, and ensuring that the delivery of securities matches the payment of funds. They serve as the backbone for smaller firms that do not wish to maintain such expensive and complex administrative systems. On the other side of this relationship, we find the introducing firm. As the name suggests, this type of broker-dealer introduces its customers to a clearing firm. The introducing firm handles the relationship side of the business, such as providing investment advice, taking orders, and opening new accounts. However, they do not hold customer funds or securities themselves. Instead, they outsource those heavy-lifting tasks to a clearing firm through a formal agreement. If you imagine a local brokerage office that helps you buy stock, but the actual stock certificates and cash are held at a massive global bank, you are seeing this relationship in action. The introducing firm essentially functions as the front-end interface, while the clearing firm acts as the repository and execution engine in the background. Within the category of introducing firms, we can make a further technical distinction between fully disclosed and omnibus accounts. In a fully disclosed arrangement, the introducing firm provides the clearing firm with all the individual details of every customer. This means the clearing firm knows exactly who the end client is and sends statements directly to that person. This is the most common setup for smaller broker-dealers because it shifts almost all regulatory and administrative burdens onto the clearing firm. The clearing firm keeps the records for each individual account, as if those accounts belong to them directly. This arrangement reduces the operational risk for the introducing firm, allowing them to focus entirely on sales and client service without worrying about the complexities of custody or settlement. It is also worth noting the role of a prime broker, which is a specialized type of clearing firm used primarily by institutional clients like hedge funds. Institutional investors often trade through many different executing brokers to find the best prices or to keep their trading strategies private. However, managing all those scattered trades would be a nightmare for their accounting departments. To solve this, the institutional client chooses one prime broker to act as a centralized clearing hub. All the trades made at various executing brokers are funneled into the prime broker, who then consolidates everything into a single statement and provides specialized services like margin lending and securities lending. This provides the client with the flexibility of using multiple brokers while maintaining the simplicity of having a single point of contact for their asset custody. New paragraph. Welcome back. To understand the landscape of capital markets, we must distinguish between the entities that execute trades and those that provide professional advice for a fee. An investment advisor is defined as any person or firm that engages in the business of providing advice, making recommendations, or issuing reports concerning securities. For an entity to be legally classified as an investment advisor, it must generally meet a three-part test, often referred to as the ABC test. These three components are advice, business, and compensation. This means they must provide guidance on specific securities, perform this function as a regular part of their business operations, and receive specific compensation for those services. If an individual provides financial advice to a friend for free, they are not an investment advisor in the regulatory sense. The distinction between a broker-dealer and an investment advisor is often a point of confusion, but the regulatory implications are significant. While a broker-dealer earns commissions or markups for executing transactions, an investment advisor typically charges a fee based on a percentage of assets under management, a flat fee, or an hourly rate. Legally, investment advisors are held to a fiduciary standard, which is a higher level of responsibility than the suitability standard often applied to broker-dealers. A fiduciary must always put the client's interests ahead of their own and disclose any potential conflicts of interest that might color their advice. This obligation is not just a moral suggestion. It is a legal requirement governed by the Investment Advisors Act of 1940 or state laws, depending on the size of the advisor. Registration requirements for investment advisors depend primarily on the amount of assets they manage. Those who manage smaller amounts of capital typically register with the state securities administrator in the states where they conduct business. However, once an investment advisor reaches a certain threshold of assets under management, generally defined as $100 million or more, they must register with the Securities and Exchange Commission as federal covered advisors. It is important to note that an individual who works for an investment advisor firm is known as an investment advisor representative. These individuals generally register at the state level regardless of whether the firm itself is state registered or SEC registered. This distinction ensures that the regulatory oversight scales appropriately with the systemic impact of the financial entity's operations. Compensation structures for investment advisors are designed to align their incentives with the growth of the client's portfolio, though this is not always perfect. The most common arrangement is an asset-based fee, where the advisor takes a small percentage of the total value of the account annually. This differs from commission-based models where a professional might be incentivized to encourage frequent trading to generate revenue. Some advisors may also charge fixed fees for a comprehensive financial plan or hourly rates for specific consultations. However, they are generally prohibited from charging performance-based fees, where they take a cut of the profits, unless the client is considered a sophisticated or qualified investor. This rule exists to prevent advisors from taking excessive risks with a typical retail client's capital in hopes of securing a larger payout for themselves. Certain professionals are excluded from the definition of an investment advisor if their advice is purely incidental to their primary profession. This group is often remembered by the acronym LATE, which stand for lawyers, accountants, teachers, and engineers. If an accountant suggests a specific bond as part of a tax planning strategy, they are not necessarily an investment advisor because they are not being paid specifically for investment advice. However, if that accountant sets up a separate practice branch specifically to manage portfolios for a fee, they would then lose that exclusion. Similarly, publishers of general interest financial newspapers or magazines are usually excluded as long as they do not provide personalized advice to specific individuals. Welcome back. To understand how capital flows through the primary market, we must first define the entities that initiate these financial transactions. An issuer is a legal entity that develops, registers, and sells securities to the investing public for the purpose of financing its operations or specific projects. These entities can take many forms, including corporations, which might issue stocks or bonds, or various levels of government, such as the U.S. Treasury, state municipalities, or foreign sovereigns. Even special-purpose vehicles or nonprofit organizations can act as issuers if they seek to raise funds by offering investment contracts to the public. The defining characteristic of an issuer is that it is the party responsible for the obligations underlying the security and the one that ultimately receives the proceeds from the sale. When an issuer decides to raise capital, it rarely does so alone because the process involves significant regulatory complexity and financial risk. This is where the underwriter comes into play, acting as a crucial intermediary between the issuer and the investing public. An underwriter is typically a broker-dealer that specializes in investment banking services and helps the issuer structure the offering. They provide counsel on the timing of the issuance, the appropriate price for the securities, and the specific type of security that would best suit the current market appetite. More importantly, the underwriter facilitates the distribution of these securities to investors, often assuming some degree of financial liability in the process. The relationship between issuers and underwriters is formalized through an underwriting agreement, which dictates the terms of the engagement and the responsibilities of each party. In large offerings, a single broker-dealer might find the risk too great to handle individually, leading to the formation of an underwriting syndicate. This syndicate is a group of investment bankers who share the financial risk and the distribution responsibilities, led by a managing underwriter. The managing underwriter, or lead manager, directs the entire process and maintains the books for the offering, ensuring that the distribution is handled according to regulatory requirements. By spreading the risk among several firms, the syndicate ensures that the issuer can successfully raise the substantial amounts of capital required for large-scale operations. It is important to distinguish between the various roles within the underwriting process to understand how compensation and risk are allocated. While the syndicate members take on financial liability for unsold shares, they may also enlist a selling group to assist in the distribution. Selling group members act as subcontractors and do not assume any financial responsibility for unsold inventory. They simply earn a commission for the shares they manage to sell to their clients. This hierarchical structure allows the primary market to function efficiently by involving multiple layers of broker-dealers to reach a broad base of retail and institutional investors. The issuer benefits from this extensive network, as it maximizes the likelihood that the entire offering will be subscribed at the desired price point. Beyond corporations and governments, we must also consider the role of municipal issuers, which includes cities, counties, and various authorities. These entities issue municipal bonds to fund public works like bridges, schools, or hospitals, and they rely on underwriters to navigate the unique tax implications of these securities. The underwriting process for municipal debt often involves a competitive bidding process, unlike the negotiated underwritings more common in the corporate world. Regardless of the method, the underwriter's role remains fundamentally the same, assisting the issuer in bridging the gap between their need for capital and the investor's desire for investment opportunities. Understanding these roles is foundational to grasping how new securities are introduced into the financial ecosystem before they ever begin trading on a secondary exchange. See you in the next lecture. Welcome back. In the landscape of capital markets, we distinguish between market participants based on their sophistication, wealth, and the regulatory protections they require. The most fundamental distinction is between retail investors and institutional investors. A retail investor is generally an individual who purchases securities for their own personal account rather than for an organization. These individuals are typically investing for long-term goals, such as retirement or a child's education. because they often lack the deep financial expertise or the vast resources of large organizations. The regulatory framework provides them with the highest level of protection. This protection manifests through strict disclosure requirements and suitability standards that broker-dealers must follow when making recommendations. While most retail investors are treated as a single category, some may qualify as accredited investors under Regulation D of the Securities Act of 1933. An accredited investor is a retail investor who meets specific income or net worth thresholds. To qualify, an individual must have a net worth of at least $1 million, excluding the value of their primary residence, or an annual income exceeding $200,000 for the last 2 years. If a couple is investing together, that income threshold rises to $300,000. The significance of this classification lies in the fact that accredited investors are permitted to participate in private placements and other sophisticated offerings that are generally closed to the average retail public. Institutional investors represent the other side of the spectrum, consisting of entities that manage large pools of money. These include banks, insurance companies, investment companies, pension funds, and endowment funds. Unlike retail investors, institutional investors are assumed to possess a high degree of financial sophistication and the ability to conduct their own due diligence. Because they trade in massive volumes, they often have access to different market tiers and pricing structures. Regulatory bodies like FINRA recognize that these entities do not require the same hand-holding as an individual saving for retirement. Consequently, the suitability obligations for a broker-dealer are somewhat attenuated when the client is a sophisticated institution capable of evaluating risks independently. A specific and highly important subset of institutional investors is the qualified institutional buyer, or QIB. To be classified as a QIB under Rule 144, an institution must manage at least $100 million in securities for its own portfolio or for other institutional clients. This is a significantly higher bar than the general definition of an institutional investor. The distinction is critical because QIBs are allowed to trade restricted securities among themselves without those securities being registered with the SEC. This creates a liquid private market that is entirely separate from the public exchanges. You should note that while an individual can be an accredited investor, an individual can never be a qualified institutional buyer, regardless of their wealth. Broker-dealers are required to categorize their customers correctly to ensure compliance with communication and suitability rules. When a firm interacts with a retail investor, every piece of sales literature and every recommendation is under intense scrutiny to prevent exploitation. In contrast, when dealing with an institutional investor, the firm must still act fairly, but the expectation is that the institution has the resources to understand complex financial instruments. Understanding these boundaries helps you see why different products are marketed to different groups. A complex derivative might be appropriate for a hedge fund acting as an institutional investor, but it would rarely be suitable for a retail investor with a low risk tolerance. I'll see you in the next lecture. Welcome back. Let's solidify our knowledge of the capital market structure with a short quiz to ensure you have mastered the roles of various participants and the mechanics of different market segments. Which of the following entities is primarily responsible for assuming financial risk by purchasing a new issue of securities from an issuer with the intent to resell those securities to the public? A. Investment advisor. B. Transfer agent. C. Underwriter. D. Broker-dealer acting in an agency capacity. Please pause the video now to consider your answer before we proceed to the explanation. The correct answer is C. Underwriter. In the context of the primary market, an underwriter plays a pivotal role by bridging the gap between the issuer and the investing public. When a corporation or government entity needs to raise capital, they engage an investment bank to serve as the underwriter. The defining characteristic of an underwriter is their role in the distribution of new, previously unissued securities. While some underwriting agreements are structured to limit risk, the standard definition assumes the underwriter facilitates the offering by purchasing the inventory from the issuer. This distinguishes the primary market, where the proceeds of the sale go to the issuer, from the secondary market, where investors trade among themselves. To understand why the other options are incorrect, we must look at the specific functions of each role within the financial ecosystem. An investment advisor is an entity that is paid a fee for providing investment advice, but they do not typically take a principal position in the underwriting of new issues. A transfer agent is responsible for maintaining records of stock ownership and is not involved in the risk-bearing process of selling securities. Finally, a broker-dealer acting in an agency capacity is essentially acting as a middleman or broker, matching buyers with sellers for a commission, rather than taking a financial stake or principal risk in the transaction itself. We should also distinguish between the types of investors involved in these transactions. Institutional investors, such as banks, insurance companies, or large pension funds, often participate in these primary offerings alongside retail investors, who are typically individuals trading for their own accounts. The regulations surrounding capital markets are designed to protect these retail investors, as they are generally presumed to have less financial sophistication than institutional entities. Understanding the flow of funds from the investor back to the issuer is key to identifying the primary market. Once those securities begin trading on an exchange or over-the-counter between participants, the role of the underwriter concludes and the secondary market takes over. See you in the next lecture. Hello. It is good to see you again as we continue our look into the regulatory landscape of the financial markets. The Securities and Exchange Commission, or the SEC, is the primary body responsible for overseeing the United States securities markets. While it might be tempting to view it as a monolithic entity with unlimited power, its character is more specifically defined by the mission to protect investors, maintain fair and orderly markets, and facilitate capital formation. It was established by the Securities Exchange Act of 1934, making it a product of the Great Depression era. This historical context is important because it explains why the agency exists in the first place. Before its creation, there was no centralized federal authority to police the markets, which contributed to the volatility and fraud of the 1920s. Today, the SEC functions as an independent federal agency that operates with executive, legislative, and judicial-like powers within its specific domain. When we talk about the SEC, we're talking about a body composed of 5 commissioners who are appointed by the president. To ensure that the agency remains relatively insulated from partisan shifts, these commissioners serve 5-year staggered terms, and no more than 3 of them can belong to the same political party. This structural design is intended to provide a level of continuity and objective oversight regardless of the current administration's leanings. The SEC does not actually belong to any of the 3 main branches of government in the traditional sense. But as an independent agency, it has the authority to create rules and regulations that carry the force of law. It also has the power to investigate potential violations and bring civil enforcement actions against individuals or firms that fail to comply with federal securities laws. One of the most critical aspects of the SEC's authority is its jurisdiction over the various players in the financial markets. It oversees broker-dealers, investment advisors, and even the self-regulatory organizations that we will discuss in later sessions. It is the repository for a vast amount of disclosure documentation, including registration statements for new securities and periodic financial reports for publicly traded companies. This focus on disclosure is foundational to the SEC's philosophy. The agency does not typically judge whether an investment is good or bad for the public, which is a common misconception among new students. Instead, it ensures that all relevant information is provided to the public so that individual investors can make informed decisions based on the actual risks involved. The SEC is organized into several divisions, each focusing on a specific part of the regulatory life cycle. For instance, the Division of Corporation Finance oversees the disclosure documents filed by companies, while the Division of Enforcement is responsible for investigating violations and prosecuting civil cases. There is also the Division of Examinations, which conducts inspections of registered entities to ensure they are operating according to the rules. By partitioning its duties this way, the SEC can maintain a broad reach without losing focus on the technical details of market mechanics. For your exam purposes, it is enough to understand that the SEC is the ultimate federal authority, sitting at the top of the regulatory pyramid, and that its primary concerns are transparency and market integrity. Beyond its role in registration and enforcement, the SEC also has a significant impact on how markets are structured and how trades are executed. It has the authority to regulate the exchanges themselves, such as the New York Stock Exchange and the NASDAQ. When you see new rules regarding trade execution or market transparency, these often originate from or are approved by the SEC. It is also important to note that while the SEC can bring civil actions and impose fines or bars from the industry, it does not have the authority to bring criminal charges. If a case involves criminal activity, such as blatant fraud or theft, the SEC refers that case to the Department of Justice. This distinction between civil and criminal authority is a classic point of interest in the study of federal regulation. Ultimately, the SEC serves as the cop on the beat for the financial world, even if much of its work is done through paperwork and administrative hearings. Because it requires broker-dealers and investment advisors to register with it, the SEC maintains a gateway to the industry. Any firm that wishes to operate in interstate commerce within the securities industry must be willing to submit to this oversight. This oversight extends to the review of annual and quarterly reports, which allows the SEC to spot inconsistencies in financial health before they become systemic problems. When you represent a firm in the future, you're operating within a framework that is largely dictated by the rules established and enforced by this single agency. Knowing its origins and its powers is the first step in understanding the rest of the regulatory environment. I look forward to seeing you in the next session. Welcome back. We are continuing our examination of regulatory entities by focusing on self-regulatory organizations. To understand the financial industry's landscape, we must distinguish between government agencies and self-regulatory organizations, or SROs. While the SEC is a federal government agency with broad legal authority, SROs are non-governmental entities that are given the power by the SEC to create and enforce day-to-day rules for their members. This delegation of power is a pragmatic approach to regulation. The industry effectively polices itself under the watchful eye of the government. Member firms must comply with SRO rules as a condition of doing business, and failure to do so can result in significant fines or expulsion from the industry. Because these organizations are funded by their members rather than taxpayers, they can move with a degree of specificity that a purely governmental body might lack. The Financial Industry Regulatory Authority, commonly known as FINRA, is the most prominent SRO you will encounter. It regulates nearly all securities firms doing business with the public in the United States and oversees the licensing and conduct of registered representatives. When you sit for this exam, you're interacting with a process managed by FINRA. Its jurisdiction covers a vast array of activities, from the way firms supervise their employees to the technical methods used for trade reporting. FINRA's primary mission is to ensure market integrity and investor protection by enforcing a massive rulebook that addresses ethical conduct and fair dealing. If a firm violates these rules, FINRA has the authority to conduct disciplinary hearings and impose sanctions. Another critical SRO in the capital markets is the Municipal Securities Rulemaking Board, or MSRB. As its name suggests, the MSRB is focused specifically on the municipal securities market, including the conduct of broker-dealers and municipal advisors. However, the MSRB is structurally unique because while it creates those rules, it does not have the authority to enforce them directly. Instead, enforcement of MSRB rules is delegated to other entities like FINRA for broker-dealers or the SEC and bank regulators for municipal advisors. This distinction is vital for your understanding of the regulatory hierarchy. You should think of the MSRB as the legislative body for municipal bonds, drafting the blueprints that other organizations then use to maintain order. We also find SROs in the options and exchange-listed markets, such as the Chicago Board Options Exchange, CBOE. The CBOE serves as both a central marketplace for trading standardized options contracts and an SRO that regulates the conduct on its own exchange. Like other SROs, it establishes strict listing requirements for the products traded there and monitors trading activity to detect potential manipulation. Every options trade is governed by the rules established by these specialized SROs to ensure that the markets remain transparent and auction-based. When a firm chooses to participate in these specific markets, they voluntarily submit to the oversight and rule-making authority of that particular exchange's SRO function. The operational framework of an SRO is built on the concept of membership. A broker-dealer becomes a member firm, and by doing so, it agrees to abide by the SRO's conduct rules, Uniform Practice Code, and Code of Procedure. The conduct rules dictate how a member firm must interact with customers, emphasizing that recommendations must be suitable and communications must be truthful. The Uniform Practice Code standardizes the technical aspects of trading, such as settlement dates and delivery procedures, so that all firms are working from the same operational playbook. These rules eliminate friction in the markets by ensuring that every participant knows exactly what to expect during the life cycle of a transaction. Finally, we must consider how disputes are handled within the SRO framework, which is governed by the Code of Arbitration. This is a mandatory process for resolving disputes between members or between members and their employees, and often between members and customers if an arbitration agreement exists. Arbitration is generally faster and less expensive than traditional litigation in a court of law. Once an arbitrator or a panel makes a decision, that ruling is final and binding on all parties involved, with very few avenues for appeal. This system ensures that the financial industry can resolve its internal conflicts without clogging the public court system, maintaining the efficiency of the capital markets. I'll see you in the next lesson. Hello, and welcome back. While the Securities and Exchange Commission oversees the industry at the federal level, each individual state maintains its own authority to regulate securities transactions within its borders. This dual system of regulation ensures that even if a firm or a security is exempt from federal registration, it still remains subject to the scrutiny of local jurisdictions. We often refer to these state-level regulations as blue sky laws, a term originating from a desire to protect investors from speculative schemes that had no more substance than so many feet of blue sky. The Uniform Securities Act serves as the model legislation that most states use to draft their specific regulations, creating a degree of consistency across the country despite the inherent legal variations between different states. You should understand that these laws are specifically designed to address local fraud and to require the registration of securities, broker-dealers, and investment advisors who conduct business with state residents. The administration of these laws falls to a designated state official or agency, typically referred to as the State Securities Administrator. The administrator holds broad powers to investigate potential violations, issue cease and desist orders, and coordinate with other regulatory bodies to enforce compliance. Within their specific jurisdiction, the administrator is responsible for ensuring that all financial professionals are properly qualified and that the products they sell are properly vetted through registration or are lawfully exempt. They also play a crucial role in investor education and the handling of consumer complaints, acting as the primary point of contact for retail investors who believe they have been victims of misconduct. While federal law often takes precedence in interstate commerce, the state administrator remains the relevant authority for many localized activities that do not meet federal thresholds. To facilitate cooperation among these various state regulators, the North American Securities Administrators Association, or NASAA, was established as a voluntary membership organization. NASAA does not possess direct enforcement power themselves. Rather, they serve as a framework for state and provincial regulators in the United States, Canada, and Mexico to share information and develop uniform policies. By collaborating through NASAA, state regulators can create standardized exams, such as the Series 63, 65, and 66, which ensure that professionals have a consistent understanding of state-level requirements. They also draft model rules and interpretive releases that help states keep their individual blue sky laws updated against evolving market practices. For your purposes, viewing NASAA as a clearinghouse for state regulatory standards and a collective voice for investor protection at the local level is the most accurate way to categorize their function. An important distinction to maintain is the relationship between state and federal registration for investment advisors and broker-dealers. Under the National Securities Markets Improvement Act, also known as NSMIA, the regulatory burden is split to avoid redundant oversight. Larger investment advisors with significant assets under management generally register with the SEC, while smaller advisors typically register with the state administrator in the states where they maintain an office or a significant number of clients. Broker-dealers, however, generally must register with both the SEC and any state in which they have a place of business or where they direct offers to residents. This intersection of federal and state authority means that a professional must often navigate multiple layers of compliance to ensure they are legally permitted to operate. Understanding that the state's primary goal is the protection of its specific citizens will help you contextualize why these additional requirements exist alongside federal mandates. When a security is offered for sale, it must either be registered with the state, be a federal covered security, or qualify for an exemption under state law. State registration can occur through several methods, such as coordination, where the state filing is made simultaneously with the federal filing, or qualification, which is a more rigorous process used for securities not registered with the SEC. Federal covered securities, which include those listed on national exchanges like the NYSE or NASDAQ, are exempt from state-level registration. Those states may still require a notice filing and the payment of fees. This system ensures that while the federal government handles large-scale national offerings, the states retain the ability to monitor smaller, local offerings that might otherwise escape regulatory notice. By requiring registration or notice, state regulators maintain a record of what is being sold to their constituents and who is responsible for those invitations to invest. I'll see you in the next lesson. Welcome back. The Federal Reserve, often referred to as the Fed, is the central bank of the United States and serves as a critical regulator within the financial system. While it is independent of the federal government in its daily operations, it is accountable to Congress and operates to promote a stable and flexible monetary and financial system. You should think of the Fed as the entity responsible for managing the nation's money supply and the cost of credit. It does not regulate individual brokerage firms in the same way the SEC or FINRA might, but its actions dictate the environment in which all capital market participants operate. The Fed consists of the Board of Governors in Washington, D.C., and 12 regional Federal Reserve banks located across the country. Through these structures, it monitors systemic risk and ensures that the banking system remains solvent and functional during periods of economic stress. One of the primary responsibilities of the Federal Reserve is the implementation of monetary policy, which aims to achieve maximum employment and stable prices. To accomplish these goals, the Fed utilizes several tools that directly influence the amount of money circulating in the economy. The most frequently used tool is open market operations, conducted by the Federal Open Market Committee, or FOMC. By purchasing or selling U.S. Treasury securities in the secondary market, the Fed can increase or decrease the reserves held by member banks. When the Fed buys securities, it injects liquidity into the banking system, which generally leads to lower interest rates. Conversely, when it sells securities, it drains liquidity from the system, which exerts upward pressure on interest rates. Another significant lever at the Fed's disposal is the discount rate, which is the interest rate the Fed charges member banks for short-term loans. By adjusting this rate, the Fed signals its stance on monetary policy to the broader market. A lower discount rate makes it cheaper for banks to borrow from the Fed, encouraging them to lend more to consumers and businesses. A higher discount rate has the opposite effect, effectively tightening credit conditions throughout the economy. It is important to distinguish this from the federal funds rate, which is the rate banks charge each other for overnight loans. While the Fed does not set the federal funds rate directly, it targets a specific range for it through its open market operations and other policy adjustments. The Fed also maintains authority over reserve requirements, which dictate the percentage of deposits that banks must keep on hand rather than lending out. If the Fed increases the reserve requirement, banks have less money available for lending, which reduces the overall money supply. If the requirement is lowered, banks can lend out a larger portion of their deposits, thereby stimulating economic activity. In practice, adjustments to reserve requirements are rare compared to open market operations because even small changes can have a massive impact on the banking industry structure. Understanding this mechanism is vital because it illustrates the direct link between central bank policy and the availability of credit for the average participant in the capital markets. In addition to managing the money supply, the Federal Reserve plays a vital role in regulating the credit extended by broker-dealers for the purchase of securities. This authority is exercised through Regulation T, which governs the amount of credit that can be extended to customers in margin accounts. By setting these initial margin requirements, the Fed controls the amount of leverage available in the securities markets, which helps prevent excessive speculation that could lead to systemic instability. While the SEC oversees the conduct of participants, the Fed oversees the structural financial conditions under which that conduct occurs. This distinction is subtle, but important for your understanding of how different regulatory bodies partition their responsibilities in the United States. Finally, the Federal Reserve acts as a lender of last resort to the financial system, providing liquidity during times of crisis when private sources of funding may dry up. This function is designed to prevent a domino effect of bank failures that could lead to a total collapse of the financial markets. The Fed also provides essential services to the government and the public, such as clearing checks, processing electronic payments, and acting as the fiscal agent for the U.S. Treasury. By managing the issuance and redemption of government debt, the Fed ensures that the government can fund its operations efficiently. This comprehensive scope of duties makes the Fed the most influential economic institution in the world, as its decisions ripples through international markets and affect every asset class you will study. Until next time, welcome back. Understanding the mechanisms that protect investors is a fundamental requirement for the SIE exam, and we must distinguish between the protections offered for securities and those offered for cash deposits. The Securities Investor Protection Corporation, or SIPC, is a nonprofit membership organization that provides limited coverage to customers of broker-dealers in the event of the firm's financial failure. It is important to realize that SIPC is not a government agency. Though it was created by a federal statute, the Securities Investor Protection Act of 1970. Most broker-dealers registered with the SEC are required to be members of SIPC, paying assessments into a general insurance fund. This fund is then used to restore customer property when a member firm becomes insolvent and can no longer meet its obligations. The scope of SIPC coverage is specific and limited to the loss of cash and securities held by the broker-dealer on behalf of a client. In the event of a firm's liquidation, SIPC provides coverage up to $500,000 per separate customer. Within that $500,000 limit, a maximum of $250,000 can be applied to claims for cash. If a customer has $300,000 in stock and $200,000 in cash, they're fully covered because the total is within the $500,000 limit and the cash portion does not exceed the $250,000 sublimit. However, SIPC does not protect against market risk or provide a guarantee that the value of your investments will not decline. Defining a separate customer is a critical nuance for the exam, as it determines how the coverage limits are applied across different accounts. If an individual maintains a standard brokerage account and an IRA at the same firm, these are treated as two separate customers, and each receives its own $500,000 limit. Joint accounts and custodial accounts for minors also count as distinct capacities for coverage purposes. However, if an individual has two separate brokerage accounts in their name only at the same firm, SIPC treats them as a single customer. This means the total combined value of those two accounts would be subject to a single $500,000 protection limit. When a brokerage firm undergoes liquidation, the distribution of assets follows a strict protocol managed by a court-appointed trustee. First, any securities that are specifically registered in the name of the customer are returned directly to that customer without respect to the SIPC limits. Second, the remaining boat of street-name securities and cash is distributed to customers on a pro rata basis. If these assets are insufficient to satisfy all claims, SIPC steps in to cover the shortfall up to the prescribed limits. Any customer with a claim exceeding the SIPC coverage limits becomes a general creditor of the failed broker-dealer for the remaining balance. In contrast to the SIPC, the Federal Deposit Insurance Corporation, or FDIC, is an independent agency of the United States government. Its primary role is to maintain stability and public confidence in the nation's financial system by ensuring deposits in banks and thrift institutions. While SIPC covers securities held at broker-dealers, the FDIC covers traditional banking products such as checking accounts, savings accounts, and certificates of deposit. The standard insurance amount is $250,000 per depositor, per insured bank, for each account ownership category. This protection is backed by the full faith and credit of the United States government, distinguishing it from the SIPC's industry-funded model. It is vital to maintain a clear boundary between which entity covers which type of financial product. You will frequently encounter scenarios where a bank might have an investment wing, or a broker-dealer might offer a sweep account into a bank. If a client buys a mutual fund or a bond at a bank, that investment is not covered by the FDIC because it is a security, not a deposit. Conversely, a money market deposit account at a bank is protected by the FDIC, but a money market mutual fund at a brokerage is covered by the SIPC. Always look at the underlying product and the type of institution holding it to determine which regulatory safety net applies. Finally, we must consider what is explicitly excluded from SIPC coverage to avoid common pitfalls. SIPC does not cover claims for commodities, futures contracts, or investment contracts that are not registered with the SEC. It also excludes coverage for accounts held by persons who are closely associated with a failing firm, such as partners or officers of the broker-dealer. Currencies, particularly digital assets or foreign exchange positions, are generally not considered securities for the purposes of SIPC protection. By understanding these exclusions and the specific dollar limits for both SIPC and FDIC, you'll be well equipped to handle questions regarding customer protection. I'll see you in the next lecture. Hello again. Let's solidify our knowledge of the regulatory landscape with a short quiz to ensure you can distinguish between the various entities we have discussed. Which of the following entities is responsible for protecting customer assets in the event of a broker-dealer's failure? And what is the maximum coverage provided for cash claims? A. FDIC, $250,000. B. SIPC, $250,000. C. SEC, $500,000. D. FINRA, $100,000. Please pause the video now to consider the correct answer before we continue. The correct answer is B. SIPC, $250,000. Distinguishing between the Securities Investor Protection Corporation, SIPC, and the Federal Deposit Insurance Corporation, FDIC, is a fundamental requirement for the SIE. SIPC is a nonprofit membership corporation funded by broker-dealers, designed specifically to protect customer accounts when a firm becomes insolvent. It provides a total of $500,000 in coverage per separate customer, but there is a specific sublimit of $250,000 for cash claims. If a customer has $300,000 in cash in their brokerage account, SIPC would only cover $250,000 of that cash, leaving the remaining $50,000 as a general creditor claim against the failed firm. This differs significantly from the FDIC, which is a government agency providing insurance for traditional banking deposits rather than investment accounts. The other options provided are incorrect because they conflate the roles of regulators and insurance providers. The Securities and Exchange Commission, SEC, is the ultimate federal government regulator responsible for enforcing federal securities laws and overseeing the industry, but it does not provide insurance coverage for account losses. Similarly, the Financial Industry Regulatory Authority, FINRA, is a self-regulatory organization, SRO, that manages the licensing and conduct of member firms and associated persons, but it has no insurance function. It is also important to remember that SIPC does not protect against market loss. It only addresses the physical or digital loss of assets held by a bankrupt or troubled broker-dealer. Understanding these boundaries ensures you can accurately identify which body governs a specific market participant or protection mechanism. I'll see you in the next lesson. Hello, it is good to have you back as we move into the specifics of how the economy functions over time. The business cycle is a recurring pattern of fluctuations in economic activity, primarily measured by gross domestic product. It is important to understand that these cycles are not uniform in length or intensity, yet they always follow a specific sequence of 4 distinct phases. When analyzing these movements, we are looking at the broad health of the economy, including levels of employment, consumer spending, and industrial production. For the purposes of the SIE exam, you must be able to identify each phase and understand the characteristics that define them. Success in securities trading and investment management often depends on recognizing which phase of the cycle we are currently in. This allows market participants to adjust their expectations regarding corporate earnings and interest rate changes. The expansion phase is characterized by an increase in economic activity across the board. During this period, GDP is rising, consumer demand is strong, and the stock market typically exhibits bullish behavior. Businesses tend to increase production to meet the growing demand, which leads to higher employment levels and rising wages. As the expansion continues and the economy approaches full employment, there is often upward pressure on prices, leading to inflation. It is a period of general growth where credit is easily available and business inventories are usually low because goods are being sold quickly. You should associate this phase with prosperity and increasing industrial output. Eventually, the expansion reaches its highest point, which we refer to as the peak. At the peak, the economy has reached its maximum sustainable output, and the growth of GDP begins to flatten out. Demand for goods and services starts to outpace the economy's ability to produce them, often pushing inflation to uncomfortable levels. Central banks might begin to raise interest rates to cool down the overheating economy. Because production is at full capacity, there is very little room for further growth without significant new investment. This phase represents a transition period where the momentum of the expansion essentially exhausts itself before turning downward. Following the peak, the economy enters the contraction phase, which is marked by a decline in real GDP. If this decline persists for 2 consecutive quarters, it is technically defined as a recession. A more severe or prolonged downturn is classified as a depression. During a contraction, consumer demand falls, leading businesses to scale back production and reduce their workforce. This results in rising unemployment and a decrease in consumer spending, creating a feedback loop that further slows the economy. Corporate profits usually decline during this time, and as a result, the stock market often reflects this through falling share prices. You may also observe that inventories begin to build up because consumers are no longer purchasing goods at the previous rate. The final phase is the trough, which marks the lowest point of the economic downturn. At this stage, the decline in GDP stops and the economy begins to stabilize before the next expansion starts. While unemployment remains high and consumer confidence is typically low, the conditions for recovery begin to take shape. Prices may have leveled off, and interest rates are often lowered by the Federal Reserve to encourage borrowing and investment. It is the turning point where the negative momentum of the contraction ceases. Once the economy begins to grow again from this point, we move back into the expansion phase, completing the cycle and starting the process over again. I will see you in the next lesson. Hello, and welcome back to our discussion on economic factors. To understand the financial markets, we must be able to categorize the data points that inform us about the state of the economy. Economic indicators serve as diagnostic tools that reveal whether the business cycle is expanding or contracting. We categorize these metrics into 3 distinct groups based on their temporal relationship with the overall economy: leading, coincident, and lagging indicators. Each group provides a specific perspective, and as a candidate for the SIE, you must be able to distinguish between them accurately. It is not enough to know that an indicator represents growth. You must know when that growth is actually occurring relative to the data being reported. Leading indicators are perhaps the most frequently discussed because they possess predictive qualities. These metrics tend to change direction before the economy as a whole follows suit, making them useful for forecasting future trends. Common examples include building permits, which signal future construction activity, and the money supply, M2, which indicates the availability of capital for future spending. Manufacturers' new orders for consumer goods and stock market prices also fall into this category because investors trade based on expectations of what will happen in the coming months. If you see a consistent rise in these leading data points, it often suggests that an economic expansion is on the horizon. Coincident indicators change at approximately the same time as the economy as a whole, providing a snapshot of current conditions. These metrics do not look forward or backward. They tell us exactly where we are standing right now in the business cycle. Examples include industrial production and the manufacturing and trade sales figures, which reflect real-time output. Personal income levels and non-agricultural payrolls are also key coincident indicators because they fluctuate in tandem with current economic vitality. When analysts want to confirm the current phase of the business cycle, such as whether we are currently in a peak or a trough, they look to these coincident figures for immediate validation. Lagging indicators are the final piece of the puzzle, changing only after the economy has already begun to follow a particular trend. These metrics are used to confirm that a specific trend, such as a recession or an expansion, has actually occurred in the past. High interest rates, for instance, often persist even after an economy begins to cool, and the average duration of unemployment typically increases well after a recession has started. Corporate profits and the ratio of consumer installment credit to personal income also tend to lag behind the broader economic movements. While they are not useful for prediction, lagging indicators are essential for identifying the duration and strength of past economic shifts. The Consumer Price Index, CPI, is a critical metric that measures the change in prices for a fixed basket of goods and services purchased by typical urban consumers. It serves as the primary gauge for inflation, reflecting the purchasing power of the dollar over time. When the CPI rises, it indicates that goods are becoming more expensive, which often prompts the Federal Reserve to adjust interest rates to maintain stability. For the purposes of the exam, remember that while CPI reflects price changes, its classification as an indicator can vary, though is frequently viewed as a lagging indicator because price adjustments usually follow changes in underlying economic activity. Gross domestic product, GDP, represents the total market value of all goods and services produced within a country's borders during a specific period. It is the most comprehensive measure of an economy's size and health, often reported on a quarterly basis. When GDP grows, the economy is considered productive. When it shrinks for 2 consecutive quarters, it is the technical definition of a recession. While GDP is a broad measure, the components that make it up, such as consumer spending, investment, government spending, and net exports, provide the raw data that these various indicators are meant to summarize. Understanding the interplay between these components is vital for interpreting the broader economic landscape. I hope this provides a clear framework for how we categorize economic data. See you in the next lecture. Hello again. Let's look at how price levels change over time and what that means for the financial markets. Inflation is defined as a general increase in the prices of goods and services within an economy over a specific period. When inflation occurs, each unit of currency buys fewer goods than it did previously, which is why we often say inflation erodes purchasing power. For an investor, this is a critical metric because it determines the real rate of return on investment. If your portfolio grows by 5% in a year, but inflation is also at 5%, your actual wealth hasn't increased in terms of what you can consume. We often measure this using the Consumer Price Index, or CPI, which tracks a basket of goods to see how much more expensive life is becoming for the average person. The causes of inflation are generally categorized into 2 main drivers: demand pull and cost push. Demand pull inflation happens when the demand for goods and services exceeds the available supply, essentially pulling prices higher as consumers compete for limited products. Cost push inflation occurs when the costs of production, such as labor or raw materials, increase for manufacturers. To maintain profit margins, companies pass these higher costs on to consumers in the form of higher prices. Both scenarios lead to the same result for the investor, which is a reduction in the value of future cash flows. Fixed income securities, such as bonds, are particularly sensitive to inflationary pressures. Because a bond typically pays a fixed coupon rate, that set amount of money becomes less valuable as the cost of living rises. Investors who hold long-term debt instruments face the risk that the interest they receive will not keep pace with rising prices, a concept known as purchasing power risk. When inflation expectations rise, the market usually responds by demanding higher interest rates. This inverse relationship means that as inflation pushes interest rates up, the market value of existing bonds with lower fixed rates tends to fall. Deflation is the opposite phenomenon, characterized by a general decline in the price levels of goods and services. While falling prices might sound beneficial to a consumer in the short term, persistent deflation is usually a sign of a struggling economy with low demand. During deflationary periods, the purchasing power of money actually increases because a dollar tomorrow can buy more than a dollar today. This often leads consumers to delay purchases in anticipation of even lower prices, which can create a downward spiral of reduced corporate earnings and higher unemployment. For an investor, deflation makes cash and high-quality fixed-income securities more attractive because the value of those fixed payments increases in real terms. There's also a specific middle ground known as disinflation, which is often confused with deflation. Disinflation is not a decline in prices, but rather a reduction in the rate at which prices are rising. If inflation drops from 5% one year to 2% the next, the economy is experiencing disinflation. Prices are still going up, just more slowly than before. Understanding the distinction between a slowing rate of inflation and an actual drop in price levels is vital for interpreting economic reports correctly. Central banks generally aim for a low, stable rate of inflation rather than deflation or high inflation, as stability allows for more predictable long-term financial planning. Equities can sometimes act as a hedge against inflation, although this is not always a linear relationship. Many companies have pricing power, which allows them to raise the prices of their products in line with increasing costs, thereby protecting their earnings. However, if inflation becomes too high, the resulting high interest rates can increase the cost of borrowing for companies and hurt their valuations. Real estate and commodities are other asset classes that investors often turn to when they expect inflation to rise. On the other hand, during deflationary cycles, stocks often perform poorly as corporate revenues shrink and the real burden of any debt the company holds increases. A healthy economy typically experiences mild inflation, as it suggests that consumer demand is robust and the labor market is active. When inflation is moderate, it encourages individuals to spend or invest their money rather than hoarding cash that is slowly losing value. This circulation of capital is what drives economic growth and provides the liquidity necessary for the capital markets to function effectively. As you prepare for the exam, remember that the Federal Reserve uses various tools to keep inflation within a target range. They monitor these price shifts closely to decide whether to tighten or loosen monetary policy, which we will discuss in detail soon. I'll see you in the next lecture. Welcome back. When we discuss the forces that shape the economy, we must distinguish between two primary levers of control: monetary policy and fiscal policy. While both aim to influence economic growth and stability, they originate from different authorities and use different mechanisms to achieve their goals. For the SIE exam, it is crucial to understand that monetary policy is the domain of the central bank, specifically the Federal Reserve in the United States, whereas fiscal policy is the responsibility of Congress and the President. This distinction is fundamental because it defines how liquidity, interest rates, and government spending interact with the broader market. Mixing these concepts up is a common error, so we will examine each in isolation before looking at how they interact. Monetary policy centers on the management of the money supply and interest rates to influence the cost of borrowing. The Federal Reserve, or the Fed, operates with a dual mandate to promote maximum employment and stable prices. To influence the economy, the Fed primarily uses four tools: open market operations, the discount rate, reserve requirements, and interest on reserve balances. Open market operations are frequently tested and involve the buying and selling of U.S. Treasury securities. When the Fed buys securities, it injects cash into the banking system, which increases the money supply and lowers interest rates. Conversely, when the Fed sells securities, it drains liquidity from the system, which typically leads to higher interest rates and a cooling effect on economic activity. The discount rate and reserve requirements represent more structural adjustments to the banking environment. The discount rate is the interest rate at which the Federal Reserve charges member banks for short-term loans. A lower discount rate encourages banks to borrow more and lend more freely to consumers and businesses. Reserve requirements dictate the percentage of deposits that a bank must keep in its vaults or at the Fed, rather than lending them out. If the Fed increases the reserve requirement, banks have less capital to lend, which tightens the money supply. Currently, the Fed relies heavily on interest paid on reserve balances as a primary tool to guide the federal funds rate, which is the interest rate banks charge each other for overnight loans. Fiscal policy, by contrast, refers to the government's use of spending and taxation to influence the economy. Unlike monetary policy, which is adjusted frequently by a non-political body, fiscal policy is a political process that results from the federal budget. The two main levers here are government spending and tax rates. When the government increases spending on infrastructure or social programs, it directly injects capital into the economy, theoretically boosting demand. Similarly, decreasing taxes leaves more disposable income in the hands of individuals and corporations, which can stimulate investment and consumption. These actions are often referred to as expansionary fiscal policy, typically used during recessions to jumpstart growth. Contractionary fiscal policy is the inverse, used when the economy is overheating and inflation is becoming a significant concern. In this scenario, the government might reduce overall spending or increase tax rates to pull money out of the private sector and slow down demand. It is important to note that fiscal policy decisions often lead to budget deficits or surpluses. When spending exceeds tax revenue, the government must issue debt, Treasury securities, to fund the deficit. This creates a link back to the capital markets, as the supply of government debt can influence interest rates and the availability of capital for private borrowers. Practitioners should recognize that fiscal policy generally has a longer implementation lag than monetary policy due to the legislative process. Economics often describes these policies through different schools of thought, notably Keynesianism and supply-side economics. Keynesians believe that government intervention via fiscal policy is necessary to manage demand and stabilize the business cycle. They argue that during a downturn, the government should spend money even if it results in a deficit. Supply-side economists, on the other hand, argue that economic growth is best achieved by lowering taxes and reducing regulation to encourage production. They believe that if businesses are more profitable, the benefits will eventually trickle down to the rest of the economy. While the SIE won't ask for a political critique, you must know that Keynesianism focuses on government spending, while supply-side economics focuses on tax cuts and deregulation. Finally, we must consider the easy and tight money stances often referred to in market analysis. An easy money policy occurs when the Fed increases the money supply and lowers rates, often coupled with expansionary fiscal policy. This is intended to stimulate the economy, but carries the risk of causing inflation if the money supply grows too quickly. A tight money policy involves the Fed raising rates and reducing the money supply, potentially alongside contractionary fiscal policy to combat inflation. You should be able to identify which specific actions belong to which policy type. For instance, a decrease in the reserve requirement is an easy monetary tool, while an increase in the corporate tax rate is a contractionary fiscal tool. See you in the next lesson. Hello, and welcome back. To understand the broader economic environment for the SIE exam, we must look beyond domestic borders and consider how nations interact financially. International economics is primarily concerned with the flow of goods, services, and capital across sovereign lines. This movement is facilitated by the exchange of different currencies, which introduces a layer of complexity not found in purely domestic transactions. For a registered representative, understanding these dynamics is necessary because fluctuating currency values and trade imbalances directly impact the performance of various investment vehicles and the health of multinational corporations. The exchange rate is the price of one country's currency expressed in terms of another country's currency. These rates are determined in the foreign exchange market, which is a global, decentralized market where participants buy and sell different currencies. When a currency increases in value relative to another, we say it has strengthened or appreciated, while a decrease in value is referred to as weakening or depreciating. A strong domestic currency makes foreign goods cheaper for local consumers, which tends to increase imports. Conversely, a strong currency makes domestic exports more expensive for foreign buyers, which can reduce the competitiveness of local businesses abroad. The balance of trade is the largest component of a country's balance of payments and measures the difference between the value of a nation's exports and its imports. When a country exports more than it imports, it experiences a trade surplus, which is often viewed as a favorable balance of trade. In contrast, when imports exceed exports, the country has a trade deficit or an unfavorable balance of trade. It is important to realize that trade balances and currency values are fundamentally linked through a feedback loop. As a country's currency weakens, its goods become cheaper for foreigners, which typically leads to an increase in exports and a movement toward a trade surplus. A trade deficit generally puts downward pressure on the value of the domestic currency because there is a higher demand for foreign currency to pay for those imports. This increased supply of the domestic currency on the global market leads to depreciation. On the other hand, a trade surplus increases the demand for the domestic currency as foreign buyers must acquire it to pay for the exported goods. This increased demand leads to an appreciation of the domestic currency. Investors watch these trends closely because a persistent trade deficit can lead to higher interest rates as the country tries to attract foreign capital to offset the deficit. Intervention by central banks also plays a role in international economics, as they may attempt to influence their currency's value to achieve specific economic goals. By buying or selling their own currency in the foreign exchange market, a central bank can manage its exchange rate to help boost exports or control inflation. For example, if a country wants to encourage its manufacturing sector, it might prefer a weaker currency to make its products more attractive globally. However, a weaker currency can also lead to imported inflation, as the cost of foreign raw materials and finished goods rises for domestic consumers and businesses. When analyzing the impact of international economics on the securities markets, the relationship between interest rates and exchange rates is a critical factor. Generally, higher domestic interest rates attract foreign investment because they offer a better return on debt instruments like bonds. As foreign investors buy the domestic currency to purchase these bonds, the currency tends to appreciate. This demonstrates how monetary policy, which we discussed previously, has international consequences. A firm understanding of these mechanics provides the context needed to evaluate how global shifts might affect the domestic economy and the specific securities you will encounter on the exam. See you in the next lesson. Hello, and welcome back. It is time to solidify your knowledge of macroeconomics with a short quiz. A country is experiencing a period of 2 consecutive quarters of declining gross domestic product, accompanied by rising unemployment and decreasing consumer spending. To combat this, the central bank decides to lower the discount rate and purchase government securities in the open market. Which of the following best describes the current economic phase and the specific policy being implemented? A. Prosperity and fiscal policy. B. Depression and supply-side policy. C. Recession and monetary policy. D. Recovery and regulatory policy. Please pause the video now to consider your answer before we proceed to the explanation. The correct answer is C. Recession and monetary policy. A recession is technically defined as 2 or more consecutive quarters of negative economic growth, which manifests as a decline in a nation's gross domestic product. During this phase of the business cycle, we typically observe a contraction in manufacturing, higher unemployment rates, and a general reduction in consumer demand. This is distinct from a depression, which is a much more severe and prolonged downturn, usually lasting years rather than months. Prosperity or expansion is the opposite phase, characterized by growth, while recovery or troughs represent the turning point where the economy begins to move upward again after a period of decline. Understanding these 4 phases is essential for any financial professional because they dictate the risk appetite of investors and the performance of various asset classes. The second half of the question addresses the actions taken by the central bank, such as the Federal Reserve. Monetary policy involves the management of the money supply and interest rates to influence the economy, whereas fiscal policy involves government spending and taxation. In this scenario, lowering the discount rate, the rate charged to banks for short-term loans, and engaging in open market operations by purchasing Treasury securities are classic examples of an easy or expansionary monetary policy. By buying securities, the central bank injects liquidity into the banking system, which lowers interest rates and encourages borrowing and spending. Fiscal policy, by contrast, would involve legislative action, such as passing a bill to lower income taxes or increasing federal spending on infrastructure projects. We should also consider how these factors interact with inflation and international economics. If the central bank is too aggressive with expansionary monetary policy, it risks causing inflation, which is a general increase in prices and a corresponding decrease in the purchasing power of the currency. This can lead to currency depreciation, where the local currency becomes weaker compared to foreign currencies, potentially making exports more competitive but imports more expensive. Conversely, deflation is a period of falling prices, often associated with severe recessions or depressions where consumers hoard cash in anticipation of even lower prices later. Mastery of these dynamics ensures you can identify how government and central bank interventions attempt to stabilize the business cycle and manage the value of money on a global scale. I will see you in the next lecture. Hello, and welcome back to our look into the regulatory framework that governs our industry. The Securities Act of 1933 is the foundational piece of legislation for the primary market, often referred to as the Paper Act. Its main objective is not to protect investors from bad investments, but to ensure they have access to enough information to make an informed decision. It requires that any new issue of securities must be registered with the SEC unless an exemption applies. This registration process is designed to provide full and fair disclosure of all material facts about the security and the issuer. By mandating transparency, the Act attempts to prevent fraud and misrepresentation in the initial sale of securities. You should think of this as the gatekeeper for every new financial product entering the public domain. The Act establishes a clear line of responsibility for the accuracy of the information provided to the public. If an issuer wants to raise capital by selling stocks or bonds to the public, they must file a registration statement. This document contains comprehensive details regarding the company's business, its financial health, and the specific risks associated with the investment. The SEC reviews this statement during a mandatory cooling-off period to ensure it meets disclosure requirements. It is important to note that the SEC neither approves nor disapproves of the investment's quality. They merely verify that the paperwork appears complete and that no obvious omissions of material facts exist. A central component of the Securities Act is the prospectus, which is a legal document extracted from the registration statement. The law mandates that a final prospectus must be delivered to every purchaser of the new issue no later than the confirmation of the sale. This ensures the investor has written evidence of the claims made by the issuer before they are legally bound to the transaction. The prospectus includes the offering price, the selling discounts, and the intended use of the proceeds. Without this document, a public offering cannot legally proceed in the primary market. You will find that nearly all regulations regarding new offerings stem from these original requirements for disclosure. Beyond the registration requirements, the Securities Act of 1933 also contains anti-fraud provisions that apply even to securities that are exempt from registration. While certain instruments like municipal bonds or government treasuries do not need to file with the SEC, the individuals selling them are still prohibited from using deceitful tactics. This means that full and fair disclosure is a universal expectation across the entire primary market. The Act also defines who can be held liable for inaccuracies in the registration statement, including the issuer, underwriters, and even the accountants who audited the financials. This creates a high level of accountability for all parties involved in bringing a security to market. In the context of the SIE exam, understanding the Securities Act of 1933 is about recognizing its role in primary distribution. It is distinct from the Securities Exchange Act of 1934, which focuses on the secondary market and the people who work in it. When you think of the 1933 Act, you should immediately associate it with new issues, registration statements, and prospectuses. The burden of proof for the safety of an investment is not on the government, but the burden of disclosure is strictly on the issuer. This framework has remained the standard for how capital is raised in the United States for nearly a century. I'll see you in the next lesson. Welcome back. We are now going to examine the mechanics of how a security actually moves from an idea to a public offering. The registration process for a new security is governed primarily by the Securities Act of 1933, which dictates a specific timeline that every issuer must follow. This process is divided into three distinct phases: the pre-registration period, the cooling-off period, and the post-effective period. Understanding the boundaries between these phases is critical because the law strictly limits what an issuer or underwriter can say or do during each one. The transition between these stages is marked by two major events: the filing of the registration statement and the effective date declared by the SEC. We will look at each of these phases to understand how they ensure that investors receive full and fair disclosure before committing their capital. The pre-registration period, often referred to as the quiet period, begins when an issuer decides to raise capital and hires an investment banker to act as an underwriter. During this phase, the underwriter helps the issuer prepare the registration statement, which is a comprehensive document detailing the company's business, financial health, and the intended use of the proceeds. It is vital to understand that during this time, no public communication regarding the upcoming offering is permitted. Any attempt to prime the pump or solicit interest from the public is considered gun jumping and can result in severe regulatory delays. The phase ends explicitly when the issuer files the registration statement with the SEC, which officially moves the process into the next stage. Once the registration statement is filed, the cooling-off period begins, typically lasting for a minimum of 20 days. During this time, the SEC reviews the filing for completeness and accuracy, though it is important to remember that the SEC does not approve of the investment's merits. They only ensure that the disclosure is adequate. While the issuer cannot sell the securities yet, the underwriter is allowed to perform certain activities to gauge market interest. They may distribute a preliminary prospectus, often called a red herring, because of the bold red disclaimer on its cover stating that the registration is not yet effective. This document contains most of the essential facts about the offering, but excludes the final offering price and the effective date. In addition to distributing the red herring, underwriters may use the cooling-off period to collect indications of interest from potential investors. An indication of interest is a non-binding statement from a customer suggesting they might want to buy the shares once the offering goes live. It is not an order, and the underwriter cannot accept any money or deposits during this time. The underwriters may also publish tombstone advertisements, which are very limited announcements providing basic facts like the issuer's name, the type of security, and the contact information for obtaining a prospectus. No other promotional materials or suggestive sales literature are allowed during this 20-day window to prevent the distribution of unverified information. The cooling-off period ends on the effective date, which is the point at which the SEC determines the registration statement is sufficiently transparent for the public. This marks the beginning of the post-effective period, where the actual sale of securities can finally take place. All investors who purchase shares in the primary market must be provided with a copy of the final prospectus no later than the completion of the transaction. This final document includes the official offering price, the underwriter's discount, and any other information that was missing from the preliminary version. It is only at this stage that indications of interest can be converted into actual orders and money can be accepted from the public. While the registration is now effective, certain restrictions on communication still apply to ensure that the final prospectus remains the primary source of information. Any supplemental sales literature used during the post-effective period must be preceded or accompanied by the final prospectus to ensure the investor has the full context of the risks involved. The underwriter's role shifts from gathering interest to executing trades and stabilizing the market price if necessary, although stabilization is a complex legal topic we will touch on elsewhere. The sequence of pre-registration, cooling off, and post-effective periods creates a structured environment that balances the issuer's need for capital with the investor's right to informed decision-making. By following this rigid timeline, the industry maintains a level of transparency that is fundamental to the integrity of the capital markets. I look forward to seeing you in the next lesson. Hello and welcome back. While the Securities Act of 1933 mandates that most securities must be registered with the SEC before being offered to the public, the law provides specific carve-outs for transactions that do not require full registration. These are known as exempt offerings, and they are essential for businesses that need to raise capital without the significant expense and time delay associated with a full public filing. You should interpret these exemptions not as a way to circumvent investor protection, but as a streamlined framework for specific types of private or limited transactions. The most common exemptions you will encounter are defined under Regulation D, Rule 144, and Regulation A. Each of these has distinct boundaries regarding who can buy the securities, how much money can be raised, and how the securities can be resold in the future. Regulation D is the most frequent path for private placements, allowing a company to sell securities to a targeted group of investors. Under this regulation, the distinction between accredited and non-accredited investors is paramount. An accredited investor is typically defined as an individual with a net worth of at least $1 million, excluding their primary residence, or an annual income exceeding $200,000 for the last 2 years. Institutional investors, such as banks and insurance companies, also fall into this category. While Rule 506(b) allows for an unlimited number of accredited investors and up to 35 non-accredited investors, the company cannot use general solicitation or advertising to find them. If a company chooses to use general solicitation under Rule 506(c), all purchasers must be accredited investors, and the issuer must take reasonable steps to verify that status. Securities acquired through these private placements are considered restricted securities because they have not been registered with the SEC. To sell these securities in the secondary market, investors must typically comply with Rule 144, which governs the resale of restricted and controlled securities. Restricted stock must usually be held for a minimum of 6 months if the issuing company is a reporting company, or 1 year if it is not. Control securities are those held by an affiliate of the issuer, such as an officer, director, or a shareholder owning more than 10% of the voting stock. Even if the stock was purchased in the open market, these insiders are subject to volume limitations and filing requirements when they decide to sell. Rule 144 effectively ensures that large insiders cannot dump massive quantities of stock onto the public market without notice. Regulation A, often referred to as a mini IPO, provides another middle ground between a private placement and a full S-1 registration. It allows smaller companies to raise capital from the general public, including non-accredited investors, while providing a less rigorous disclosure document called an offering circular. Regulation A is divided into 2 tiers. Tier 1 allows for offerings up to $20 million in a 12-month period, while Tier 2 allows for offerings up to $75 million. Tier 2 offerings come with more stringent requirements, such as audited financial statements and ongoing reporting obligations, but they also exempt the issuer from certain state-level blue sky registration requirements. This framework democratizes access to early-stage investments while maintaining a level of regulatory oversight appropriate for the scale of the offering. Finally, it is worth noting Rule 147, which applies to intrastate offerings. This exemption is available to issuers that do a significant amount of their business within a single state and sell securities only to residents of that state. To qualify, the issuer must meet at least one of several 80% tests, such as deriving 80% of its gross revenues from that state or having 80% of its assets located there. Investors who purchase these securities must wait 6 months before they can sell them to someone residing outside of that state. This rule demonstrates the principle that when an offering is purely local in nature, federal registration may be unnecessary, leaving oversight to the specific state's regulatory body. I hope this provides a clear understanding of how capital can be raised outside the traditional registration process. See you in the next lecture. Hello, and welcome back to the course. When a corporation or sovereign entity decides to raise capital by issuing securities, they must choose a specific structure for that offering. This process is essentially how financial assets transition from the issuer into the hands of investors. You should think of these offerings as the initial mechanisms of the primary market, where the proceeds of the sale go directly to the issuer rather than to other investors. Understanding the different classifications of these offerings is not just a matter of terminology. It is about identifying who receives the capital and whether the entity has previously accessed public markets. Most of the complexity in this area arises from the distinction between new shares being created and existing shares being liquidated by current owners. An initial public offering, or IPO, represents the first time a company sells its equity to the general public. Before this event, the company is considered private, often owned by founders, venture capitalists, or private equity firms. The transition to a public entity involves a rigorous registration process and usually a significant change in regulatory oversight. In an IPO, the issuer creates entirely new shares to sell, and the cash raised is used to fund business operations, research and development, or to pay down existing debt. Because the company has no prior trading history on a public exchange, these offerings carry a unique risk profile and are subject to specific rules regarding how they are marketed and sold to the public. Once a company is already public, it may find that it needs additional capital at a later date. This leads us to the concept of a follow-on offering, which is sometimes referred to as an additional public offering. In this scenario, the company is already listed on an exchange like the NYSE or NASDAQ and is already subject to the reporting requirements of the SEC. The firm issues more shares to the public to raise further capital for expansion or projects. Because there is already a secondary market price for the internal shares, the pricing of a follow-on offering is typically more straightforward than that of an IPO. The proceeds from these newly minted shares still flow to the issuer, making this another example of a primary market transaction. We must also distinguish between primary offerings and secondary offerings, as the two terms are frequently confused in common parlance. A primary offering is any sale where the issuer is the one creating the securities and receiving the proceeds, which includes both IPOs and follow-on offerings. Conversely, a secondary offering involves the sale of shares that are already outstanding and held by existing shareholders, such as a founder or a large institutional investor. In a pure secondary offering, the corporation itself does not receive any new capital because the money is simply moving from the buyer to the seller. You might see a combined or split offering where a company issues new shares while existing shareholders simultaneously sell some of theirs. Finally, it is useful to consider the distinction between public and private offerings. Public offerings are registered with the SEC and can be sold to the general investing public, including retail investors. Private placements, on the other hand, are generally exempt from registration and are offered to a restricted group of sophisticated or accredited investors. These private offerings lack the liquidity provided by public exchanges, but allow issuers to raise funds more quickly and with lower administrative costs. While this lesson focuses on the broad types of public offerings, keep in mind that the fundamental question is always whether the capital is being used to grow the issuer's balance sheet or simply to provide liquidity for an existing owner. I look forward to seeing you in the next lesson. Hello, glad to have you back. When a corporation or municipality decides to raise capital by issuing securities, it rarely attempts to sell those securities directly to the public. Instead, it engages the services of an investment bank, acting as an underwriter to facilitate the distribution. The nature of the relationship between the issuer and the underwriter is defined by the underwriting commitment, which outlines who carries the financial risk if the securities do not sell. You can think of this as a contract that determines whether the investment bank is acting as a principal, taking ownership of the assets, or merely as an agent, facilitating a transaction on behalf of another party. Understanding this distinction is vital because it dictates the incentives and potential liabilities of all participants in the primary market. A firm commitment underwriting is the most common arrangement for large, established issuers. In this scenario, the underwriter or the underwriting syndicate agrees to purchase the entire issue from the issuer at a set price. Once the purchase is complete, the underwriter owns the securities and bears the full financial responsibility for reselling them to the public at the public offering price. If the underwriter is unable to sell all the shares or bonds, they're stuck with the remaining inventory and must potentially sell it at a loss or hold it on their balance sheet. Because the underwriter is acting as a principal and taking on significant risk, they usually receive a higher spread as compensation for their service. Conversely, a best efforts underwriting shifts the financial risk away from the underwriter and back onto the issuer. In this arrangement, the underwriter agrees to make their best attempt to sell the securities to the public, but they do not purchase the securities themselves. The underwriter acts strictly as an agent, earning a commission on every share sold, but assuming no obligation to buy any unsold shares. If the market demand is lower than expected and only half of the offering is sold, the issuer simply receives the proceeds from that half, and the remaining shares remain unissued. This model is often used by smaller companies or for riskier offerings where an investment bank is unwilling to put its own capital at risk. Within the category of best efforts underwriting, there are specific variations designed to meet different capital requirements, such as the all-or-none commitment. In an all-or-none offering, the entire issue must be sold to the public, or the entire deal is canceled and all investor funds are returned. This is common when an issuer requires a specific, minimum amount of capital to complete a project. If they cannot raise the full amount, the project cannot proceed, making a partial raise useless. During the selling period, investor funds are typically held in an escrow account to ensure they are protected until the contingency is met. If the underwriter fails to sell every single share by a predetermined deadline, the transaction is voided. Another variation of the best effort structure is the mini-maxi commitment, which establishes both a floor and a ceiling for the offering. The underwriter must sell a minimum amount specified in the agreement for the offering to become effective and for the funds to be released to the issuer. Once that minimum threshold is crossed, the underwriter can continue selling shares up to a maximum limit defined in the prospectus. If the minimum is not reached, the offering is canceled, much like the all-or-none scenario. This provides a balance of flexibility for the issuer while still ensuring that enough capital is raised to justify the costs of the offering and the subsequent operations of the business. To summarize, the core difference between these commitments lies in the location of the risk and the capacity in which the broker-dealer operates. In a firm commitment, the underwriter is a principal, they buy the securities, and they risk their own money. In a best efforts arrangement, the underwriter is an agent. They find buyers for the issuer and the issuer bears the risk of an unsuccessful offering. As you evaluate different scenarios for the exam, always look for who is left holding the securities if the public refuses to buy them. If it is the underwriter, you are looking at a firm commitment. If it is the issuer, you are looking at some form of best efforts. I look forward to discussing the next topic with you. Hi there. Let's see how well you have internalized the mechanics of bringing new securities to market. It is time to solidify our knowledge with a short quiz regarding the registration and underwriting process. During the cooling-off period of a new securities registration, which of the following activities is permitted for a registered representative? A. Accepting a check from a customer to reserve shares of the new issue. B. Sending a preliminary prospectus to a potential investor who expressed interest. C. Highlighting key sections of the preliminary prospectus to help a client understand the risks. D. Confirming a sale of the security to a long-term institutional client. Please pause the video now to consider your choice before we move on to the rationale. The correct answer is B. Sending a preliminary prospectus to a potential investor who expressed interest. The Securities Act of 1933 is quite rigid about what can and cannot happen while the SEC is reviewing a registration statement. During this cooling-off period, which typically lasts at least 20 days, the issuer and its underwriters are in a state of limbo where they can stimulate interest but cannot close a deal. Sending a preliminary prospectus, often called a red herring, is a core part of this phase because it provides disclosure without being an official offer to sell. It contains most of the essential facts about the business and the offering, though it conspicuously lacks the final offering price and the effective date. This document allows prospective investors to perform due diligence while the regulatory review is still ongoing. The other options presented involve activities that violate the gun-jumping rules or the requirement for a final prospectus. For instance, accepting money or confirming a sale, as suggested in options A and D, is strictly prohibited because no sale can be legally finalized until the registration becomes effective. Even if a client is enthusiastic, the representative can only take an indication of interest, which is non-binding for both parties. Option C is also a violation because a prospectus must be delivered in its original, clean form. Marking or highlighting a prospectus is considered an unauthorized alteration of a legal disclosure document and can mislead the investor by drawing disproportionate attention to specific sections while ignoring others. Underwriting commitments also play a significant role in how these offerings are structured and executed. In a firm commitment underwriting, the investment bank acts as a principal, buying the entire issue from the issuer and taking on the financial risk of unsold shares. This contrasts sharply with a best efforts underwriting, where the bank acts as an agent and is not liable if the securities do not sell. There are also specialized versions like the all-or-none or mini-maxi commitments, which are types of best efforts underwritings that require a certain threshold of capital to be raised for the offering to proceed. Understanding who carries the inventory risk is essential for interpreting the motivations of the parties involved in a primary market transaction. I hope this helped clarify the boundaries of the offering process. See you in the next lecture. Hello, and welcome back to our discussion on equity securities. Common stock represents the most basic form of corporate ownership and serves as the primary building block for many investment portfolios. When an investor purchases common stock, they are acquiring an equity interest in a corporation, which entitles them to a proportionate share of the company's success or failure. This ownership is perpetual in nature, meaning the security does not have a maturity date like a bond. The capitalization of a corporation is often anchored by this common equity, as it provides the foundational capital required for operations. For the SIE exam, you must understand that common stockholders are the last in line to be paid in the event of a corporate liquidation. This residual claim on assets is why common stock is considered the most junior security in a company's capital structure. One of the defining features of common stock ownership is the right to vote on key corporate matters. Shareholders do not manage the day-to-day operations of the company. Instead, they elect a board of directors to oversee the management team. Voting typically occurs at the annual shareholder meeting or through a proxy statement if the investor cannot attend in person. There are two primary methods of voting that you should recognize: statutory and cumulative. In statutory voting, a shareholder can cast one vote per share for each directorship seat being filled, which tends to benefit larger shareholders. Cumulative voting allows shareholders to multiply their total shares by the number of seats and distribute those votes however they wish, which provides minority shareholders a better chance at representation. While the board of directors decides if and when to pay dividends, common stockholders have a right to receive their portion of those distributions. Dividends are usually paid in the form of cash, but companies may also issue additional shares of stock instead. It is important to remember that common stockholders only receive dividends after the company's obligations to creditors and preferred stockholders have been satisfied. Because common stock dividends are not guaranteed, the board has the ultimate discretion over whether the company will retain earnings for future growth or distribute them to owners. The potential for dividend growth, alongside capital appreciation, is one of the primary reasons investors are willing to accept the higher risks associated with equity ownership. A fundamental concept that protects individual investors is the principle of limited liability. This means that as an owner of common stock, your financial risk is strictly limited to the amount of money you have invested in the security. If a corporation becomes insolvent or faces legal judgments that exceed its total assets, the personal assets of the shareholders are protected from the company's creditors. You cannot lose more than your initial investment, regardless of how much debt the corporation has accumulated. This stands in stark contrast to a general partnership, where partners can be held personally responsible for all business debts. Limited liability is a critical feature that makes the public equity markets accessible and attractive to institutional and retail investors alike. In addition to voting and dividends, common stockholders possess several other secondary rights that ensure fair treatment. One such right is the inspection of books and records, which allows shareholders to review lists of stockholders and the company's bylaws. Furthermore, common stock is generally freely transferable, meaning owners can sell their shares in the secondary market without needing permission from the issuer. Investors also have the right to maintain their proportionate ownership in the company through what is known as a preemptive right. If the corporation decides to issue new shares, existing shareholders are often given the first opportunity to buy those shares before they are offered to the general public. This prevents the dilution of their voting power and economic interest in the firm. Understanding the relationship between risk and reward is essential when analyzing common stock. While it offers the highest potential for long-term capital appreciation, it also carries the highest level of market risk among traditional securities. If a company performs poorly, the stock price may decline significantly, and the board may choose to suspend dividend payments entirely. Despite these risks, the historical performance of common stocks has often outpaced inflation, making them a core component of growth-oriented investment strategies. As you progress through this course, keep in mind that the features of common stock serve as the benchmark against which all other equity and debt instruments are measured. Mastering these fundamentals is necessary for navigating the more complex securities we will discuss in later modules. I look forward to seeing you in our next session on preferred stock. Hello, and welcome back. When we discuss equity, we often default to thinking about common stock, but that is only one part of the ownership equation. Preferred stock occupies a unique middle ground in a company's capital structure, acting as a hybrid between debt and equity. While it represents an ownership stake in the corporation, its behavior often mimics that of a bond because its primary value proposition is a fixed income stream. Investors who purchase preferred stock are generally less interested in the long-term capital appreciation of the company and more focused on the reliability of the dividend payments. Because of this fixed income characteristic, preferred stock prices are sensitive to interest rate changes in much the same way as bonds. The most defining feature of preferred stock is its fixed dividend, which is typically expressed as a percentage of the stock's par value. For the purposes of the SIE exam, you should assume a par value of $100 unless the problem specifically states otherwise. If a company issues a 5% preferred stock, the investor can expect to receive $5 in dividends annually for each share they own. Unlike common stock dividends, which fluctuate based on board decisions and company profitability, preferred dividends are established at the time of issuance and remain constant. This provides a level of predictability that is attractive to income-oriented investors, such as retirees or institutional portfolios requiring steady cash flows. It is important to understand that while these dividends are described as fixed, they are not guaranteed in the same way that interest on a bond is guaranteed. A corporation's board of directors must still formally declare a dividend before it can be paid out to shareholders. If a company experiences a difficult year and lacks the cash to cover its obligations, the board can choose to skip the preferred dividend without being forced into default. However, preferred shareholders possess a specific contractual advantage over common shareholders regarding these distributions. A corporation is strictly prohibited from paying any dividends to common stockholders until all required dividends have been paid to the preferred stockholders. Beyond the priority of dividend payments, preferred stock also offers a higher claim on company assets in the event of corporate liquidation. If a company goes bankrupt or is dissolved, there is a specific order in which creditors and owners are paid from the remaining assets. At the top of the list are the secured and unsecured creditors, followed by the holders of subordinated debt. Preferred stockholders sit just below the bondholders, but significantly above the common stockholders in this hierarchy. This means that if there is limited capital remaining after debts are settled, the preferred shareholders receive their full par value before the common shareholders receive a single penny. The trade-off for this increased security and steady income is that preferred stockholders generally do not have voting rights. In a typical corporate structure, common shareholders use their votes to elect the board of directors and influence major corporate policy decisions. Preferred shareholders are essentially silent partners who have exchanged their right to participate in corporate governance for the stability of a fixed dividend and liquidation preference. Furthermore, preferred stock does not typically offer the same potential for capital gains as common stock. If a company's profits triple, the common stock price might skyrocket, but the preferred stock will likely remain close to its par value because the dividend remains fixed. When you analyze preferred stock, you should see it as a tool for managing risk while still participating in the equity market. It provides a cushion against the volatility of the common markets, though it remains subordinate to the company's debt obligations. Understanding this graduation of risk and reward is fundamental to conceptualizing how a corporation scales its financing. The preference in liquidation and the priority of dividends are the two pillars that support the entire concept of this security class. As you continue your studies, keep these priorities in mind, as they form the basis for more complex variations of preferred securities you will encounter later. See you in the next lecture. Welcome back. When we discuss preferred stock, we're looking at a security that occupies a middle ground between equity and debt. While all preferred shares generally provide a fixed dividend, the specific rights attached to those shares can vary significantly depending on the underlying contract. It is a mistake to view preferred stock as a monolithic asset class. Instead, we should view it as a collection of modular features that issuers can combine to meet specific financing needs. The primary variations we encounter in the market are cumulative, participating, callable, and convertible features. Each of these features modifies the risk profile and the potential return for the investor in a distinct way. Understanding these nuances is essential because the SIE exam expects you to distinguish how these features behave under different market conditions. Cumulative preferred stock is designed to protect the investor's right to receive dividends even if the issuing corporation encounters financial difficulty. In a standard non-cumulative arrangement, if a company skips a dividend payment, that payment is lost forever to the shareholder. Cumulative shares change this logic by requiring that any omitted dividends accumulate as an obligation on the company's balance sheet. Before the company is permitted to pay any dividends to common stockholders, it must first satisfy all of these dividends in arrears to the cumulative preferred holders. This feature reduces the risk of income interruption, though it does not guarantee payment if the company lacks the funds entirely. From a valuation perspective, cumulative shares are often more attractive to conservative investors who prioritize consistent income streams over capital appreciation. Participating preferred stock offers a unique mechanism for investors to share in the exceptional success of a corporation beyond the stated fixed dividend. Most preferred stocks are limited to their fixed rate, meaning that even if the company earns record profits, the preferred holder's return remains static. Participating shares include a provision that allows the holder to receive additional dividends if the dividends paid to common stockholders exceed a specified level. This effectively allows the preferred shareholder to participate in the upside, typically reserved for common equity holders. While these shares still provide the safety of a fixed dividend preference, the participating feature acts as a secondary layer of potential profit. Issuers might use this feature when they need to attract capital, but want to keep the initial fixed dividend rate lower than it would otherwise be. Callable preferred stock introduces a specific type of reinvestment risk for the investor while providing flexibility for the issuer. The call feature gives the corporation the right to repurchase the shares from the investor at a predetermined price, usually at par value or slightly above it, after a certain date. A company is most likely to exercise this right when prevailing interest rates in the market drop. In such a scenario, the company can call in the existing preferred stock, which carries a high dividend rate, and issue new shares at a lower rate to save on financing costs. For the holder, this means their high-yielding investment might be taken away exactly when it is most valuable. To compensate for this risk, callable preferred stock normally offers a higher stated dividend rate than non-callable shares issued by the same entity. Convertible preferred stock provides a bridge between the fixed income nature of preferred shares and the growth potential of common stock. This feature allows the shareholder to swap their preferred shares for a fixed number of common shares at their discretion. The conversion ratio is established at the time of issuance and remains constant, though it may be adjusted for stock splits. Investors choose convertible shares when they want the safety of a preferred dividend, but wish to maintain the option to benefit from a significant rise in the company's common stock price. Because of this embedded option to convert into common equity, these shares usually carry a lower dividend rate than non-convertible preferred stock. The price of convertible preferred stock tends to be more volatile because it tracks the price movements of the underlying common stock quite closely. Adjustable rate preferred stock is another variant where the dividend is not fixed for the life of the security, but rather tied to a benchmark like Treasury bill rates. As market interest rates fluctuate, the dividend paid on these shares is reset periodically to reflect current economic conditions. This mechanism helps the share price remain relatively stable, near its par value, because the yield adjusts to match the market rather than the price adjusting to match a fixed yield. While this protects the investor's principal from interest rate risk, it also means the income generated by the investment is unpredictable. This type of security is often held by corporate investors seeking to manage their cash positions while taking advantage of certain tax exclusions available for corporate dividend income. Understanding these various types is a matter of identifying which party, the issuer or the investor, holds a specific right or protection granted by the feature. See you in the next lesson. Welcome back. We are continuing our examination of equity securities by looking at two specific instruments that give investors the right to purchase stock at a predetermined price. Rights, often formally called preemptive rights, are instruments issued to existing shareholders to prevent their ownership interest from being diluted when a company decides to issue additional shares. When a corporation issues new common stock, the articles of incorporation often require that current shareholders be given the first opportunity to maintain their proportionate share of the company. These rights are typically issued for a very short duration, usually lasting only 30 to 45 days, making them short-term instruments. Each existing share of stock usually receives one right, and the terms of the offering will specify how many rights are required to purchase one new share. A defining characteristic of rights is that the exercise price, or the subscription price, is set below the current market value of the stock. This discount provides an immediate incentive for shareholders to participate, though they also have the option to sell the rights in the secondary market if they do not wish to increase their position. The mechanics of a rights offering ensure that a shareholder who owns 10% of a company can purchase 10% of the new issuance, thus remaining a 10% owner after the transaction is complete. If the shareholder chooses not to exercise the rights, they can sell them to another investor because rights have intrinsic value due to the discounted subscription price. During the period they are active, the stock may trade cum rights, meaning the rights are bundled with the stock, or X rights, where the stock and the rights trade separately. Investors should understand that if they do nothing, their rights will eventually expire worthless, and their overall percentage of ownership in the firm will decrease. Because the expiration is so near, rights are not considered long-term investment vehicles, but rather a procedural necessity of corporate finance. You should view them as a mechanism for protecting shareholder equity rather than a speculative tool for long-term growth. Warrants represent a different approach to the same underlying concept of purchasing shares at a fixed price, but they operate on a much longer time horizon. Unlike rights, which expire in weeks, warrants are typically issued with expiration dates 5 to 10 years in the future, and some may even be perpetual. At the time of issuance, the exercise price of a warrant is set significantly higher than the current market price of the underlying stock. This means that a warrant has no intrinsic value when it is first created. It only has speculative value based on the hope that the stock price will rise above the exercise price before the warrant expires. Companies often use warrants as sweeteners when they are issuing other securities, such as bonds or preferred stock, to make the offering more attractive to investors. By attaching a warrant, the issuer might be able to offer a lower interest rate on a bond because the investor gains the potential for equity upside. While rights are generally issued to maintain ownership proportions, warrants are frequently traded as independent securities after they have been detached from the original host security. If an investor holds a warrant and the market price of a stock eventually exceeds the exercise price, the warrant becomes in the money and gains intrinsic value. An investor can then choose to exercise the warrant to purchase the stock at the lower fixed price or sell the warrant for a profit in the secondary market. It is important to distinguish that while rights are a legal requirement in many jurisdictions to protect against dilution, warrants are purely contractual and are used as a capital-raising tool. Neither rights nor warrants provide the holder with dividends or voting power while they are held. These benefits only accrue if the holder exercises the instrument and becomes a common shareholder. You should carefully distinguish between the short-term, discounted nature of rights and the long-term, premium price nature of warrants. When comparing these two instruments for the exam, remember that rights are about the present and the preservation of current standing, while warrants are about the future and potential appreciation. Rights are issued to current shareholders to avoid dilution at a price below the market, whereas warrants are issued to anyone as an incentive at a price above the market. Time is the most reliable variable to watch. If you see a time frame measured in weeks, it is almost certainly a right. If it is measured in years, it is a warrant. By understanding these structural differences, you can accurately categorize how a corporation manages its equity base and how investors might leverage these tools for different outcomes. Ensure you can identify which instrument is in the money at issuance and which requires the market price to rise to become valuable. I will see you in the next lecture. Welcome back. When we discuss equity securities, we often focus on domestic corporations listed on local exchanges, but investors frequently seek exposure to foreign companies. An American depositary receipt, or ADR, serves as a bridge that allows a domestic investor to purchase shares of a foreign corporation without dealing with the complexities of foreign currency exchange or overseas settlement systems. Technically, an ADR is a negotiable security that represents a specific number of shares in a foreign corporation that is traded in the United States. These instruments are issued by domestic financial institutions, typically large commercial banks, which act as the depositary. The bank purchases the foreign shares and holds them in custody at a branch or a correspondent bank in the issuer's home country. The mechanics of ADRs are designed to make the investment feel as much like a domestic stock purchase as possible. While the underlying shares are those of a foreign company, the ADR itself is priced in US dollars and dividends are paid in US dollars. This is a significant convenience for the investor because the depositary bank handles the actual currency conversion. When the foreign company declares a dividend in its local currency, the depositary bank collects that payment, converts it into US dollars, and distributes it to the ADR holders. Because the bank performs this service, it may deduct a small fee from the dividend payment to cover the costs of conversion and administration. It is crucial to understand that while the dividends are paid in dollars, the investor is still subject to currency risk. If the value of the foreign currency declines relative to the US dollar, the amount of the dividend, when converted, will be smaller. Similarly, the market price of the ADR is influenced not just by the company's performance, but also by the exchange rate between the dollar and the local currency. An investor might see the underlying stock price rise on its home exchange in Tokyo or London, but if the local currency weakens significantly against the dollar, the ADR price in the US might remain flat or even decrease. This is a fundamental risk factor that candidates must distinguish from standard market risk. From a legal and regulatory standpoint, ADRs are registered with the SEC and trade on the NYSE, NASDAQ, or the over-the-counter market. This means they provide a level of liquidity and transparency that might not be available if an investor tried to buy the shares directly on a foreign exchange. ADR holders generally have many of the same rights as common stockholders, but there is a notable exception regarding voting. While the underlying shares often carry voting rights, the ADR holder typically does not vote directly. Instead, the depositary bank usually retains the right to vote the shares, although in some cases, it may pass through the voting materials to the ADR holders so they can provide instructions on how the bank should vote. Taxation is another area where ADRs present a unique profile for the domestic investor. The foreign government where the issuer is based may withhold taxes on dividend payments made to the depositary bank. This withholding tax is generally credited against the investor's U.S. income tax liability, assuming the investor files the appropriate documentation. It is important to remember that while the foreign government might take a portion of the dividend at the source, the U.S. investor is still responsible for reporting the full amount of the dividend income to the IRS. This interaction between two different tax jurisdictions is one of the more technical aspects of owning exposure to foreign equities through these instruments. We should also distinguish between sponsored and unsponsored ADRs, as the level of involvement by the foreign issuer varies. In a sponsored ADR, the foreign company works directly with a single U.S. depositary bank to list its shares and pays the associated costs. These are typically the ADRs that trade on major exchanges and provide regular financial reports in English. Unsponsored ADRs are created by banks without the active participation of the foreign company and often trade over the counter. Because the issuer is not involved, these unsponsored versions may not provide the same level of reporting transparency. For the purposes of the SIE, focusing on the roles of the depository bank and the investor's exposure to currency and political risk is the most productive path. Good luck with your continued studies. Welcome back. It is time to solidify our knowledge of equity instruments with a short quiz. An investor owns 1,000 shares of a company's common stock. The company announces a rights offering that allows existing shareholders to purchase one new share for every 5 shares owned at a discount. If the investor exercises all of their preemptive rights, how many additional shares will they acquire? A. 1,000 shares. B. 500 shares. C. 200 shares. D. 100 shares. Please pause the video now to consider your answer before we proceed to the explanation. The correct answer is C. 200 shares. To arrive at the correct answer, we must apply the definition of preemptive rights within the context of common stock ownership. Preemptive rights are a fundamental feature of common stock that allow existing shareholders to maintain their proportionate ownership in a corporation when the company decides to issue additional shares. In this specific scenario, the ratio provided is one new share for every 5 shares currently held by the investor. Since the investor holds 1,000 shares, we divide that total by the denominative factor of 5, resulting in 200. This calculation represents the number of new shares the investor is entitled to purchase under the terms of the offering. By exercising these rights, the investor ensures that their percentage of the total outstanding shares remains constant, protecting them against equity dilution. The other options provided are mathematically incorrect based on the 5-to-1 ratio specified in the question. Option A suggests a 1-to-1 ratio, which is uncommon in typical rights offerings as it would effectively double the share count. Option B assumes a 2-to-1 ratio, and Option D assumes a 10-to-1 ratio, neither of which aligns with the data provided in the prompt. Understanding these ratios is critical because the SIE exam frequently tests your ability to translate verbal descriptions of rights offerings into basic mathematical outcomes. Beyond the calculation, remember that rights are short-term instruments, usually expiring within 30 to 45 days, and they typically allow for the purchase of stock at a price below the current market value. This discount is what provides the intrinsic value to the right itself, which can be exercised, sold in the secondary market, or allowed to expire. See you in the next lecture. Welcome back. We're moving our focus from equity to debt, starting with how bonds are structured and the core attributes that define them. A bond is essentially a formal contract where an investor lends money to an issuer for a defined period. Unlike equity, where you own a piece of the company, a bond represents an obligation for the issuer to pay back the principal along with interest. We typically refer to the principal amount as the par value or face value of the bond. For the purposes of the SIE exam and most domestic debt markets, you should assume a par value of $1,000 unless the problem specifically states otherwise. This value is the mathematical anchor for most calculations you will perform later. It is the amount that the issuer promises to return to the investor when the bond reaches the end of its term. The interest rate paid on a bond is known as the coupon rate or the nominal yield. This rate is expressed as a fixed percentage of the bond's par value and determines the annual dollar amount of interest the investor receives. For example, a 5% coupon on a bond with a $1,000 par value means the issuer will pay $50 in interest every year. It is important to remember that these payments are usually made semi-annually, meaning that $50 will be split into two $25 payments. Even if the market price of the bond fluctuates after it is issued, the coupon rate remains fixed based on the original par value. This fixed nature is why bonds are often categorized as fixed income securities. Maturity is the specific date on which the issuer must repay the principal amount to the bondholders. At this point, the debt obligation is satisfied and the last interest payment is usually disbursed along with the par value. Bonds are often classified by the length of time remaining until they mature, ranging from short-term to long-term. You will encounter different structures of maturity, such as term bonds and serial bonds. In a term bond structure, every bond in the entire issue matures at the same time. Conversely, a serial bond issue features different portions of the debt maturing at regular intervals over a period of years. The relationship between the coupon rate and the maturity date is a primary driver of how a bond is priced and traded in the secondary market. While the par value is what the investor receives at the end, the market price during the life of the bond can be higher or lower than that $1,000 figure. If a bond trades at more than par, it is trading at a premium. If it trades at less than par, it is at a discount. These price movements occur because the fixed coupon rate may become more or less attractive as general interest rates in the economy change. Investors will pay more for a higher coupon if current market rates are lower, and they will demand a discount if the bond's coupon is lower than what new bonds are offering. When describing bond prices, the industry uses a specific point system where 1 point is equal to $10 or 1% of the par value. If you see a bond quoted at 95, it means the bond is trading at 95% of its par value, which equals $950. If it is quoted at 102, the price is $1,020. Understanding this conversion is necessary for interpreting quotes and calculating gains or losses. The par value remains the constant reference point for these percentages regardless of the bond's duration. This consistency allows different types of debt to be compared using a standardized language of price and yield. The term of the bond also affects its price sensitivity and the risk profile for the investor. Generally, bonds with longer maturities carry more risk because there is a higher probability that interest rates or the issuer's creditworthiness will change over a long period. In exchange for this increased risk, long-term bonds typically offer higher coupon rates than short-term debt from the same issuer. As we progress through this chapter, you will see how these basic characteristics of par, coupon, and maturity interact to determine the total return of the instrument. Maintaining a clear distinction between these fixed contractual terms and the fluid market price is vital for your success. We will build on these concepts in the coming discussions on yield and risk. See you in the next lecture. Welcome back. Understanding the yield of a bond is fundamental to evaluating its performance as a fixed income investment. While the face value of a bond is often set at $1,000, the price an investor pays in the secondary market typically fluctuates. This movement in price creates a distinction between the coupon rate printed on the certificate and the actual return the investor realizes. We must distinguish between 3 primary types of yield to accurately describe a bond's profitability: nominal yield, current yield, and yield to maturity. Each of these metrics provides a different lens through which to view the income generated by the security relative to its cost. Ignoring these differences would lead to a misunderstanding of how interest rate changes affect bond valuation. Nominal yield is the most straightforward of these concepts, as it is simply the coupon rate stated on the bond. If a bond has a 6% nominal yield, it will pay $60 of interest annually for every $1,000 of par value. This figure remains fixed throughout the life of the bond regardless of whether the market price of the bond rises or falls. You can think of the nominal yield as a static attribute of the bond's identity, much like its maturity date or the issuer's name. It does not account for the price the investor actually paid to acquire the bond in the secondary market. Consequently, nominal yield is rarely sufficient on its own to determine if a bond is a good investment at its current market price. Current yield introduces the variable of the bond's current market price into the equation to provide a more relevant snapshot of income. To calculate current yield, you divide the annual interest payment by the current market price rather than the par value. For instance, if that same 6% bond is trading at a discount for $900, the current yield would be $60 divided by 900, resulting in approximately 6.67%. Conversely, If the bond trades at a premium of $1,100, the current yield drops to 5.45%. This calculation helps investors understand the immediate cash flow return they are receiving based on the capital they must deploy today. It is a more accurate representation of current income than nominal yield, but it still lacks a complete picture of total return. Yield to maturity is the most comprehensive yield measure because it accounts for the time value of money and capital gains or losses. This calculation includes not only the annual interest payments, but also the difference between the purchase price and the par value received at maturity. If an investor buys a bond at a discount, the yield to maturity will be higher than the current yield because the investor gains the discount amount when the bond matures at par. If purchased at a premium, the yield to maturity will be the lowest yield because the investor effectively loses the premium paid over the life of the bond. You must understand that yield to maturity assumes all interest payments are reinvested at the same rate and the bond is held until its end date. It is the standard industry metric for comparing bonds with different coupons and maturities. The relationship between these yields changes predictably based on whether a bond is trading at a discount, at par, or at a premium. When a bond trades at par, the nominal yield, current yield, and yield to maturity are all equal to each other. Whenever a bond trades at a discount, the yields follow an ascending order where the nominal yield is the lowest, followed by current yield, and yield to maturity is the highest. If the bond trades at a premium, this relationship is inverted, meaning the nominal yield is the highest, followed by current yield, with yield to maturity being the lowest. Memorizing this relationship is vital because it allows you to quickly assess the status of a bond without performing complex long-form division. These inverted relationships are a direct consequence of the inverse relationship between bond prices and interest rates. See you in the next lesson. Welcome back. We are now going to examine how the market quantifies the probability that a bond issuer will meet its financial obligations. When an investor purchases a debt security, they are essentially acting as a lender to an entity, such as a corporation or a municipality. The primary risk inherent in this relationship is credit risk, which is the possibility that the issuer will default on interest payments or fail to return the principal at maturity. To help investors navigate this risk, independent rating agencies provide standardized assessments of an issuer's creditworthiness. The most prominent agencies you will encounter are Standard & Poor's, Moody's, and Fitch. These organizations analyze the financial health of the issuer, looking at factors like cash flow, existing debt levels, and broader economic conditions to assign a specific letter grade to each bond issue. This rating serves as a heuristic for the likelihood of default, allowing for a structured comparison between disparate debt instruments. The rating scales used by these agencies are similar, but contain slight variations in nomenclature that you must be able to distinguish. Standard & Poor's and Fitch use a system of uppercase letters, where the highest quality is AAA, followed by AA, A, and BBB. Moody's uses a slightly different convention, employing a combination of uppercase and lowercase letters, such as AAA, AA, A, and BA. These specific categories represent the threshold for what the industry calls investment-grade debt. These are securities issued by entities with a strong capacity to meet their financial commitments. Because the perceived risk of default is lower for these bonds, they generally offer lower interest rates to investors. The trade-off is fundamental. You accept a lower yield in exchange for a higher probability that your capital will be preserved and your interest paid on time. Once a bond rating falls below the four highest categories, it enters the realm of non-investment grade debt, often referred to as high yield or junk bonds. For Standard & Poor's and Fitch, this transition occurs when a rating drops to BB or lower. For Moody's, it occurs at BA or lower. It is important to remember that these securities are speculative in nature. While they're colloquially called junk bonds, they play a specific role in the capital markets for investors willing to assume higher risk for the potential of higher returns. These issuers must offer a higher coupon rate to compensate investors for the increased volatility and the higher statistical probability of a default event. Understanding this dividing line between BBB/BA and BB/BA is essential for the exam, as many institutional investors are legally or internally restricted from holding securities that fall into the speculative category. The ratings assigned at the time of issuance are not permanent and are subject to change as the issuer's circumstances evolve. If a company's financial position strengthens, an agency might upgrade its rating, which typically causes the bond's price to rise as it becomes more desirable. Conversely, if an issuer's debt levels become unsustainable or their revenue declines, the agency may issue a downgrade. A significant risk for investors in investment-grade bonds is the possibility of the bond becoming a fallen angel. This term describes a bond that was originally issued with an investment-grade rating but has since been downgraded to high-yield status. Such a downgrade often triggers a mass sell-off by institutions that can only hold investment-grade debt, leading to a sharp decrease in the bond's market price. You should also be aware that some debt instruments are not rated at all. An unrated bond does not necessarily imply that the issuer is in poor financial health. Rather, it simply means the issuer chose not to pay the rating agency for an evaluation or the issue was too small to warrant one. In these cases, it is the responsibility of the investor or the broker-dealer to conduct their own due diligence to determine creditworthiness. However, for the purposes of a standardized exam, your focus should remain on the qualitative differences between the major rating tiers and how these ratings influence both the yield and the marketability of the bond. Higher credit ratings correlate with lower yields and higher prices, while lower credit ratings correlate with higher yields and lower prices. Finally, keep in mind how these agencies refine their ratings within a specific grade. Standard & Poor's and Fitch use plus and minus signs, such as a plus or a dash, to show relative standing within category. Moody's uses a numerical system, adding a 1, 2, or 3 to the rating, where 1 is the highest and 3 is the lowest within that grade. For example, an A1 rating from Moody's is equivalent to an A+ from Standard & Poor's. Recognizing these subcategories will help you understand the granularity of credit risk assessment. Mastering these distinctions is a prerequisite for understanding how debt is priced and traded in the secondary market. See you in the next lecture. Welcome back. Interest rate risk represents the most significant market risk for fixed income investors. When you hold a bond, you are essentially holding a contract that pays a fixed rate of interest over a specific period. This fixed payment becomes more or less attractive to the broader market, depending on what happens to prevailing interest rates in the economy. If the Federal Reserve raises interest rates, new bonds entering the market will offer higher yields than the older bonds already in circulation. Consequently, the older bonds with lower coupon rates become less desirable, and their market price must drop to compensate for the lower interest payments. This inverse relationship between interest rates and bond prices is the cornerstone of debt security valuation and is a concept you must master for the SIE exam. To understand why prices move in the opposite direction of rates, consider the competitive nature of the secondary market. If you own a bond paying 4% and the current market interest rate rises to 6%, no rational investor will pay you the full face value for your 4% bond. To make your bond competitive with the new 6% issues, you must lower your asking price until the effective return for the buyer matches the current market rate of 6%. This loss of principal value due to rising rates is the manifestation of interest rate risk. Conversely, if interest rates fall, your existing bond with its higher coupon becomes more valuable, allowing you to sell it at a premium, while falling rates result in a price gain. The risk we focus on is the potential for capital loss when rates climb. The magnitude of interest rate risk is not uniform across all debt instruments. It is heavily influenced by the time remaining until a bond matures. Long-term bonds are significantly more sensitive to interest rate fluctuations than short-term bonds. This is because a long-term bond locks the investor into a specific interest rate for a longer duration, increasing the uncertainty and the opportunity cost if rates rise. A 10-year bond has many more interest payments remaining than a 2-year bond, so a change in rates has a compounding effect on its present value. When interest rates move, the price of the 10-year bond will swing more violently than the price of the 2-year bond. For exam purposes, remember that the longer the maturity, the greater the interest rate risk and the higher the price volatility. In addition to maturity, the coupon rate of a bond also determines its sensitivity to interest rate changes. Bonds with lower coupon rates are more volatile than bonds with higher coupon rates when interest rates shift. A bond with a very low coupon depends more on the final principal repayment at maturity to provide its total return, whereas a high coupon bond provides more cash flow to the investor sooner. This concept leads to the realization that zero coupon bonds are the most volatile of all debt securities. Because a zero coupon bond pays no periodic interest and is sold at a deep discount, its entire value is realized at the very end. Therefore, a zero coupon bond with a long-term maturity represents the maximum possible interest rate risk for a fixed income investor. Investors often use duration as a technical measurement to quantify this sensitivity to interest rate movements. While you do not need to perform complex duration calculations for the SIE, you must understand that duration is expressed in years and accounts for both maturity and coupon rates. It essentially tells an investor how much a bond's price will change for every 1% move in interest rates. A bond with a duration of 8 years will lose approximately 8% of its value if interest rates rise by 1%. By comparing the durations of different fixed income portfolios, an investment professional can determine which is more exposed to the threat of rising interest or market volatility. Managing this risk often involves balancing the desire for higher yields with the need for price stability. It is also important to distinguish interest rate risk from other types of risks, such as credit risk or inflationary risk. Interest rate risk affects even the highest quality securities, including those issued by the United States Treasury. While a Treasury bond has virtually no default risk, it remains fully exposed to interest rate risk because its market price will still fluctuate as interest rates move. An investor who plans to hold a bond until it matures might feel they are immune to this risk, as they expect to receive the full par value eventually. However, they still face an opportunity cost, as their capital is tied up in a lower-yielding instrument while better options are available in the market. This illustrates that interest rate risk is an inherent characteristic of the fixed income market that cannot be entirely avoided if one wishes to trade or hold debt. I will see you in the next one. Welcome back. We are ready to move into the specific mechanics of how bond issuers and investors manage interest rate volatility. A callable bond is a debt instrument that grants the issuer the right, but not the legal obligation, to redeem the security before its formal maturity date. You can think of this as a refinancing option for the entity that borrowed the money. In a market where interest rates are declining, an issuer finds itself paying a higher coupon than the current market requires. To optimize their capital structure, they will call the existing bonds, effectively paying off the old debt, and then issue new debt at a lower prevailing interest rate. This action is inherently beneficial for the issuer, but introduces reinvestment risk for the bondholder, who must now find a new place for their return principal in a low-rate environment. Because the call feature favors the issuer, investors require a higher yield to compensate for the risk of having the bond taken away. This compensation typically manifests in two forms: a higher coupon rate compared to non-callable bonds and a call premium. A call premium is an additional amount paid to the investor above the par value if the bond is called early. Traditionally, many corporate and municipal bonds include a call protection period, which is a specified time frame during the early years of the bond's life when the issuer is prohibited from exercising the call feature. Once this protection expires, the bond becomes callable at the discretion of the issuer, usually upon providing 30 to 60 days of notice. When analyzing these securities, you must consider the yield to call rather than just the yield to maturity. If a bond is trading at a premium, the yield to call will always be lower than the yield to maturity because the investor loses the premium faster than expected. Conversely, if a bond is trading at a discount, the yield to call would theoretically be higher, though issuers rarely call bonds when they're trading at a discount. In fact, issuers only call bonds when it is financially advantageous for them, which almost exclusively happens when interest rates have dropped. This inverse relationship between interest rates and call probability is a fundamental concept that you must internalize for the exam. A puttiable bond operates on the opposite logic, granting the right of early redemption to the bondholder instead of the issuer. This feature allows an investor to sell the bond back to the issuer at a specified price, typically par, before the maturity date. This is an attractive feature in a rising interest rate environment. If market rates climb significantly, the fixed coupon of an existing bond becomes less attractive and its market price will drop. By exercising the put feature, the investor can reclaim their principal at par and reinvest that capital into newer bonds that offer the now higher market yields. Since the put feature provides a significant advantage to the investor, these bonds typically offer a lower coupon rate than comparable bonds without a put option. The issuer is essentially charging the investor for the flexibility of being able to exit the investment early if market conditions change for the worse. Like call features, put features often have specific windows or dates when they can be exercised. From the perspective of the issuer, these bonds carry the risk of a sudden demand for capital if interest rates spike and many investors decide to put their bonds simultaneously. This is the mirror image of the call feature, where the investor is the one who chooses when to terminate the contract. Understanding these embedded features is not merely about memorizing definitions. It is about recognizing how they respond to the movement of interest rates. You should always associate call features with falling interest rates and the issuer's desire to lower their cost of debt. Conversely, you should associate put features with rising interest rates and the investor's desire to protect their capital from price depreciation. These features transform a standard fixed income instrument into a more dynamic contract, where the eventual maturity date is no longer a certainty. Managing the expectations of when principal will be returned is a core part of fixed income analysis. I hope this clarifies how these features function in a real-world market context. See you in the next lecture. Welcome back. It is time to solidify our knowledge with a short quiz regarding the mechanics of debt securities. An investor holds a 10-year corporate bond with a 5% coupon rate that is currently trading at 102% of par. If interest rates in the general market rise by 1%, which of the following statements best describes the impact on the bond? A. The bond's market price will increase, and its yield to maturity will decrease. B. The bond's market price will decrease, and its yield to maturity will increase. C. The bond's duration will increase as the market price approaches par value. D. The bond's coupon rate will increase to remain competitive with new issues. Please pause the video now to consider your answer before we proceed to the explanation. The correct answer is B. The bond's market price will decrease, and its yield to maturity will increase. To understand why this is the correct answer, we must look at the inverse relationship between interest rates and bond prices. When market interest rates rise, newly issued bonds offer higher coupon payments than existing bonds with lower fixed rates. Consequently, the demand for existing bonds with lower coupons drops, forcing their market price down until their effective yield matches the current market environment. In this specific scenario, because the bond is trading at 102, which is a premium, a rise in market rates will pull that price downward. As the price falls, the yield to maturity increases because the investor is paying less for the same fixed stream of cash flows. The other options represent fundamental misunderstandings of bond mechanics. Option A is incorrect because it describes the opposite of the interest rate relationship we just discussed. Option D is a common trap. The coupon rate is a fixed contractual obligation set at the time of issuance and does not change regardless of what happens in the secondary market. Option C is also incorrect because duration, while a measure of sensitivity, does not behave in the manner described simply because a price moves toward par. Understanding that price and yield move in opposite directions is a prerequisite for passing the SIE exam and managing debt portfolios effectively. I will see you in the next lecture. Welcome back. When we discuss government debt, we are primarily looking at securities issued by the United States Department of the Treasury. These instruments are backed by the full faith and credit of the U.S. government, which effectively means they are considered to have no credit risk. Unlike corporate bonds, which rely on the cash flow of a business, the Treasury can satisfy its obligations through its power to tax and print money. Because they're the safest fixed income investments available, they often serve as the benchmark for interest rates globally. It is important to remember that while there is no default risk, these securities are still subject to market risks, such as interest rate fluctuations and inflation. Treasury bills, or T-bills, represent the short-term end of the government debt spectrum. These securities are issued with maturities of 1 year or less, typically in denominations of 4, 13, 26, and 52 weeks. A defining characteristic of T-bills is that they do not pay a periodic interest coupon. Instead, they are issued at a discount to their face value, and the difference between the purchase price and the par value received at maturity represents the investor's interest income. Because of their short duration and high liquidity, they are often considered the closest thing to cash in the investment world. Treasury notes, commonly referred to as T-notes, occupy the intermediate maturity space. They are issued with initial maturities ranging from 2 to 10 years. Unlike T-bills, T-notes are interest-bearing securities that pay a fixed rate of interest every 6 months until they reach maturity. They are issued at or near par value, and when they mature, the investor receives the final interest payment along with the full face value. For the purposes of the exam, you should recognize that T-notes are quoted as a percentage of par in 1/32, which distinguishes them from corporate or municipal bonds. Treasury bonds, or T-bonds, are the long-term debt obligations issued by the government with maturities greater than 10 years. Currently, the Treasury issues these with 30-year maturities. Like T-notes, T-bonds pay semiannual interest at a fixed coupon rate and return the principal at maturity. Because they have the longest durations, T-bonds are the most sensitive to changes in interest rates among all Treasury securities. If interest rates in the market rise, the price of a 30-year T-bond will fall significantly more than that of a 2-year T-note, making them a significant consideration for investors concerned with price volatility. Beyond the standard bills, notes, and bonds, there are specialized Treasury products designed to address specific investor needs. Treasury receipts and strips focus on the separation of principal and interest components of a bond. While the Treasury Department does not issue Treasury receipts, as these are created by broker-dealers, the government does issue strips, which stand for separate trading of registered interest and principal of securities. These function as zero-coupon bonds where the investor buys only a specific interest payment or the final principal payment. This structure allows investors to lock in a specific rate of return over a known period without the reinvestment risk associated with periodic coupon payments. Another specialized instrument is the Treasury Inflation Protected Security, or TIPS. These are designed specifically to eliminate purchasing power risk by adjusting the principal amount based on changes in the Consumer Price Index. The coupon rate on a TIPS remains fixed, but because that rate is applied to an increasing principal value during inflationary periods, the actual dollar amount of the interest payment grows. If deflation occurs, the principal is adjusted downward, though, at maturity, the investor is guaranteed to receive at least the original par value. This mechanism makes TIPS a unique hedge against rising costs of living that other fixed-rate treasuries cannot provide. I hope this provides a clear framework for understanding treasury debt. See you in the next lecture. Hello, and welcome back. When we discuss debt issued by the United States government, we often default to thinking about treasury securities. However, a significant portion of the fixed income market consists of debt issued by government agencies or government-sponsored enterprises, commonly referred to as GSEs. While these instruments are frequently grouped together, they possess distinct structural differences regarding their backing and credit risk that you must understand for the examination. It is useful to think of these as a middle ground between the absolute safety of direct treasury obligations and the higher yields found in the corporate sector. We categorize these into two primary groups: those backed by the full faith and credit of the U.S. government, and those that carry only an implicit guarantee. Understanding this distinction is fundamental because it influences how these securities are priced and how they behave in a portfolio. The most prominent entity in the first category is the Government National Mortgage Association, or Ginnie Mae. Because Ginnie Mae is a government-owned corporation within the Department of Housing and Urban Development, its debt is directly backed by the U.S. Treasury. This direct backing makes Ginnie Mae securities the safest of all agency debt, virtually eliminating default risk from credit perspective. Other entities, such as the Federal National Mortgage Association, known as Fannie Mae, and the Federal Home Loan Mortgage Corporation, known as Freddie Mac, operate differently. These are publicly traded, shareholder-owned corporations that were chartered by Congress to provide liquidity to the mortgage market. While they're supervised by federal regulators, their debt is not technically a direct obligation of the U.S. government, though the market generally operates under the assumption that the government would not allow them to fail. Most agency securities are structured as mortgage-backed securities, which introduces a cash flow mechanic that differs significantly from standard corporate or treasury bonds. Instead of receiving a fixed semi-annual interest payment and a lump sum of principal at maturity, investors in mortgage pools receive monthly payments consisting of both interest and principal. This process is known as amortization, and it replicates the way a homeowner pays off their mortgage over time. This structure is efficient for providing regular income, but it requires the investor to manage the reinvestment of principal much sooner than they would with a traditional bond. For the SIE exam, you should remember that these monthly payments are subject to federal, state, and local taxation, unlike Treasury securities, which are typically exempt at the state and local levels. A primary risk associated with these mortgage-backed instruments is prepayment risk, which is closely tied to fluctuations in interest rates. When interest rates in the broader economy decline, homeowners are incentivized to refinance their existing mortgages to secure lower rates. When this happens, the underlying mortgages in an agency pool are paid off early, and that principal is returned to the bondholders sooner than expected. This leaves the investor with a pool of cash that must now be reinvested in a lower interest rate environment, effectively reducing the overall yield of their portfolio. This phenomenon creates a dynamic where the security lacks the price appreciation potential that a traditional bond would normally enjoy when rates fall. You'll find that this makes the valuation of agency debt more complex than the valuation of zero coupon or fixed coupon treasury bonds. Conversely, when interest rates rise, investors face what is known as extension risk. In a rising rate environment, homeowners are unlikely to refinance, meaning they will hold onto their original mortgages for as long as possible. This causes the expected maturity of the mortgage-backed security to lengthen, locking the investor's capital into a lower-yielding instrument for a longer duration than they initially anticipated. While the investor is still receiving their monthly payments, the market value of the security will drop more significantly than it would if the principal were being returned faster. Understanding both prepayment risk and extension risk is critical because it explains why agency securities usually offer a slightly higher yield than direct Treasury obligations. The market demands a premium to compensate the investor for the uncertainty regarding exactly when their principal will be returned. Beyond mortgage-backed securities, the federal farm credit banks also issue agency debt to support agricultural, lending, and rural infrastructure. These securities are issued to fund loans for farmers, ranchers, and agricultural cooperatives, providing a vital source of liquidity for the American food supply chain. Like Fannie Mae and Freddie Mac, these are obligations of the issuing GSE and are not directly guaranteed by the U.S. government, though they maintain very high credit ratings. They typically issue short-term discount notes and longer-term bonds, which are often exempt from state and local taxes, similar to Treasury securities. This tax treatment makes them an attractive alternative for investors seeking diversification within their high-quality debt holdings without the specific prepayment risks associated with housing-related debt. In terms of mechanics, agency securities are typically issued in larger denominations than Treasury bonds, often starting at $25,000. They are traded in the over-the-counter market, and while they are highly liquid, their liquidity may slightly trail that of the direct Treasury market. For the purposes of the exam, keep your focus on the fact that only Ginnie Mae has the full faith and credit backing. Every other agency mentioned has an implicit guarantee or is simply an obligation of the corporation itself. Being able to distinguish between the tax treatments and the specific risks like prepayment and extension will allow you to navigate most questions regarding this asset class. These securities represent a crucial component of the debt market by connecting private borrowers, like homeowners and farmers, to the broader capital markets. See you in the next lecture. Welcome back. General obligation bonds, commonly referred to as GO bonds, represent a fundamental category of municipal debt that relies on the taxing power of the issuer rather than specific project revenues. When a municipality issues a GO bond, it pledges its full faith, credit, and taxing power to meet its debt obligations. This commitment means the issuer is legally obligated to use all available resources, including the periodic collection of taxes, to ensure bondholders receive timely interest and principal payments. Because these bonds are backed by the general treasury of the issuer, they're often perceived as having a lower default risk compared to other municipal instruments. You'll find that these securities are typically used to fund public projects that do not generate their own income, such as public schools, police stations, or administrative buildings. The security of a GO bond depends heavily on the level of government issuing the debt, specifically whether the issuer is a state or a local entity. State-issued GO bonds are primarily secured by income taxes, sales taxes, and excise taxes collected at the state level. Local government units, such as counties, cities, or school districts, rely more heavily on ad valorem taxes, which is a Latin term meaning according to value. These are property taxes levied on real estate within the jurisdiction and serve as the primary source of fund for local debt service. If you are analyzing the creditworthiness of a local GO bond, you must examine the assessed value of property within the municipality and the tax rates applied to that value. One of the defining characteristics of GO bonds is the requirement for voter approval before the debt can be issued. Since the repayment of these bonds is tied directly to the taxing power of the community, the taxpayers themselves usually must vote on whether the municipality should incur the new debt. This process acts as a check on the government's ability to increase its debt load and potentially raise property taxes. Furthermore, most municipalities are subject to statutory debt limits, which are legal restrictions on the total amount of debt an issuer can have outstanding. If a municipality reaches its debt limit, it cannot issue more GO bonds without changing the law or obtaining specific voter authorization to exceed that limit. When evaluating the risk associated with GO bonds, the focus shifts toward the economic health of the taxing jurisdiction. Analysts look at the diversity of the tax base. For instance, a city that relies on a single industry for its tax revenue is riskier than one with a broad mix of residential, commercial, and industrial taxpayers. An increasing population and rising property values generally indicate a strengthening ability to support debt obligations. Conversely, if property tax collection rates decline or if the municipality is already burdened by high existing debt, the risk to the investor increases. It is also important to consider the overlapping debt, which refers to debt issued by different political entities that draw from the same taxpayer base, such as a city and a school district sharing the same residents. The concept of the full faith and credit pledge is the strongest commitment a municipal issuer can provide. It implies that the issuer will raise taxes if necessary to meet the debt service requirements, provided they are within legal limits. This is why GO bonds generally carry higher credit ratings than revenue bonds from the same issuer, as the latter are limited to the earnings of a specific facility like a toll bridge or hospital. For the purpose of the exam, you should remember that GO bonds are synonymous with taxes and voter approval. This distinction is vital for correctly identifying the appropriate investment vehicle based on a municipality's specific needs and its residents' willingness to provide financial backing. See you in the next lecture. Welcome back. We are continuing our examination of municipal debt by looking at revenue bonds. When a municipality needs to fund a specific project that generates its own income, it often turns to revenue bonds rather than general obligation bonds. While general obligation bonds rely on the full faith and credit and taxing power of the issuer, revenue bonds are self-supporting. This means the principal and interest payments are funded exclusively by the revenues generated by the facility or project for which the debt was issued. Because these bonds are not linked to tax revenues, they do not require voter approval, and they do not count against the municipality's statutory debt limits. This lack of taxpayer recourse makes the credit analysis of these instruments significantly different from other municipal securities. The sources of revenue for these bonds can vary widely, ranging from turnpike tolls and bridge fees to airport landing charges and water utility payments. You might find revenue bonds financing a local hospital or university dormitory where the patient fees or student rent payments serve as the security for the debt. In each of these cases, if the facility fails to generate sufficient revenue to cover the debt service, the bondholders do not have a claim on the municipality's tax base. This fundamental decoupling of project risk from general tax funds is why these securities are considered more risky than general obligation bonds. Consequently, they typically offer higher yields to investors to compensate for the possibility that the project might not perform as expected. To provide a layer of protection to investors, most revenue bonds are issued with a bond contract that includes various protective covenants. These covenants are legal promises made by the issuer to perform certain duties or refrain from certain actions throughout the life of the bond. For instance, a rate covenant requires the issuer to adjust user fees as necessary to ensure that the revenue generated is always sufficient to cover operating expenses and debt service. A maintenance covenant ensures the facility is kept in good working order so it can continue to generate income. These rules are outlined in the trust indenture, which acts as the governing document for the relationship between the issuer and the bondholders. Another critical component of revenue bond structure is the flow of funds, which dictates the order in which the generated revenue is distributed. In a gross revenue pledge, the issuer pays the debt service first, before any operating or maintenance expenses are covered. Conversely, a net revenue pledge requires that the facility's operating and maintenance expenses are paid first, and the debt service is covered by the remaining net revenues. Most revenue bonds utilize a net revenue pledge because it ensures the facility remains operational and capable of earning money to pay back the debt. You should distinguish between these two structures, as the order of payment significantly impacts the safety of the interest payments for the bondholder. The viability of a revenue bond is often determined before the bond is even issued through what is known as a feasibility study. The issuer hires independent consultants to estimate future revenues and compare them against the projected costs of construction and operation. This study helps determine the debt coverage ratio, which measures how many times the projected annual revenue covers the annual debt service requirements. A higher ratio indicates a more secure investment, as there is a larger cushion to absorb potential revenue shortfalls. Without a favorable feasibility study, a municipality would find it difficult to attract the institutional interest necessary to underwrite the offering effectively. Specialized types of revenue bonds also exist to meet specific financing needs, such as industrial development revenue bonds. These are issued by a municipality to build a facility for a private corporation, which then leases the facility. The lease payments are used to pay the bondholders. Because the debt is secured by a private company's payments, the credit rating is based on the corporation, not the municipality. In some cases, these bonds may be subject to the alternative minimum tax, which is an important consideration for high net worth investors. Understanding these nuances helps clarify how municipal debt can be used as a flexible tool for both public and private infrastructure development. See you in the next lecture. Welcome back. When we discuss municipal bonds, the conversation inevitably centers on their tax treatment, which is arguably their most distinguishing feature compared to corporate or treasury debt. The fundamental principle is that interest income from municipal bonds is exempt from federal income tax. This exemption exists because of the doctrine of reciprocal immunity, which suggests that the federal government and state or local governments should not tax each other's debt obligations. It is important to note that this exemption applies only to interest income, not to capital gains. If an investor sells a municipal bond for more than their cost basis, that profit is subject to capital gains tax, just like any other security. While federal tax exemption is the baseline, the state-level tax treatment depends on where the investor resides and where the bond was issued. Typically, if a resident of a particular state purchases a municipal bond issued by an entity within that same state, the interest is exempt from both federal and state income taxes. This is often referred to as a double tax-free status. In some municipalities, such as New York City, interest might even be exempt from local city taxes, creating a triple tax-free scenario. However, if an investor buys a municipal bond issued by a different state, the interest is usually subject to the investor's home state income tax, even though it remains exempt at the federal level. This tax-exempt status creates a disparity when comparing the yields of municipal bonds to taxable bonds, such as corporate debt. Since an investor in a municipal bond keeps the entire interest payment without sending a portion to the IRS, a lower nominal coupon rate can actually be more valuable than a higher rate on a taxable bond. To make an objective comparison, we use a calculation called the tax equivalent yield. This formula helps us determine what interest rate a taxable bond would need to offer to equal the after-tax return of a municipal bond. You calculate this by taking the municipal yield and dividing it by the quantity of 1 minus the investor's marginal tax bracket. Consider an investor in a 30% tax bracket who is looking at a municipal bond yielding 7%. Using the formula, we divide 0.07 by 0.70, which results in a tax equivalent yield of 10%. This means that for this specific investor, a taxable corporate bond must yield more than 10% to be a better financial choice than the 7% municipal bond. If the corporate bond yields only 9%, the investor is actually better off with a municipal bond, despite its lower stated interest rate. This demonstrates why municipal bonds are generally more attractive to investors in higher tax brackets, as the relative value of the tax savings increases as the tax rate rises. We can also look at this from the opposite direction using the net after-tax yield formula. This is used when an investor starts with a taxable bond yield and wants to see what they would actually keep after paying Uncle Sam. To find this, you multiply the taxable yield by the quantity of 1 minus the tax bracket. If we take that same 10% corporate bond and multiply it by 0.70, we see the net yield is 7%. This confirms our previous calculation and provides a clear mechanism for evaluating different fixed income products side by side. You should be comfortable performing these calculations in both directions, as the suitability of a municipal bond depends entirely on these mathematical relationships. It is also necessary to mention the alternative minimum tax, commonly known as the AMT. Certain municipal bonds, specifically private activity bonds that fund projects like sports stadiums or industrial parks, may lose their tax-exempt status for investors subject to the AMT. Because these bonds benefit private entities rather than the general public exclusively, the IRS considers the interest a tax preference item. For a student of the SIE, the takeaway is that municipal bonds are not always 100% tax-free for every single investor. Always consider the specific type of bond and the individual tax situation of the person purchasing it before assuming the tax benefit applies. In summary, the primary benefit of municipal debt is the preservation of capital through federal tax avoidance on interest income. This benefit is most pronounced for high-income earners and those living in the state of issuance. By mastering the tax-equivalent yield formula, you can quantify exactly how much that tax exemption is worth in the broader marketplace. When assessing these securities, always distinguish between interest income and capital gains, as the former is protected while the latter is not. This distinction is a frequent point of testing and remains a cornerstone of municipal bond theory. See you in the next lecture. Hello. Let's see how well you have internalized the concepts of government and municipal debt. It is time to solidify our knowledge with a short quiz regarding the nature of public debt instruments and their taxation. An investor in a high tax bracket is considering purchasing a debt security. Which of the following securities would offer interest income that is generally exempt from federal income tax? A. Treasury bills. B. Ginnie Mae pass-through certificates. C. General obligation bonds. D. Corporate debentures. Please pause the video and think about the answer before proceeding. The correct answer is C. General obligation bonds. General obligation bonds, or GO bonds, are a category of municipal debt backed by the full faith, credit, and taxing power of the issuer. Because these are issued by states, cities, or counties, the interest paid to investors is typically exempt from federal income tax. This specific tax advantage makes them highly attractive to investors in higher tax brackets, as the tax-free yield can often result in a higher after-tax return than a taxable bond with a nominally higher interest rate. In contrast, Treasury bills are issued by the federal government. While their interest is exempt from state and local taxes, it is fully subject to federal income tax. Agency securities like Ginnie Mae pass-through certificates represent a different risk and tax profile. While they are backed by the government and involve mortgage-backed securities, the interest income earned by the investor is subject to taxation at all levels, including federal, state, and local. This is a common point of confusion, as many assume that a government-related entity provides the same tax benefits as a municipal issuer, but that is not the case for most mortgage-backed agencies. Corporate debentures, being unsecured private debt, offer no such tax exemptions and are fully taxable at all levels. Revenue bonds, another type of municipal debt, not listed as the primary answer here, would also share the federal tax exemption, but the question specifically leads us to the characteristics of general municipal issues. I hope this helped clarify the distinctions between federal, agency, and municipal debt obligations. See you in the next lecture. Hello, and welcome back to our survey of the debt markets. When a corporation decides to borrow money from the public, it must determine how it will entice investors to provide capital while managing the risks inherent in its own balance sheet. One of the most effective ways to lower the interest rate a corporation needs to pay is to offer security in the form of specific assets. This brings us to the concept of secured corporate bonds, which are debt instruments backed by collateral that the issuer pledges to the bondholders. In the event of a default or liquidation, these bondholders have a preferred claim on the underlying assets, providing a safety net that unsecured creditors do not enjoy. Because the risk of total loss is mitigated by this collateral, these bonds are generally considered more conservative investments than their unsecured counterparts. We will examine three primary types of secured debt: mortgage bonds, equipment trust certificates, and collateral trust bonds. Mortgage bonds represent one of the most common forms of secured corporate debt, frequently utilized by capital-intensive industries, such as public utilities. These bonds are backed by a lien on real property owned by the issuing corporation, which might include land, office buildings, or manufacturing facilities. It is important to distinguish between open-end and closed-end trust indentures within this category. An open-end indenture allows a corporation to issue additional bonds backed by the same collateral, provided they meet certain financial tests, which can dilute the original bondholder's claim. Conversely, a closed-end indenture prevents the issuance of further debt against the same property unless the new bonds are subordinate to the existing ones. In a liquidation scenario, the trustee sells the real estate and uses the proceeds to satisfy the mortgage bondholders before any other creditors receive a distribution from those specific assets. Another specialized form of secured debt is the equipment trust certificate, often referred to as an ETC. These instruments are primarily used by transportation companies, such as airlines, railroads, and shipping firms, to finance the purchase of expensive mobile equipment. The unique structural characteristic of an ETC is that the title to the equipment, whether it be a fleet of aircraft or a set of locomotives, is held by a trustee rather than the corporation itself. The corporation operates the equipment and makes lease payments to the trustee, which then passes these payments through to the bondholders as interest and principal. Once the debt is fully retired, the title to the equipment officially transfers to the corporation. This arrangement is particularly advantageous for investors because, should the company fail, the assets are highly mobile and can be easily relocated and sold to another operator in the same industry. Collateral trust bonds differ from the previous two examples because they are secured not by physical property or equipment, but by financial assets. A corporation may own a significant portfolio of securities, such as the stocks or bonds of its subsidiaries, or even shares in unrelated companies. To raise capital, the parent company can deposit these securities into a trust account held by a third-party trustee to serve as collateral for a new bond issue. This structure is common among holding companies that do not have substantial physical operations of their own, but possess significant equity in other businesses. The quality of a collateral trust bond is directly linked to the market value and liquidity of the underlying securities held in the trust. If the value of the pledged securities falls below a certain threshold, the trust indenture typically requires the issuer to deposit additional collateral to maintain the safety margin for the bondholders. While secured bonds offer a higher degree of protection than debentures, they're still subject to the general risks of the bond market, including interest rate and inflationary risks. The primary benefit of the secured status only becomes relevant during extreme financial distress or actual bankruptcy. In the hierarchy of corporate liquidation, secured creditors sit at the top, receiving the proceeds from their specific collateral before any other party. If the sale of the collateral is insufficient to cover the entire debt, the remaining balance is usually treated as a general, unsecured claim against the company's remaining assets. Understanding these layers of protection is essential for evaluating the risk-reward profile of a corporate debt portfolio. Investors must weigh the lower yields typically offered by secured bonds against the fundamental security provided by the underlying collateral. I hope this clarifies the mechanics of asset-backed corporate debt. I will see you in the next lecture. Welcome back. When we discuss corporate debt, we often focus on the collateral backing the promise to pay. While secured bonds rely on specific physical assets, Unsecured corporate bonds rely solely on the full faith and credit of the issuing corporation. This means there is no mortgage on a building or a lien on equipment to protect the investor if the company defaults. You might wonder why an investor would accept such an arrangement, but the reality is that many of the world's most stable companies frequently issue unsecured debt. These instruments are categorized primarily as debentures, which represent a significant portion of the corporate bond market. From a structural perspective, a debenture is a legal contract where the issuer promises to pay interest and principal, but the only recourse for the holder is to sue the company or join other creditors in bankruptcy proceedings. The term debenture identifies a debt obligation that is backed by the general creditworthiness and reputation of the issuer rather than physical collateral. Since there is no specific asset tied to the bond, the credit rating of the corporation becomes the most critical factor for an investor to consider. High-quality issuers with strong cash flows can issue debentures at relatively low interest rates because the market perceives the risk of default to be minimal. However, because these bonds lack collateral, they're inherently riskier than secured bonds from the same issuer. Consequently, to compensate for this increased risk, debentures typically offer a higher coupon rate than secured obligations. It is a trade-off between the security of an asset-backed instrument and the higher yield of a credit-backed instrument. Within the realm of unsecured debt, we find different levels of seniority that dictate the order of repayment. A subordinated debenture is a specific type of unsecured bond that sits lower in the hierarchy of claims than regular debentures. The term subordinated indicates that, in the event of a corporate liquidation or bankruptcy, these bondholders will only be paid after the senior, unsecured debt holders have been satisfied. This hierarchy is essential to understand because it directly impacts the risk profile of the investment. Because they are further back in line for payment, subordinated debentures are considered riskier than standard debentures. To attract investors to this lower priority position, companies must offer even higher interest rates than those found on their senior unsecured debt. It is important to distinguish between the various types of unsecured instruments based on their maturity and purpose. While most debentures are long-term instruments, corporations also issue short-term unsecured debt, known as commercial paper, to meet immediate cash needs. However, for the purposes of understanding corporate bonds, we focus on the long-term obligations that form a part of a company's capital structure. The legal document governing these bonds, the trust indenture, will explicitly state whether the bond is senior or subordinated. This transparency allows the market to price the bonds appropriately based on their standing. If a company faces a financial crisis, the holders of subordinated debentures are often the ones who face the highest likelihood of a total loss among the bondholding class. Investment-grade corporations are the most frequent issuers of unsecured debt because their financial standing is robust enough that they do not need to pledge assets. Smaller or more speculative companies may find it difficult to issue debentures at reasonable rates, as investors will demand collateral to offset the higher risk of business failure. When evaluating these securities for the exam, you should always assume that unsecured means the bond is backed only by the company's promise to pay. You must also remember that even though a debenture is unsecured, it still ranks ahead of all classes of equity, including both preferred and common stock. The bondholder is a creditor, which is a fundamentally different legal position than that of a shareholder. In summary, unsecured corporate bonds come in several varieties, but they all share the common trait of lacking specific collateral. Debentures are the standard form of this debt, while subordinated debentures represent a junior claim on the company's assets and income. The interest rates on these products reflect their position in the capital stack, with lower priority instruments requiring higher yields to compensate for the added risk. Understanding the distinction between these layers of debt is crucial for any professional operating in the capital markets. As the priority of the claim decreases, the potential for higher income increases, assuming the issuer remains solvent. This relationship between seniority and yield is a cornerstone of fixed income analysis. See you in the next lecture. Hello, it is good to have you back as we continue our look at corporate debt instruments. A convertible bond is a hybrid security that starts its life as a debt instrument, but contains an embedded option allowing the holder to exchange the bond for a fixed number of shares of the issuer's common stock. From the perspective of the issuing corporation, this feature acts as a sweetener that typically allows the company to pay a lower coupon rate than it would on a traditional non-convertible bond. Investors are often willing to accept this lower interest income in exchange for the potential capital appreciation if the company's stock price rises significantly. Because the bond can be converted into equity, its market price is influenced not only by prevailing interest rates, but also by the performance of the underlying common stock. The terms of the conversion are established at the time the bond is issued and are found in the bond indenture. The most important metric to understand is the conversion ratio, which defines exactly how many shares of stock the investor receives for each bond. It is critical to remember that for calculation purposes, the conversion ratio is always based on the bond's par value, which is typically $1,000, regardless of the bond's current market price. If an indenture specifies a conversion price of $25, you determine the conversion ratio by dividing the $1,000 par value by that $25 conversion price, resulting in a ratio of 40 shares. Once you understand the conversion ratio, you can evaluate the relationship between the bond price and the stock price using a concept known as parity. Parity occurs when the total market value of the common stock received upon conversion is exactly equal to the current market value of the bond. To find the parity price of the bond, you multiply the current market price of the common stock by the conversion ratio. Conversely, to find the parity price of the stock, you divide the current market price of the bond by the conversion ratio. In an efficient market, convertible bonds usually trade at a slight premium to parity because they offer the downside protection of a bond with the upside potential of a stock. There are several advantages and disadvantages to this structure that you should be aware of for the exam. For the investor, the primary advantage is the floor provided by the bond's fixed income characteristics. Even if the stock price collapses, the bond still retains value as a debt instrument that pays interest and returns principal at maturity. For the issuer, converting debt into equity eliminates the obligation to pay interest and eventually repay the principal, effectively deleveraging the balance sheet. However, the downside for the issuer is that conversion results in the issuance of new shares, which dilutes the ownership percentage and earnings per share for existing stockholders. Another feature often attached to convertible bonds is a call provision, which gives the issuer the right to redeem the bond before its maturity date. When a company issues a call notice for a convertible bond that is trading above its call price, it often triggers what is known as a forced conversion. If the value of the stock an investor would receive through conversion is higher than the call price the company is offering, the investor will logically choose to convert their bonds into shares rather than allow the bonds to be redeemed for cash. This allows the issuing corporation to stop making interest payments and remove the debt from its books without a significant cash outlay. When analyzing these securities, you must be careful not to confuse the coupon rate with the total return. Because the conversion feature is valuable, the yields on convertible bonds are generally lower than those of non-convertible bonds of the same credit quality and maturity. If the underlying common stock performs poorly and never reaches the conversion price, the investor is left holding a bond with a below-market interest rate. This represents the trade-off inherent in the security. You are paying for an opportunity, and like any option, that opportunity has a cost in the form of foregone interest income over the life of the investment. I hope this clarifies how these hybrid instruments function within the corporate capital structure. I look forward to seeing you in the next lesson. Hello, it is good to have you back as we continue our look into the various segments of the fixed income market. When we discuss the money market, we are essentially talking about the wholesale market for high-quality, short-term debt instruments that are characterized by their liquidity and safety. In this context, Short-term specifically refers to securities with a maturity of 1 year or less, though many of the instruments we will discuss mature in much shorter time frames. The primary function of the money market is to provide a venue where corporations and governments can manage their short-term cash flow needs, allowing those with excess cash to earn a modest return while providing borrowers with immediate access to liquidity. Because these instruments are so close to cash, they are often referred to as cash equivalents, and they trade in large denominations, which usually makes them the domain of institutional investors. For the purpose of the exam, you must distinguish these from capital market instruments, which are used for long-term financing through the issuance of stocks and long-term bonds. Commercial paper represents one of the most prominent instruments within this space, serving as an unsecured, short-term promissory note issued by corporations with high credit ratings. Because it is unsecured, it is backed only by the full faith and credit of the issuing corporation, which is why only the most financially stable entities typically use it to finance accounts receivable or seasonal inventory needs. The maximum maturity for commercial paper is 270 days, a specific time frame chosen because it exempts the issuance from the rigorous registration requirements of the Securities Act of 1933. Most commercial paper is issued at a discount to its face value, meaning the investor's return is the difference between the purchase price and the par value received at maturity. If you encounter a question regarding the typical duration or the primary backing of these notes, remember that they are shorter than 9 months and rely entirely on the issuer's reputation. Another vital component of the money market is the banker's acceptance, which functions as a short-term draft used primarily to facilitate international trade. When a domestic company wants to purchase goods from a foreign supplier, the foreign entity may require a guarantee of payment. The banker's acceptance serves this role by acting as a post-dated check that a bank has guaranteed or accepted. This instrument allows the exporter to receive immediate payment from the bank at a discount, while the bank holds the obligation until it matures, usually within 180 days. Like commercial paper, bankers' acceptances trade at a discount and are considered very safe because they are backed by both the credit of the bank and the underlying goods being traded. You should view these as the machinery that keeps global commerce moving by mitigating the credit risk inherent in cross-border transactions. Negotiable certificates of deposit, often called jumbo CDs, are another instrument you will need to recognize, though they differ significantly from the retail CDs you might find at a local bank. These are time deposits with a fixed interest rate and a minimum face value of $100,000, though they more commonly trade in blocks of $1 million or more. The negotiable aspect is the defining characteristic here, as it means these instruments can be traded in the secondary market before they reach maturity. While traditional retail CDs are non-negotiable and carry penalties for early withdrawal, jumbo CDs allow institutional investors to liquidate their positions by selling them to other investors. It is important to remember that because these are bank obligations, they are insured by the FDIC up to the legal limits, provided the bank is a member of the organization. Repurchase agreements, or repos, are contract-based transactions where one party sells securities to another with a formal agreement to buy them back at a higher price on a specific future date. The difference between the sale price and the repurchase price represents the interest, often referred to as the repo rate, which compensated the lender for the use of their funds. These agreements are essentially collateralized short-term loans, often lasting only a single night, making them a cornerstone of the Federal Reserve's monetary policy operations. For the exam, you should also be aware of the reverse repo, which is simply the other side of the transaction where an entity buys securities with the intention to sell them back. This mechanism provides the highest level of liquidity and is used extensively by government bond dealers to manage their daily positions. Finally, we must briefly touch upon Treasury bills and tax anticipation notes, as they represent the government's presence in the money market. Treasury bills are the most liquid of all money market instruments and are considered the safest possible investment since they are backed by the United States Treasury. They are issued with maturities of 4, 13, 26, and 52 weeks, and like many other money market tools, they do not pay a periodic coupon but are sold at a discount. Similarly, municipalities issue short-term notes like tax anticipation notes to finance current operations in expectation of future tax revenue. While these differ based on the issuer, they all share the common money market traits of short duration, high liquidity, and a primary focus on capital preservation over high yields. I look forward to discussing our next topic with you in the following session. Hello, and welcome back. When a corporation fails and enters bankruptcy, the orderly distribution of remaining assets is governed by a strict hierarchy known as liquidation priority. This structure ensures that creditors and investors are compensated according to the level of risk they assumed and the contractual nature of their claims. As an investor or an advisor, understanding this pecking order is not just an academic exercise. It defines the ultimate recovery value of a security in a worst-case scenario. The legal framework dictates that each tier of claimants must be paid in full before the next tier receives any value. This often results in junior claimants receiving nothing at all if the assets are exhausted by senior claims. We begin this hierarchy with the parties that have the most direct legal claim to specific company assets. At the absolute top of the list are the secured creditors, typically represented by secured bondholders. These investors hold debt instruments backed by specific collateral, such as real estate in the case of mortgage bonds or physical equipment in the case of equipment trust certificates. If the corporation defaults, these creditors have a legal right to the underlying asset itself or the proceeds from its sale. Because their claim is tied to a tangible piece of property, they occupy the safest position in the liquidation process. It is important to note that if the sale of the collateral does not fully cover the debt owed to them, the remaining unpaid balance is treated as a general unsecured claim. This means they would effectively join a lower tier for the residual amount, losing their priority status for that specific portion. Following the secured creditors, the next group to be satisfied includes administrative claimants and unsecured creditors. Administrative expenses often include costs associated with the bankruptcy proceedings themselves, such as legal fees and trustee charges, which must be settled to facilitate the liquidation. After these expenses, the focus shifts to general creditors, which includes holders of unsecured bonds, also known as debentures. These instruments are backed only by the full faith and credit of the issuing corporation rather than specific physical assets. In this same tier, you will often find wages owed to employees up to certain limits and taxes owed to federal, state, and local governments. While taxes and wages are high-priority, unsecured claims, they still sit below the secured bondholders who have a lien on specific property. Below the general creditors and debenture holders is a specific category of debt known as subordinated debentures. The term subordinated explicitly indicates that these debt holders have agreed, by contract, to stand behind other unsecured creditors in the event of a liquidation. Investors are generally compensated for this increased risk through higher interest rates compared to senior debt. When a liquidation process reaches this stage, there is often significantly less capital available to distribute. If the assets are insufficient to pay the senior debentures in full, the subordinated holders will receive nothing. This clear demarcation between senior and junior debt is a fundamental component of corporate finance that influences how these securities are priced in the secondary market. Once all creditors, both secured and unsecured, have been paid in full, the remaining assets, if any, belong to the equity holders. Within the equity class, preferred stockholders hold priority over common stockholders. Preferred stock is often described as a hybrid security because it has dividend characteristics similar to bond interest, and its standing in liquidation reflects this middle ground position. Preferred shareholders must receive their stated par value or specified liquidation preference before a single penny can be distributed to common shareholders. While they are senior to common stock, they remain junior to every type of debt instrument. In many corporate bankruptcies, the value of the firm is exhausted before reaching the preferred shareholders, leaving them with a total loss on their investment. The final participants in the liquidation hierarchy are the common stockholders. As the residual owners of the corporation, they assume the greatest risk and, consequently, occupy the lowest priority level. In a liquidation scenario, common stockholders are referred to as the residual claimants because they only receive what is left over after every other obligation has been met. History shows that in most formal liquidations, common stockholders are wiped out entirely. This risk is the trade-off for the unlimited upside potential they enjoy if the company prospers. While debt holders are limited to receiving their principal and interest, common shareholders own the growth of the firm, but they must accept that they're the very last in line during a failure. See you in the next lecture. Welcome back. Let's solidify our knowledge of corporate debt with a short quiz. A corporation has entered bankruptcy liquidation. It has outstanding 6% debentures, 5% mortgage bonds, and accounts payable to various suppliers. In what order will these claims be satisfied? A. Mortgage bonds, debentures, accounts payable. B. Accounts payable, mortgage bonds, debentures. C. Mortgage bonds, accounts payable, debentures. D. Debentures, mortgage bonds, accounts payable. Please pause the video and think about the answer before proceeding. The correct answer is C. Mortgage bonds, accounts payable, debentures. The resolution of claims in a corporate bankruptcy follows a strict legal hierarchy that prioritizes secured lenders above all others. In this specific scenario, the mortgage bonds are considered secured debt because they are backed by specific physical assets, such as real estate or equipment. Because the bondholders have a lien on that collateral, they're the first in line to receive proceeds from the sale of those assets. Once the secured creditors have been satisfied, the liquidation moves to administrative claims and general creditors. Accounts payable represent money owed to suppliers and are categorized as general, unsecured liabilities that must be paid before any junior unsecured debt. The debentures in this question represent the most junior claim among the three options provided. A debenture is an unsecured corporate bond backed only by the full faith and credit of the issuing corporation, meaning there is no specific collateral pledge to the bondholders. In the hierarchy of liquidation, general creditors like suppliers take precedence over the holders of these unsecured bonds. While the debenture holders are still ahead of preferred and common stockholders, they remain behind both the secured bondholders and the general creditors. Understanding this sequence is vital for determining the relative risk and recovery prospects for different classes of corporate debt instruments. Good luck with your continued studies. Hello, and welcome back. We are moving into a subject that many find intimidating, but it is manageable once you understand the basic mechanics. Options belong to a broader category of financial instruments known as derivatives. As the name implies, a derivative does not possess intrinsic value in a vacuum. Instead, its value is derived from an underlying asset. In the context of the SIE exam, this underlying asset is typically a specific stock, though it can also be an index or a foreign currency. An options contract is a legally binding agreement between two parties that governs the potential future transaction of that underlying asset at a predetermined price. It is important to distinguish this from the equity or debt securities we have discussed previously, as an option is a bilateral contract rather than a simple issuance of ownership or debt. Every options contract involves two distinct parties, the buyer and the seller. The buyer, also referred to as the holder, pays a sum of money known as the premium to acquire specific rights. These rights allow the holder to either buy or sell the underlying security at a fixed price, but they are not obligated to do so. Conversely, the seller, often called the writer, receives the premium in exchange for taking on obligation. If the buyer decides to exercise their right, the seller must fulfill their end of the contract, regardless of whether the market price makes the transaction unfavorable for them. This dynamic creates a zero-sum environment where the gain of one party is the loss of the other. The standardized nature of these contracts is what allows them to be traded efficiently on public exchanges. Each standard equity option contract represents exactly 100 shares of the underlying stock. Within the contract, several fixed variables define the terms of the agreement. The first is the strike price, which is the specific price at which the underlying stock can be bought or sold if the option is exercised. The second is the expiration date, which represents the point in time when the contract ceases to exist. Most equity options have a lifespan of 9 months or less, making them short-term instruments compared to long-term bonds or perpetual equity. Understanding the terminology of being long or short is critical to navigating options questions. When an investor buys an option, they are long the contract, meaning they have paid the premium and hold the right to exercise. When an investor writes an option, they are short the contract, meaning they have collected the premium and are now on the hook to perform if called upon. The premium itself is determined by market demand and the volatility of the underlying stock, and it represents the maximum amount a buyer can lose and the maximum amount a seller can gain. This relationship between rights, obligations, and premiums forms the foundation for all complex trading strategies. We can categorize these contracts into two primary types: calls and puts. A call option grants the holder the right to purchase the underlying stock at the strike price, which is a position typically taken by investors who believe the stock price will rise. A put option grants the holder the right to sell the underlying stock at the strike price, a position favored by those who expect the stock price to decline. Because these contracts are standardized and traded on exchanges like the Chicago Board Options Exchange, they provide investors with a way to gain leverage or protect existing positions without necessarily owning the shares outright. We will examine the mechanics of these specific types in more detail as we progress. I look forward to continuing this discussion in the next lesson. Welcome back. When an investor decides to go long on an option, they are purchasing the right, but not the obligation, to perform a specific action before a predetermined expiration date. In the context of the SIE exam, buying an option is synonymous with being a holder or an owner, and this position requires the payment of an upfront cost known as the premium. This premium represents the maximum amount of money the investor can lose, regardless of how the underlying market behaves. By paying this cost, the buyer essentially acquires leverage and protection, as their financial risk is strictly capped at the amount paid for the contract. We must distinguish between the two primary types of long positions, the long call and the long put. Each serves a different market outlook and carries its own distinct calculation for profit and loss. Buying a call option is a bullish strategy where the investor expects the price of the underlying security to rise significantly above the strike price. Since the buyer has the right to purchase the stock at a fixed price, a higher market price allows them to acquire the asset for less than its current value or simply sell the contract for a profit. To find the break-even point for a call buyer, you simply add the premium paid to the strike price of the option. For example, if an investor buys a 50 call for a premium of 3, the break-even point is 53. Any market price above 53 at expiration results in a net gain for the investor. Because there is theoretically no limit to how high a stock price can climb, the maximum gain for a long call is considered unlimited. The financial risk for a call buyer is quite different from that of a short seller or a margin trader, because it is entirely quantifiable at the time of purchase. If the stock price remains at or below the strike price until the option expires, the contract will finish out of the money and become worthless. In this scenario, the investor simply loses the entire premium paid to the seller and nothing more. This maximum loss occurs when the market fails to move in the direction the buyer anticipated. It is important to remember that for the buyer, the loss cannot exceed the cost of the contract, which provides a defined risk profile. This makes the long call an attractive instrument for those who want to speculate on upward movement without the open-ended risk of some other strategies. Conversely, buying a put option is a bearish strategy used when an investor anticipates that the price of the underlying security will decline. The buyer of a put pays a premium for the right to sell the stock at the strike price, which becomes valuable if the market price drops below that level. The break-even point for a put buyer is calculated by subtracting the premium from the strike price. If an investor buys a 50 put for a premium of 4, the break-even point is 46. This means the investor needs the stock to drop below 46 to realize a net profit after accounting for the initial cost of the option. Unlike a call, a put has a finite maximum gain because a stock price cannot drop below 0. The maximum gain for a long put is realized if the underlying stock becomes completely worthless, effectively falling to a price of 0. In this specific case, the investor would exercise their right to sell the stock at the strike price while the market value is 0, and then subtract the premium originally paid. Using our previous example of a 50 put bought for 4, the maximum gain would be 46 per share, or $4,600 for a standard contract. The maximum loss for the put buyer is, once again, the premium paid for the contract. This loss occurs if the stock price stays at or above the strike price, leaving the investor with no incentive to exercise the right to sell. The contract expires worthless, and the investor walks away having lost only the initial capital invested in the premium. Summary calculations for these long positions are essential for the exam, as you will often be asked to identify the specific price at which an investor starts making money. For calls, remember the mnemonic call up, which reminds you to add the premium to the strike price to find the break-even. For puts, think put down, indicating that you subtract the premium from the strike price. Understanding these boundaries allows you to quickly determine the viability of a trade based on market movement. Whether the investor is bullish or bearish, the common thread in long options is the limited risk nature of the investment. Success depends entirely on the underlying security moving past the break-even point before the clock runs out on the contract's life. See you in the next lecture. Welcome back. When you move from the perspective of an options buyer to that of a writer, you shift from acquiring rights to assuming obligations. Writing a call or a put is essentially the act of selling a contract that you do not already own, a process often referred to as opening a short position. In exchange for taking on the risks associated with these obligations, the writer receives an immediate cash payment, known as the premium. This premium represents the maximum potential profit for the writer, which is a fundamental distinction from the unlimited profit potential available to long holders. Understanding the motivations and mechanics of the short side is critical for grasping how market liquidity and income strategies function in professional trading. Writing a call option creates an obligation to sell the underlying security at the strike price if the contract is exercised by the holder. From a structural standpoint, the writer is taking a bearish or neutral stance, betting that the stock price will not rise significantly above the strike price before expiration. If the stock price remains below the strike price, the option expires worthless, and the writer keeps the entire premium as profit. However, if the stock price rises sharply, the writer faces the risk of being forced to sell shares at a price much lower than the current market value. For an uncovered or naked call writer, this risk is theoretically unlimited because there is no ceiling on how high a stock price can climb. To mitigate the extreme risk of writing calls, many investors engage in writing covered calls, where the writer already owns the underlying shares. In this scenario, if the option is exercised, the writer simply delivers the shares they already hold rather than having to buy them in the open market at an inflated price. This strategy is frequently employed as an income generation tool for portfolios that are otherwise static. By collecting the premium, the investor increases the total return on their equity holding, though they effectively cap their upside potential at the strike price. It is a trade-off where the investor accepts limited growth in exchange for immediate cash flow and a small amount of downside protection provided by the collected premium. Writing a put option involves a different set of obligations, specifically the requirement to buy the underlying security at the strike price if the holder chooses to exercise. A put writer is generally bullish or neutral, expecting the stock price to stay above the strike price so that the option expires without value. When you write a put, you are essentially providing insurance to the put buyer, and you're paid a premium for standing ready to purchase the stock. If the stock price falls below the strike price, you will be put the stock, meaning you must buy it at the strike price regardless of how low the market price has dropped. This can result in the writer owning a security at a cost basis significantly higher than the current market rate. The risk profile of a short put is substantial, though unlike the naked call, it is not technically unlimited since a stock price cannot drop below zero. The maximum loss occurs if the underlying stock becomes completely worthless, requiring the writer to pay the full strike price for a bankrupt security. To manage this, writers may use cash-covered puts, where they maintain a cash balance in their account sufficient to fulfill the purchase obligation. This ensures that the writer has the liquidity to meet their contractual commitment without relying on margin or forced liquidations. Investors often use this approach not just for the premium, but as a way to potentially acquire a stock they like at a price lower than the current market value. Every short option position is a bet on time decay and price stability or movement in a specific direction. The writer benefits from the passage of time, a concept known as theta decay, as the extrinsic value of the option erodes every day it remains unexercised. As the expiration date approaches, if the option remains out of the money, the likelihood of exercise diminishes, working in favor of the writer. One must remember that the writer has no control over when an exercise occurs. That right belongs solely to the holder. Once the options clearing corporation assigns an exercise notice to a broker-dealer, who then assigns it to a writer, the obligation is absolute and must be fulfilled according to the terms of the contract. See you in the next lecture. Welcome back. When we discuss options hedging, we are essentially looking at ways to mitigate risk within an existing portfolio. In our previous discussions, we focused on the speculative nature of buying or writing options as standalone positions. But for the SIE exam, you must understand how these contracts interact with underlying stock positions. Hedging is the process of taking an offsetting position in a related security to reduce the risk of adverse price movements. In the context of the equity markets, this usually involves an investor who is already long or short a stock and wishes to protect their capital from significant losses. By paying a premium for an option, the investor is essentially purchasing an insurance policy that provides a floor or a ceiling for the price of the security. The most common hedging strategy you will encounter is the protective put. This occurs when an investor who owns shares of a stock, meaning they're long the stock, purchases a put option on that same security. You should recall that a put option grants the holder the right to sell the underlying stock at a specific strike price. If the market value of the stock drops significantly, the investor can exercise the put option and sell their shares at the strike price, regardless of how low the market price has fallen. This effectively limits the investor's downside risk to the difference between the stock's purchase price and the option strike price, plus the premium paid for the option. It allows the investor to remain bullish on the stock's long-term prospects while neutralizing the immediate danger of a market crash. Consider an investor who owns 100 shares of a technology company currently trading at $50 per share. If they are concerned about a potential downturn in the coming months, they might buy a put option with a strike price of $45. If the stock price falls to $30, the investor does not lose $20 per share. Instead, they exercise their right to sell at $45. Their loss is capped at $5 per share, plus the cost of the option premium. This strategy is preferred by those who want to participate in any further upside the stock might offer while ensuring they are not wiped out by a sudden decline. It transforms a position with unlimited downside risk into one with a clearly defined maximum loss. The second major hedging concept is the covered call, though it serves a slightly different primary purpose than the protective put. In a covered call strategy, an investor who is long the stock writes or sells a call option against that stock. Because the investor already owns the shares, the call is considered covered since they can easily deliver the stock if they are assigned. While this strategy provides a small amount of downside protection equal to the premium received, its main function is to generate income and hedge against a neutral or slightly bearish market. If the stock price stays flat or declines slightly, the investor keeps the premium, which buffers the loss on the stock's value or increases the total return on the position. A covered call does, however, limit the investor's upside potential in exchange for this income. If the stock price rises above the strike price of the call option, the investor will likely be assigned and forced to sell their shares at that strike price. This means they will not profit from any price appreciation beyond the strike price of the option they wrote. For example, if an investor owns stock at $50 and writes a $55 call, they effectively agree to sell their stock at $55. If the stock moves to $70, they still only receive $55 per share. You should view the covered call as a way to hedge against stagnation or minor price drops, rather than a way to protect against a catastrophic decline. For the purpose of your examination, you must clearly distinguish between these two behaviors based on the investor's objective. If the goal is total protection against a falling market for a long stock position, the answer is always to buy a put. If the goal is to generate income or provide a modest hedge in a stable market, the answer is to write a covered call. You might also see scenarios involving short stock positions where an investor wants to hedge against a price increase. In that case, the appropriate hedge is to buy a call option, which allows the investor to buy back the shares at a fixed price to close their short position. This ensures that even if the stock price skyrockets, the investor has a guaranteed purchase price to limit their losses. See you in the next lesson. Hello, and welcome back to our survey of the options market. Understanding how options settle requires us to look past the initial trade execution and focus on what happens when a contract is exercised. Unlike the purchase of the option itself, which settles on the next business day, T+1, the exercise of an equity option follows the settlement rules of the underlying stock. When a holder of a call option decides to exercise their right to buy, or a put holder decides to sell, they're initiating a transaction in the actual shares of the company. In the current regulatory environment, the standard settlement for corporate securities is 2 business days after the exercise date, commonly referred to as T+2. This distinction is vital for the exam because a student must differentiate between the settlement of the option contract's premium and the settlement of the shares resulting from an exercise. If you buy an option on Tuesday, you pay for it on Wednesday, but if you exercise that same option on Tuesday, the delivery of shares and the payment for those shares do not occur until Thursday. The mechanics of this process are managed by the Options Clearing Corporation, or OCC, which acts as the central clearinghouse for all exchange-listed options. The OCC is the issuer and guarantor of every option contract, which effectively eliminates counterparty risk for participants in the market. When an investor wants to exercise an option, their broker-dealer submits an exercise notice to the OCC. The OCC does not track which specific writer sold the option to which specific buyer. Instead, it maintains a massive pool of open short positions. Once the OCC receives an exercise notice, it must assign that notice to a broker-dealer that has clients with short positions in that same series. This assignment is performed on a random basis to ensure fairness and prevent any preferential treatment among clearing members. After the OCC has randomly assigned the exercise notice to a broker-dealer, that firm must then assign the notice to one of its specific customers who is short the option. Broker-dealers are permitted more flexibility in their internal assignment methods than the OCC is. While they may use a random selection process similar to the OCC, they're also permitted to use a first-in, first-out, or FIFO method. Regardless of which method the firm chooses, it must be consistent and fair, and the firm must inform its customers of the method it employs. It is important to note that a firm cannot use a size-based assignment method, where they only assign notices to customers with the largest short positions. This ensures that every writer of an option, regardless of the size of their position, bears a proportionate risk of being assigned at any time before the contract expires. Most investors do not hold their options until expiration or exercise them, as they prefer to close out their positions in the secondary market. However, if an option is in the money by at least 1 cent at the time of expiration, the OCC employs a procedure known as exercise by exception. This means that the OCC will automatically exercise the contract on behalf of the holder unless the holder has specifically instructed their broker-dealer not to do so. This protects the investor from losing the intrinsic value of the contract simply because they forgot to submit exercise instructions on the final day of trading. From the perspective of the writer, this underscores the reality that being short an in-the-money option at expiration almost certainly results in assignment. The financial obligation for the writer must be met according to the T+2 timeline for the resulting stock delivery. Specific time frames are also tested frequently, such as the cutoff times for trading and exercise instructions on the expiration date. Options typically stop trading at 4 p.m. Eastern Time on the third Friday of the expiration month. However, the holder of the option has slightly more time, usually until 5:30 p.m. Eastern Time, to submit an exercise notice to their broker-dealer. The contract itself technically expires at 11:59 p.m. Eastern Time that same night. These precise timestamps matter because market-moving news can occur shortly after the market closes, and a holder might decide to exercise based on that news even if the last trade occurred at a different price. Understanding these windows of opportunity is a key part of mastering how the OCC governs the final moments of an option contract's life cycle. I hope this clarified the operational side of the options market for you. I will see you in the next lecture. Welcome back. It is time to verify that the mechanics of calls and puts are becoming intuitive for you. Let's solidify our knowledge with a short quiz regarding the obligations and rights of options participants. An investor is concerned about a significant decline in the value of a broad-based stock portfolio over the next 3 months. Which of the following strategies would provide the most effective hedge for this position? A. Buying call options on a broad-based index. B. Selling call options on a broad-based index. C. Buying put options on a broad-based index. D. Selling put options on a broad-based index. Please pause the video now and think about the correct answer based on the hedging principles we have discussed. The correct answer is C. Buying put options on a broad-based index. Hedging is an exercise in risk management where one takes an offsetting position to protect an existing asset. In this scenario, the investor owns a portfolio, meaning they're long the market and at risk if prices fall. To protect against a downside move, the investor needs a position that gains value as the market declines. Buying a put option provides exactly this mechanism, as the put increases in value when the underlying index drops. This is often referred to as protective put hedging, with a premium paid for the option acts as an insurance policy. If the market crashes, the gains from the put option or the right to sell at a fixed strike price will offset the losses sustained in the actual stock portfolio. The other choices presented do not provide the same level of comprehensive protection for a long position. Selling a call option, known as a covered call if the stock is owned, provides only limited protection equal to the premium received. If the market drops significantly, The small income from the premium will not be enough to cover the loss in the portfolio value. Selling a put option would actually increase the investor's risk, as it obligates them to buy more stock at a fixed price if the market falls, compounding their losses. Buying a call option is a bullish strategy that would only benefit the investor if the market went up, which is the opposite of what a hedge is intended to do in this context. When calculating the outcome of such strategies, we must always consider the break-even point and the role of the options clearing corporation. The OCC acts as the issuer and guarantor of these contracts, ensuring that if our hedge is successful and we choose to exercise or sell the contract, the counterparty will fulfill their obligation. Remember that the break-even for a long put is the strike price minus the premium paid. Any drop below that break-even point represents a net gain that protects the investor's overall wealth. We also distinguish between intrinsic value, which is the in-the-money amount, and time value, which represents the remaining life of the contract. I look forward to seeing you in the next section. Hello and welcome back. Mutual funds represent a significant portion of the investment landscape, operating as open-end management companies under the Investment Company Act of 1940. When you participate in a mutual fund, you are essentially pooling your capital with other investors to purchase a diversified portfolio of securities managed by a professional investment advisor. This structure allows individual investors to access professionally managed, diversified portfolios that would be difficult to construct on an individual basis with limited capital. Unlike individual stocks that trade on an exchange, mutual funds are continuous primary offerings. This means the fund itself issues new shares whenever an investor wants to buy and redeems them when an investor wants to sell. Because these shares are constantly being created and liquidated by the issuer, mutual funds do not trade in the secondary market. The organizational structure of a mutual fund is composed of several distinct entities, each with a specific fiduciary or operational role. At the top sits the board of directors, which is responsible for the overall governance of the fund rather than its day-to-day trading activities. At least 40% of these directors must be independent or non-interest individuals to ensure the protection of shareholder interests. The investment advisor is then contracted by the board to manage the portfolio, making the actual buy and sell decisions based on the fund's stated objective. Additionally, a custodian is required to hold the fund's assets, such as cash and securities, for safekeeping. This separation of duties ensures that the entity managing the money does not have physical possession of the assets, providing a necessary layer of protection against fraud or mismanagement. While the investment advisor handles the portfolio, the transfer agent is responsible for the administrative tasks related to share ownership. The transfer agent issues and cancels shares, distributes dividends and capital gains to shareholders, and maintains the records of who owns the shares. On the distribution side, a mutual fund employs a sponsor, often referred to as a distributor or underwriter, to sell the fund shares to the public. These sponsors may sell shares directly to the public or through a network of independent broker-dealers. It is important to distinguish the sponsor's role in marketing the fund from the advisor's role in managing the assets. This modular architecture allows the mutual fund to function as a cohesive investment vehicle while maintaining clear boundaries between management, custody, and administration. Pricing in mutual funds follows a distinct logic compared to the real-time fluctuations found in the equity markets. The price an investor pays or receives is based on the net asset value, or NAV, which is calculated at least once every business day, typically at the close of the New York Stock Exchange. The NAV is determined by taking the total value of all the fund's assets, subtracting its total liabilities, and dividing the result by the number of shares outstanding. Because mutual fund pricing is done on a forward pricing basis, an order placed at noon will be executed at the NAV calculated at the end of that day. This ensures that all investors buying or selling on the same day receive the same price per share, reflecting the current market value of the underlying portfolio. When investors purchase mutual fund shares, they often pay a public offering price, or POP, which consists of the NAV plus any applicable sales charge. The sales charge is the compensation paid to the underwriter and the broker-dealer for selling the fund to the investor. It is critical to understand that the sales charge is not an expense of the fund itself, but rather an additional cost borne by the investor. According to FINRA rules, the maximum sales charge for a mutual fund is capped at 8.5% of the POP. If a fund does not charge a sales commission, it is referred to as a no-load fund, meaning the NAV and the POP are identical. Even in no-load funds, other operational expenses such as 12b-1 fees for marketing and distribution may still apply, though these are capped at much lower levels. The ongoing operational costs of a mutual fund are expressed through its expense ratio, which compares the fund's operating expenses to its average net assets. These expenses include the investment advisor's management fee, the custodian's fees, the transfer agent's fees, and administrative costs. The management fee is typically the largest component of this ratio, as it compensates the professionals responsible for the fund's performance. A lower expense ratio is generally more favorable for investors, as these costs are deducted directly from the fund's assets and reduce the overall return. It is important to remember that the expense ratio does not include the sales charges mentioned previously, as those are transaction-based rather than operational. Understanding this ratio helps in comparing the efficiency of different management companies within the same asset class. I'll see you in the next lecture. Hello, and welcome back. When we discuss investment companies, we often default to thinking about mutual funds, but the regulatory framework defines several distinct structures. A closed-end fund, or more formally a closed-end management company, operates quite differently from the open-end mutual fund you might already be familiar with. The primary distinction lies in how the shares are issued and subsequently traded among investors. While an open-end fund constantly issues new shares and redeems existing ones, a closed-end fund conducts a single initial public offering. Once those shares are sold to the public, the offering is closed, and no new shares are typically created. This fixed capital structure is the defining characteristic that dictates how the fund interacts with the broader financial markets. Because the number of shares is fixed, an investor who wants to exit their position cannot sell their shares back to the fund complex. Instead, these shares are traded on the secondary market, such as the New York Stock Exchange or NASDAQ, just like common stock in a corporation. This means that if you own shares in a closed-end fund and wish to liquidate your position, you must find another investor willing to buy them through an exchange. Consequently, the fund manager does not have to worry about sudden outflows of cash or forced liquidations of underlying assets to satisfy redemption requests. This stability allows the portfolio manager to invest in less liquid securities or maintain a more consistent long-term strategy without the distraction of daily capital fluctuations. The pricing mechanism of a closed-end fund is another area where it departs significantly from the mutual fund model. An open-end fund is always priced at its net asset value, or NAV, calculated at the end of each trading day based on the value of its holdings. While a closed-end fund also calculates an NAV to provide transparency, the actual price you pay on an exchange is determined by supply and demand. This market price can deviate from the NAV, sometimes trading at a premium and often trading at a discount. If the investing public is pessimistic about a fund-specific sector, the shares might trade for significantly less than the per-share value of the assets held within the fund's portfolio. You should also consider the administrative and operational differences regarding how these products are purchased. When buying a mutual fund, you typically pay the NAV plus any applicable sales charge, and you deal directly with the fund or a distributor. With a closed-end fund, because it is an exchange-traded security, you will likely pay a brokerage commission rather than a sales load. Furthermore, because they trade like stocks, investors can utilize standard market tools that are unavailable with mutual funds. This includes the ability to purchase shares on margin, execute short sales, or use various order types like limit or stop orders to manage entry and exit points throughout the trading day. The capitalization of these funds also allows for more complex financial engineering than what is permitted in the open-end world. Closed-end funds are allowed to issue not just common stock, but also preferred stock and even debt securities like bonds to gain leverage. By issuing these senior securities, the fund can raise additional capital to invest, potentially increasing the returns for the common shareholders if the cost of the leverage is lower than the investment gains. This structural flexibility makes them attractive for specific income-oriented strategies, particularly in the municipal or corporate bond sectors. However, this same leverage introduces additional risk, as it amplifies losses just as it amplifies gains, making the market price more volatile than a non-leveraged equivalent. Finally, it is worth noting that while both open-end and closed-end funds are managed portfolios, their distribution of income remains subject to similar tax regulations. Most closed-end funds elect to be treated as regulated investment companies under Subchapter M of the Internal Revenue Code. This means they must distribute the vast majority of their net investment income and realized capital gains to shareholders to avoid double taxation at the corporate level. From the perspective of the individual investor, the experience of receiving dividends or capital gains distributions will feel very similar to owning a mutual fund. The core difference remains the secondary market liquidity and the independence of the market price from the underlying asset value. I look forward to seeing you in the next lesson. Hello, and welcome back. Exchange-traded funds, or ETFs, occupy a unique space in the financial landscape by combining features of both open-end mutual funds and individual stocks. At its core, an ETF is a type of pooled investment vehicle that tracks a specific index, sector, commodity, or other asset class. While they represent a basket of securities, they're structured as legal entities, specifically open-end management companies or unit investment trusts, that issue shares representing an undivided interest in that basket. Unlike traditional mutual funds, which only price and trade once per day after the market closes, ETFs are listed on exchanges. This allows them to be traded throughout the day at prices that fluctuate based on supply and demand. This structural difference is fundamental to how they are positioned in a client's portfolio, offering the diversification of a fund with the liquidity and flexibility of a stock. Most ETFs are passively managed, meaning their primary objective is to mirror the performance of a benchmark index, such as the S&P 500 or the Russell 2000. Because the goal is index tracking rather than active security selection, these funds typically have lower operating expense ratios compared to actively managed mutual funds. The fund manager is simply purchasing the securities in the same proportions as the target index, which reduces the need for extensive research and frequent trading. However, investors should be aware of tracking error, which is the divergence between the price behavior of the ETF and the price behavior of the underlying benchmark. While generally minimal, this gap can occur due to transaction costs, management fees, or the timing of dividend reinvestments within the fund structure. One of the most significant advantages of ETFs is their intraday price discovery and trading flexibility. Because they trade on secondary markets like the New York Stock Exchange or NASDAQ, investors can execute trades using various order types, including market, limit, and stop orders. Furthermore, since ETFs trade like corporate equities, they can be purchased on margin and are eligible for short selling. This is a sharp contrast to mutual fund shares, which are primary market transactions that cannot be sold short and must be paid for in full when purchased. The ability to enter and exit a position at any moment during market hours makes ETFs a preferred tool for traders who need to react quickly to market volatility or specific news events. The tax efficiency of ETFs is another critical characteristic that distinguishes them from other package products. This efficiency stems from the in-kind creation and redemption process used by authorized participants to manage the fund supply of shares. When a mutual fund manager needs to meet investor redemptions, they often must sell underlying securities, which can trigger capital gains taxes for all shareholders in the fund. In contrast, when an ETF investor sells their shares on the secondary market, they are simply trading with another investor, which does not force the fund to sell its internal holdings. This structure significantly reduces the frequency of capital gains distributions, allowing the investor more control over when they realize tax liabilities. While ETFs offer numerous benefits, they are not without costs and risks that must be understood for the SIE exam. Every time an investor buys or sells an ETF, they may incur a brokerage commission, which is not typically the case with no-load mutual funds. For an investor making small, frequent contributions, these transaction costs can erode the benefit of the low internal expense ratios. Additionally, because ETFs trade on exchange, they are subject to a bid-ask spread. This spread represents the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. In highly liquid ETFs tracking major indices, this spread is usually negligible, but it can become a significant factor in thinly traded or specialized niche ETFs. Finally, it is worth noting that while most ETFs are designed to be long-term core holdings, there are specialized versions that carry much higher risks. Leveraged ETFs use financial derivatives and debt to amplify the returns of an underlying index, while inverse ETFs seek to deliver the opposite performance of a benchmark. These products are generally not intended for long-term buy-and-hold strategies because they typically reset their performance daily. Over longer periods, the effects of compounding on these daily resets can lead to performance that differs significantly from the expected multiple of the index. For the purpose of the exam, simply recognize that the vast majority of the ETF market consists of the traditional, exchange-traded, index tracking products we have discussed today. Goodbye for now, and I will see you in the next lecture. Welcome back. A unit investment trust, or UIT, is a type of investment company that issues redeemable securities representing an undivided interest in a specific, fixed portfolio of securities. Unlike mutual funds or closed-end funds, which we have discussed previously, a UIT is not governed by a board of directors, but is instead established under a trust indenture. This legal structure defines the life of the trust and the specific securities that will be held within it from its inception. Investors purchase units, often called shares of beneficial interest, which entitle them to a proportionate share of the net assets and income generated by the underlying portfolio. Because the trust is not an ongoing corporate entity in the traditional sense, its operations are significantly more mechanical and predictable than other management companies. The primary goal of a UIT is typically to provide a stream of income or capital appreciation through a buy-and-hold strategy rather than through active trading. The most defining characteristic of a UIT is the lack of active management, which distinguishes it from the managed investment companies we often encounter in the markets. Once the portfolio is selected and the trust is created, the securities remain in the trust until it is dissolved or until the securities reach maturity. There is no investment advisor hired to buy and sell securities based on changing market conditions or economic forecasts. This stable nature means that an investor knows exactly what they are owning for the entire duration of their investment. Because there is no active management, the operating costs and management fees are generally much lower than those of a mutual fund. However, the trustee may occasionally sell a security in the event of a significant credit downgrade or a merger involving an issuer, but these events are exceptions rather than the rule. UIT portfolios are typically comprised of either debt securities, such as municipal or corporate bonds, or equity securities. When a UIT consists of bonds, it is often referred to as a fixed income UIT, and its primary purpose is to provide steady interest income to the unit holders. In these cases, the trust will usually hold the bonds until they mature, at which point the principal is returned to the investors and the trust is liquidated. An equity UIT, on the other hand, consists of a basket of stocks that may be selected based on a specific theme, such as high dividend payers or specific industry sectors. Regardless of the underlying assets, the portfolio is static, meaning that the proportions of the various holdings do not change through reinvestment or rebalancing by a human manager. This transparency allows investors to evaluate the credit quality and potential yield of the specific assets before they commit their capital. Because a UIT is designed with a finite lifespan, the trust must eventually reach a termination date specified in the trust indenture. This termination occurs when the last of the bonds in the portfolio matures, or, in the case of equity trusts, on a predetermined date several years after the trust creation. At this point, the trust is dissolved, the remaining assets are liquidated, and the proceeds are distributed to the unit holders. Some UITs offer a rollover option, where investors can take the proceeds from a maturing trust and reinvest them into a new trust series without a full sales charge. This finite nature is a contrast to mutual funds, which are perpetual and can theoretically exist indefinitely as long as there are assets to manage. Investors must therefore plan for the eventual return of their principal and the need to reinvest those funds elsewhere when the trust closes. While units of a UIT are not traded on secondary exchanges like closed-end funds or stocks, they're considered redeemable securities. This means that if an investor needs to exit their position before the trust reaches its termination date, the UIT sponsor is required to buy back the units at their current net asset value. Although the units are redeemable, most sponsors also maintain a secondary market for the units to provide additional liquidity and to keep the trust's assets intact. When a sponsor buys units back and resells them to other investors, they avoid having to sell the underlying securities, which preserves the portfolio's original structure. The price an investor receives upon redemption or sale in the secondary market is based on the current market value of the underlying securities, which may be more or less than the original purchase price. This provides a clear mechanism for liquidity, though the investor remains subject to market risk and interest rate fluctuations throughout the life of the trust. See you in the next lecture. Hello, and welcome back. When we discuss variable annuities, we're looking at a hybrid product that sits at the intersection of insurance and investments. Unlike a fixed annuity, where the insurance company guarantees a specific rate of return, a variable annuity allows the owner to participate in the market's performance. The investor's money is placed into what is known as a separate account, which is distinct from the insurance company's general account. This separate account acts much like a mutual fund, containing various subaccounts that invest in stocks, bonds, or money market instruments. Because the value of these investments fluctuates based on market performance, the investor assumes the investment risk. Consequently, variable annuities are regulated as securities by the SEC and must be sold with a prospectus. The life cycle of a variable annuity is divided into two distinct phases, the first of which is the accumulation phase. During this period, the investor makes payments into the annuity, and these contributions are used to purchase accumulation units. You can think of these units as being mathematically similar to shares in a mutual fund, representing a proportional interest in the separate accounts portfolio. The value of these units varies daily based on the underlying performance of the subaccounts. One significant advantage during this phase is tax deferral, meaning any earnings or capital gains generated within the account are not taxed until they are withdrawn. This allows the investment to compound more efficiently over time compared to a standard brokerage account. If an investor decides to begin receiving income from the contract, they enter the annuitization phase. At this point, the accumulation units are converted into a fixed number of annuity units. While the number of annuity units remains constant throughout the payout period, the actual dollar amount of each monthly check will fluctuate. This fluctuation happens because the value of each unit is recalculated periodically based on the performance of the separate account relative to an assumed interest rate, or AIR. If the actual performance of the account exceeds the error, the next payment will increase. Conversely, if the performance is lower than the error, the payment will decrease, even if the returns were positive. There are several payout options available when an investor decides to annuitize, each offering a different balance of risk and reward. The straight life option provides the highest monthly payout because it only covers the life of the annuitant, with no payments continuing to beneficiaries after their death. This represents the highest risk to the investor's estate, but the highest immediate income. Life with period certain is a common alternative that guarantees payments for the life of the annuitant, but ensures that if they die prematurely, a beneficiary receives payments for the remainder of a specified period, such as 10 years. Joint and last survivor options are often used by couples, ensuring that payments continue as long as either spouse is still living. It is important to understand the tax implications of withdrawing funds from a variable annuity before or during retirement. Since these products are typically funded with after-tax dollars, the contributions represent the investor's cost basis and are not taxed upon withdrawal. However, any growth above that cost basis is taxed as ordinary income, not at the lower long-term capital gains rate. If the investor takes a withdrawal before reaching age 59 and a half, the IRS generally imposes a 10% tax penalty on the earnings portion. Furthermore, most variable annuities include surrender charges, which are fees paid to the insurance company if the investor withdraws money during the early years of the contract. These charges typically decline over a period of 5 to 7 years. Variable annuities also offer insurance-related features that are not found in standard mutual funds, such as a death benefit. If the contract owner dies during the accumulation phase, the insurance company guarantees that the beneficiary will receive at least the original amount invested, even if the market value has declined. This provides a floor of protection for the principal investment during the accumulation years. However, these guarantees and the management of the separate account come with various fees, including mortality and expense risk charges and administrative fees. When evaluating these products for a client, one must weigh the benefits of tax deferral and lifetime income against the higher costs and lack of liquidity associated with surrender periods. I hope this clarifies how these instruments function within a retirement strategy. See you in the next lecture. Welcome back. Let's solidify our knowledge with a short quiz. Which of the following statements correctly describes a characteristic of package products? A. Closed-end funds are always purchased at their net asset value plus a sales charge. B. Unit investment trusts, UITs, feature an actively managed portfolio of securities. C. Exchange-traded funds, ETFs, generally offer higher tax efficiency compared to mutual funds. D. The death benefit of a variable annuity is always subject to a fixed interest rate during the payout phase. Please pause the video and think about the answer. The correct answer is C. Exchange-traded funds, ETFs, generally offer higher tax efficiency compared to mutual funds. Understanding the mechanics of these products requires a clear distinction between how they are structured and how they trade in the secondary market. Statement A is incorrect because closed-end funds trade on exchanges throughout the day, much like common stock. Their price is determined by supply and demand rather than a calculated net asset value, NAV. While a closed-end fund does have an underlying NAV, the market price can be at a premium or a discount to that value. It is the open-end mutual fund that is purchased at the NAV plus any applicable sales charge, typically determined at the end of the trading day. Confusing these two structures is a common pitfall when analyzing investment company products. Statement B is also false because unit investment trusts, UITs, are defined by their unmanaged nature. Once the portfolio of a UIT is selected, it remains relatively fixed until the trust's predetermined termination date. There is no investment advisor making daily buy or sell decisions to outperform the market, which distinguishes UITs from both mutual funds and closed-end funds. This lack of active management usually results in lower operating costs for the investor. If a question suggests that a UIT is actively managed or has a board of directors making frequent adjustments, you can safely eliminate that option. Statement C is the correct answer because of the in-kind redemption process used by ETFs. When investors sell mutual fund shares, the fund manager often has to sell underlying securities to raise cash, which can trigger capital gains for all shareholders. ETFs avoid much of this by exchanging baskets of securities with authorized participants rather than selling them for cash. This structural advantage allows ETFs to minimize taxable events within the fund itself. This efficiency, combined with the ability to trade intraday, makes them a preferred choice for many retail and institutional investors seeking low-cost exposure. Statement D is incorrect because the payout phase of a variable annuity is inherently variable. While a contract might offer a death benefit during the accumulation phase, the actual payments received during the distribution phase depend on the performance of the separate account. There is no fixed interest rate guaranteed during the payout phase. Instead, the number of annuity units remains fixed while the value of each unit fluctuates based on the underlying investments. In contrast, a fixed annuity would offer the stability described in the incorrect statement. Understanding the risk shift from the insurance company to the investor is central to the concept of variable products. See you in the next lecture. Welcome back. When we examine the landscape of investment vehicles, we frequently encounter the standard corporate model, where the entity is viewed as a distinct legal and taxonomic individual. In a typical C corporation, the business earns income, pays corporate taxes on those earnings, and may then distribute dividends to shareholders who pay personal income taxes on that same money. This creates the well-known phenomenon of double taxation, which often complicates the net return for high-capacity investors. Direct participation programs, or DPPs, are designed specifically to bypass this corporate layer by functioning as pass-through entities. By utilizing a legal structure that is not a taxable entity in itself, these programs allow the economic consequences of the business operations to flow directly to the investors. The fundamental architectural feature of a DPP is the concept of flow-through, which applies to both income and systemic losses. In a traditional corporation, if the company loses money, that loss stays within the corporate structure and can only be used to offset the corporation's future gains. However, in a DPP, the business is not a taxpayer. The individual participants are. This means that if the program incurs a loss, that loss is passed through to the investors, who may then use it to offset income from other passive activities. This structural characteristic makes DPPs unique because they allow investors to participate directly in the underlying business's tax benefits and cash flows without the filtration of a corporate tax filing. Most direct participation programs are organized as limited partnerships, though they can also take the form of general partnerships or certain types of corporations that elect specific tax treatments. To qualify for this pass-through treatment, the entity must avoid having too many characteristics of a standard corporation. The Internal Revenue Service looks at several factors, including continuity of life, centralized management, limited liability, and free transferability of interests. Most DPPs deliberately choose to lack at least two of these characteristics, usually continuity of life and free transferability, to ensure they maintain their partnership status for tax purposes. This technical distinction is what legally permits the bypass of corporate-level taxation and establishes the direct link between the program's performance and the investor's tax return. It is important to understand that the flow-through of losses in a DPP is not unlimited and is governed by strict passive activity loss rules. Investors cannot simply use DPP losses to offset their active salary or portfolio income, such as interest and dividends from common stocks. Instead, Losses generated by a DPP are classified as passive losses and can generally only be used to offset passive income from other similar programs. If an investor has $10,000 in passive losses from a real estate DPP, but only $4,000 in passive income from another source, they can only use $4,000 of that loss in the current year. The remaining $6,000 is carried forward to future years until passive income becomes available or the investment is liquidated. While the tax advantages are often a primary focal point, the economic substance of the program must remain the priority. A DPP is an investment in a specific business venture, such as a real estate development or an oil and gas exploration project, and it should be evaluated based on its potential for profit. The IRS can actually challenge the tax benefits of a program if it appears that the entity was created solely for tax avoidance rather than for a legitimate profit motive. Therefore, the flow-through of depreciation, depletion, and tax credits serves as a secondary benefit to the actual cash distributions the program aims to provide. Investors are essentially buying into a business where the accounting gains and losses are mirrored exactly onto their own financial statements. The life cycle of a DPP is typically finite, which distinguishes it from the perpetual existence of a large public corporation. When a program is formed, its offering materials will usually outline a clear objective and a planned dissolution date or event. Because there is no active secondary market for these interests, they're considered highly illiquid assets. An investor cannot simply log into a brokerage account and sell their partnership unit with a click of a button. The difficulty in transferring ownership is one of the features used to prove to the IRS that the entity should not be taxed like a corporation. Consequently, these programs are generally suitable only for investors who have a long-term horizon and can withstand having their capital committed for several years. Beyond the lack of liquidity, the administrative burden of a DPP is higher than that of standard equity investment. Instead of receiving a Form 1099, investors in a DPP receive a Schedule K-1, which provides a detailed breakdown of their share of the entity's income, expenses, and credits. This document is necessary because the investor must report their portion of the partnership's activity on their own tax return. This adds a layer of complexity to the investor's tax preparation, as the K-1 often arrives later in the tax season than standard forms. Despite this complexity, the ability to access specific sectors of the economy through a transparent, pass-through structure remains a compelling option for those seeking direct economic exposure. I'll see you in the next lesson. Hello. It is good to have you back as we continue our look into direct participation programs. A limited partnership is a specific legal and tax structure that allows investors to participate directly in the cash flow and tax consequences of a business venture. Unlike a standard corporation, which is a taxable entity, a limited partnership acts as a conduit or pass-through entity. This means that any income, gains, losses, deductions, or tax credits are not taxed at the partnership level, but are instead flowed through to the individual partners. For the purposes of the SIE exam, the most critical aspect to understand is the rigid division of labor and liability between the two types of partners involved, the general partner and the limited partner. Every limited partnership must have at least one of each to function legally. The relationship between these parties is governed by a partnership agreement, which serves as the foundational document outlining how the business is run and how profits are distributed. The general partner acts as the active manager of the enterprise and assumes a significant amount of responsibility and risk. Because they have full management control, they also have unlimited personal liability for the debts and obligations of the partnership. If the business fails or is sued, the general partner's personal assets can be reached by creditors to satisfy the firm's obligations. Their role involves making all daily operational decisions, such as hiring employees, entering into contracts, and buying or selling property on behalf of the partnership. To compensate for this high level of risk, the general partner typically receives a fee for their management services and maintains a functional fiduciary responsibility to act in the best interest of the limited partners. They are the face of the entity and provide the necessary expertise to execute the partnership's stated business objectives. In contrast, the limited partner occupies a role that is essentially that of a silent investor. Their primary contribution to the partnership is the capital they provide at the outset. One of the most attractive features for a limited partner is that their liability is strictly limited to the amount of money they have invested in the program. If the partnership goes bankrupt, the limited partner might lose their entire investment, but their personal assets, such as their home or bank accounts, remain protected from the partnership's creditors. This trade-off is central to the structure. In exchange for this limited liability, the limited partner must remain passive. They are explicitly prohibited from participating in the day-to-day management of the business. If a limited partner begins to exercise management control, they risk losing their limited liability status and being treated as a general partner by the legal system. While limited partners cannot manage daily operations, they're granted certain rights to protect their investment interests. These are often referred to as partnership democracy rights. Limited partners have the right to inspect the partnership's books and records and receive comprehensive annual reports regarding the financial health of the venture. They also have the voting power on major changes to the partnership's structure or objectives, such as the removal of a general partner or the dissolution of the partnership itself. It is important to distinguish these high-level oversight rights from management. Voting on a fundamental change in the business's direction is a protected right, whereas deciding which vendor to hire for a specific project would be considered management and could jeopardize the partner status. The life cycle of a limited partnership begins with the filing of a certificate of limited partnership in the state where the business is formed. This is a public document that puts the world on notice that the entity exists and identifies the general partners. Investors who wish to join as limited partners must typically complete a subscription agreement. This document acts as an application where the investor discloses their financial situation to ensure they meet the suitability standards for the investment. The general partner then reviews these applications and chooses whether to accept the investor into the partnership. Only after the general partner signs the subscription agreement is the investor officially recognized as a limited partner. This formal process ensures that the partnership remains compliant with its internal rules and regulatory requirements. One of the most significant drawbacks of a limited partnership is the lack of liquidity. These are not like shares of common stock that can be sold instantly on an exchange with the click of a button. Transferring a limited partnership interest usually requires the express written consent of the general partner, and there is rarely an active secondary market for these interests. Investors should approach limited partnerships with a long-term mindset, as they may be required to hold their interest until the partnership is eventually liquidated or reaches its natural conclusion. Furthermore, the tax benefits, while potentially significant, are complex. Limited partners can only use passive losses to offset passive income. They cannot use losses from a limited partnership to reduce their taxable income from wages or active business participation. Finally, you should be aware of the order in which assets are distributed when a limited partnership settles its affairs and dissolves. The liquidation process follows a specific hierarchy of claims to ensure fairness. Secured creditors are always paid first, followed by general or unsecured creditors. Once all outside debts have been satisfied, the limited partners receive their share of the remaining assets, including their initial investment and any unpaid profits. Only after the limited partners have been fully compensated do the general partners receive their remaining share or profits. This priority reinforces the idea that the limited partner is an investor who is owed a return for their capital, while the general partner is the residual owner who bears the ultimate entrepreneurial risk. I look forward to seeing you in the next lecture. Welcome back. When we discuss direct participation programs in the context of real estate, we are examining a structure where the economic consequences of property ownership flow directly through to the investors. Unlike a corporation that pays taxes on its earnings before distributing dividends, a real estate limited partnership allows for the pass-through of both income and losses. This structure is particularly relevant because it enables investors to participate in large-scale property developments that would otherwise be inaccessible to an individual. Within this asset class, we distinguish between different strategies based on the stage of the property's life cycle and the intended goal of the partnership. These strategies include investing in raw land, engaging in new construction, or purchasing existing properties, which are often referred to as income programs. Each of these carries a distinct risk profile and specific tax implications that you must understand for the exam. Raw land investments represent the most speculative end of the real estate DPP spectrum. In this scenario, the partnership purchases undeveloped land with the primary objective of capital appreciation, hoping to sell the land at a later date for a profit after it has been rezoned or developed. From an investment perspective, raw land is unique because it provides no current income and offers no depreciation tax benefits, as land itself is not a depreciable asset. This means there is high negative cash flow since the partnership must pay property taxes and carrying costs without any offsetting revenue. The risk is substantial because the land may not appreciate as expected, or the partnership may be unable to find a buyer when it comes time to exit. Therefore, an investor in a raw land program is essentially making a bet on future valuation rather than seeking immediate tax shelters or income. New construction programs occupy a middle ground of risk between raw land and existing property investments. These partnerships focus on building new structures, such as apartment complexes, shopping centers, or office buildings, from the ground up. The primary objective here is usually capital appreciation, although the potential for future rental income exists once the project is completed. During the construction phase, there is significant risk associated with cost overruns, changes in building codes, or economic shifts that might reduce the eventual demand for the building. Unlike raw land, new construction allows for depreciation once the building is finished and placed into service, providing a tax benefit to the limited partners. It is important to note that these programs typically do not provide immediate cash flow to investors while the project is under development, making them long-term commitments. Existing property programs, often called income programs, are designed for investors who prioritize immediate cash flow and lower risk. These partnerships acquire properties that are already built and, ideally, already occupied by tenants who are paying rent. Because the buildings are established, the partnership can generate income from day one, which is then distributed to the investors after expenses are covered. From a tax standpoint, these programs are quite attractive because they allow for significant depreciation deductions on the existing structures. This depreciation can often offset a portion of the rental income, resulting in tax-sheltered distributions where the investor receives cash that is not immediately taxable. While the potential for dramatic capital appreciation is lower than in new construction or raw land, the stability of established rental income makes this the most conservative real estate DPP option. Public housing and government-assisted housing programs constitute another specialized category of real estate DPPs. These partnerships focus on developing or rehabilitating properties for low to moderate income tenants, often utilizing government subsidies or tax credits to incentivize private investment. The most significant feature of these programs is the availability of Section 42 tax credits, which provide a dollar-for-dollar reduction in the investor's federal tax liability. This is fundamentally different from a tax deduction, which only reduces the amount of income subject to taxation. While the potential for rent increases is limited by government regulation, the tax credits provide a consistent and predictable benefit that lowers the overall risk of the investment. For the exam, remember that tax credits are the primary draw for these specific internal revenue, code-driven programs. Understanding the trade-offs between these programs is essential for correctly identifying which investment suits a particular investor profile. If an investor seeks a tax shelter with immediate income, an existing property program is the logical choice due to high depreciation and established tenants. If they're looking for maximum capital gains and can tolerate high risk and no liquidity or income, raw land is the answer. New construction fits the investor who is willing to wait several years for a potential payoff, but wants the eventual benefit of both appreciation and depreciation. Always keep in mind that all real estate DPPs suffer from a lack of liquidity, as there is no active secondary market for these limited partnership interests. This means an investor must be prepared to hold their interest for the entire life of the partnership, which can often span a decade or more. I will see you in the next lesson. Hello. It is good to have you back for this discussion on specialized investment structures. When we examine direct participation programs, oil and gas ventures represent a significant category that operates quite differently from real estate or equipment leasing. These programs are structured as limited partnerships where the investor's capital is put to work in the exploration, development, or extraction of natural resources. The primary motivation for entering such a program involves a combination of potential high returns and specific tax advantages, such as the depletion allowance and intangible drilling costs. However, the risk profile varies immensely depending on the specific objective of the program. To understand these investments for the SIE exam, we must categorize them into three distinct types: exploratory, developmental, and income programs. Exploratory programs, often referred to as wildcatting, involve drilling in unproven areas where no oil or gas has previously been discovered. Because the partnership is searching for entirely new reservoirs, the likelihood of failing to find a commercially viable amount of fuel is statistically high. If the venture is successful, the returns can be extraordinary because the acquisition cost of the land or mineral rights was likely low before the discovery. Conversely, if the well comes up dry, the investor frequently loses the entirety of their principal investment. These programs are generally considered the most speculative within the oil and gas category due to this binary outcome of total success or total loss. Developmental programs take a more conservative approach by drilling in fields that have already been proven to contain oil or gas reserves. This usually involves drilling near existing, productive wells in hopes that the underground formation extends to the new site. The geological risk is significantly lower than in exploratory programs because the presence of the resource is already established in the immediate vicinity. While the risk of a dry hole is reduced, the potential for high returns is also lower because the rights to drill in proven areas are more expensive to acquire. Investors in these programs are essentially betting on the efficiency of extraction rather than the sheer luck of discovery. Income programs are designed for an entirely different investor profile, focusing on the purchase of existing, producing wells. In this scenario, the partnership does not engage in drilling at all. Instead, it buys the right to the cash flow generated by oil or gas that is already being pumped out of the ground. This eliminates the drilling risk and the high upfront costs associated with exploration or development equipment. The primary risk in an income program is that the well might be depleted faster than anticipated or that the market price of the commodity might drop significantly. These are considered the safest of the oil and gas programs because they provide immediate cash flow to the limited partners. A critical concept to grasp across all these programs is how the tax benefits are passed through to the investor. Intangible drilling costs, or IDCs, include expenses for items that have no salvage value, such as labor, fuel, and surveys. These costs are usually deductible in the first year of operation, providing an immediate tax benefit that is especially attractive to those in high tax brackets. Additionally, there is the depletion allowance, which is a tax deduction that compensates the partnership for the decreasing supply of a natural resource as it is sold. This functions similarly to depreciation in a real estate context, allowing a portion of the income to be shielded from taxation as the asset is used up. You should also be aware of a hybrid approach known as a combination program, which allocates capital across both exploratory and developmental projects. This structure attempts to balance the high reward potential of wildcatting with the steadier, more predictable results of drilling in proven fields. By diversifying the drilling locations and objectives, the partnership mitigates the risk of a total loss while still maintaining some exposure to significant upside. Regardless of the specific type, all oil and gas programs are generally illiquid and require a long-term commitment. The suitability of these investments depends heavily on the investor's need for tax shelters and their ability to withstand the volatility of the energy markets. I hope this clarifies how these various programs are distinguished by their risk and reward profiles. See you in the next lesson. Welcome back. A real estate investment trust, or REIT, is a company that manages a portfolio of real estate assets to earn profits for shareholders. You should think of a REIT as a corporation that acts as a pass-through vehicle for income, allowing individual investors to participate in large-scale, income-producing real estate without having to buy or manage properties themselves. To qualify as a REIT under the Internal Revenue Code, the entity must meet specific requirements, most notably the distribution of at least 90% of its taxable income to shareholders annually. By meeting this threshold, the REIT is not taxed on the portion of income distributed. Those shareholders are responsible for paying taxes on the dividends they receive. It is important to distinguish this from a direct participation program. While REITs pass through income, they do not pass through losses to investors. This means an investor can benefit from the gains, but they cannot use the REIT's operating losses to offset their own personal income tax liabilities. The most common type of REIT you will encounter is the equity REIT, which focuses on the ownership and management of physical properties. These trusts generate revenue, primarily through rent collections from tenants and the capital appreciation realized when properties are sold at a profit. Equity REITs often specialize in specific sectors, such as healthcare facilities, office buildings, shopping centers, or multi-family apartment complexes. From investors' perspective, these are often viewed as a hedge against inflation because property values and rent prices typically rise when the general price level increases. Because the trust owns the underlying assets, the dividends paid to shareholders are derived from the net rental income produced by those assets. For the SIE exam, remember that equity REITs provide a way for retail investors to gain exposure to the professional real estate market with the liquidity of a publicly traded security. In contrast to equity REITs, mortgage REITs do not own physical real estate, but instead invest in the debt associated with properties. These entities loan money to real estate owners or purchase existing mortgages and mortgage-backed securities. Their primary source of revenue is the interest earned on these loans, which is then passed through to the shareholders as dividends. Because their income is derived from interest payments, mortgage REITs are highly sensitive to changes in interest rates and the credit quality of the borrowers. If interest rates rise, the value of the existing mortgages held by the trust may decline, and if borrowers default, the trust's income stream is directly impacted. You might see these referred to as MREITs in industry literature, but the fundamental takeaway is that they represent a credit-based investment rather than a property ownership investment. Hybrid REITs exist as a combination of the two previous structures, holding both physical properties and mortgage loans in a single portfolio. By diversifying across both equity and debt, the managers of a hybrid REIT attempt to balance the steady interest income of mortgages with the appreciation potential of property ownership. This approach allows the trust to mitigate some of the risks specific to either category, such as the total dependence on rental markets or the total exposure to interest rate fluctuations. When evaluating a hybrid REIT, An investor must look at the specific weighting of the portfolio to understand where the majority of the risk lies. For the purposes of the exam, it is sufficient to recognize that the hybrid model seeks to capture both rental income and interest income. This versatility makes them a popular choice for those seeking a more balanced exposure to the real estate sector. REITs are also classified by how they are bought and sold, which significantly affects their liquidity and transparency. Publicly traded REITs are registered with the SEC and trade on major stock exchanges, making them liquid investments that can be sold throughout the trading day. There are also public non-traded REITs, which are registered with the SEC but do not trade on exchanges, making them much harder to liquidate and often subject to higher fees. Finally, private REITs are exempt from SEC registration and are typically only available to institutional or accredited investors. You should be aware that while a REIT provides the benefit of professional management, it also carries risks such as property vacancy, changes in zoning laws, and general economic downturns. Understanding the distinction between these categories and their liquidity profiles is essential for providing suitable recommendations to clients. See you in the next lecture. Hello, it is good to have you back. Let us solidify our knowledge with a short quiz regarding the mechanics and characteristics of direct participation programs. Which of the following is a primary characteristic of a real estate investment trust, REIT, regarding its taxation and structure? A REIT must distribute at least 75% of its taxable income to shareholders annually to avoid corporate taxation. B. A REIT provides investors with the ability to flow through both capital gains and passive losses to their individual tax returns. C. A REIT is considered a direct participation program because it avoids double taxation by passing through at least 90% of its income. D. A REIT must have at least 75% of its assets invested in real estate, cash, or government securities and distribute at least 90% of its taxable income. Please pause the video now to consider your answer before we proceed. The correct answer is D. A REIT must have at least 75% of its assets invested in real estate, cash, or government securities and distribute at least 90% of its taxable income. To understand why this is the correct choice, we must look at the specific statutory requirements that allow a REIT to function as a pass-through entity for income. While REITs share some superficial similarities with limited partnerships, LPs, such as the professional management of pooled capital, they're governed by distinct sections of the tax code. A REIT is not a direct participation program, DPP, because while it passes through gains, it does not pass through losses to the investors. The 90% distribution rule is a strict requirement for the trust to qualify for favorable tax treatment, ensuring that the entity itself is not taxed on the income it distributes to shareholders. Additionally, the 75% asset test ensures the entity remains primarily dedicated to real estate activities rather than general corporate investing. The other options provided contain technical inaccuracies that are likely to appear as distractors on the SIE exam. Option A incorrectly identifies the distribution percentage as 75%, which is actually the asset requirement, not the income distribution requirement. Option B describes the flow-through of losses, which is a hallmark of limited partnerships, but is explicitly prohibited for REITs. Investors in a REIT cannot use the trust's operating losses to offset their own personal income or other passive gains. Option C is a common trap. Although REITs and DPPs both offer a form of pass-through taxation, the industry and regulatory bodies do not classify a REIT as a DPP due to the lack of loss flow-through. When evaluating other types of DPPs, such as oil and gas programs, we must also consider the specific risks and structures involved. For instance, an exploratory or wildcat drilling program carries significantly higher capital risk than an income program that purchases existing wells, because the probability of finding no oil at all is substantial. In these structures, the general partner, GP, serves as the fiduciary and manager, carrying unlimited personal liability for the debts of the partnership. The limited partners, LPs, conversely, have their liability restricted to the amount of capital they have invested or committed. This distinction is vital for any investor considering the trade-off between the tax benefits of intangible drilling costs and the inherent risks of the underlying business venture. I will see you in the next lecture. Hello, and welcome back. When a broker-dealer begins a relationship with a new client, the process is governed by a set of rigorous regulatory requirements designed to ensure that the firm knows exactly who they are doing business with. Every new account starts with the gathering of essential data points, which are codified under FINRA Rule 4512. At a minimum, the firm must obtain the customer's legal name and their residential or business street address, as a post office box alone is generally insufficient for identification purposes. The firm is also required to verify if the customer is of legal age, which is usually 18 in most jurisdictions, and to identify the names of any associated persons responsible for the account. These data points form the foundation of the customer profile and are non-negotiable for the establishment of a legal trading relationship. Beyond the basic identification, the firm must make a concerted effort to gather additional information that speaks to the client's financial situation and investment objectives. This includes the customer's social security number or taxpayer identification number, their occupation, and the name and address of their employer. It is also necessary to determine whether the customer is an associated person of another FINRA member firm, which prevents conflicts of interest and unauthorized private securities transactions. While a customer might choose not to provide some of this information, the firm must document the refusal. However, without a social security number or tax ID, a firm will typically find it impossible to comply with Internal Revenue Service reporting requirements and may refuse to open the account. The industry relies on a specific document known as the new account form to capture this data, and the rules surrounding its completion are quite specific regarding signatures. You might find it counterintuitive, but FINRA rules do not actually require the customer's signature on the standard new account form for a cash account. This is a common point of confusion for those new to the industry, as we often assume the client must sign everything they touch. Instead, the critical signature required is that of the principal, usually a branch manager or an appropriately registered supervisor. By signing the form, the principal is signifying that the firm has performed due diligence and that the account should be accepted based on the provided information. The principal's approval is not a mere formality, but a regulatory hurdle that must be cleared before any activity can take place in the account. This approval marks the official transition from a prospect to a client, confirming that all required information has been verified and that the account type is appropriate for the investor. All of this must happen at or prior to the time the first trade is executed in the account. If a principal finds that the documentation is incomplete or that there are red flags regarding the customer's identity or source of funds, they have a professional obligation to withhold approval. This internal check and balance is what protects the firm from legal and financial liability while maintaining the integrity of the broader capital markets. Once the account is successfully opened, the firm is obligated to send a copy of the account information to the customer within 30 days. This serves as a verification step, allowing the client to review the recorded data for any inaccuracies or omissions. If the customer reports a change in their circumstances, such as a move to a new state or a change in marital status, the firm must update the records and send an updated verification within 30 days of the change. This cyclical process of verification must occur at least once every 36 months to ensure that the firm's understanding of the client's financial profile remains current and accurate. Maintaining up-to-date records is essential for the firm to fulfill its ongoing suitability obligations as the relationship evolves over time. In some cases, a firm may encounter a customer who wishes to maintain a level of privacy by using a numbered account or an alias. This is permitted under specific conditions, provided the firm has on file a signed statement from the customer claiming ownership of the account. Even with a numbered account, the firm is still required to know the true identity of the owner and must have all the standard identification information available behind the scenes. The use of a pseudonym or a number does not exempt the firm or the customer from anti-money laundering regulations or the Know Your Customer rules. The underlying principle remains that while the public might not see the name associated with the account, the regulators and the firm's compliance department must be able to link the account to a real person. I hope this clarifies how the initial onboarding process functions within a regulated environment. See you in the next lecture. Hello, welcome back to our discussion on customer accounts. When a brokerage firm opens an account, the most fundamental distinction is who owns the assets and who has the authority to make trades. An individual account is the simplest form, where one natural person is the sole owner and the only one permitted to control the assets unless they specifically grant power of attorney to another party. In the event of the owner's death, the assets generally pass to the estate unless a transfer on death, or TOD, instruction is on file. This TOD designation allows the owner to name a specific beneficiary who will receive the assets directly, bypassing the often lengthy probate process. It is important to note that while the beneficiary receives the assets upon death, they have absolutely no control over the account while the owner is still alive. Joint accounts move a step further by allowing two or more individuals to share ownership and authority over the account assets. These accounts require a written joint account agreement, and any checks issued from the account must be made out in the names of all the owners. There are two primary ways to structure these: joint tenants with rights of survivorship and tenants in common. In a joint tenants with rights of survivorship account, which is common for married couples, each owner has an undivided interest in the entire account. If one owner passes away, their share automatically transfers to the surviving owner without going through probate. This ensures a seamless transition of the portfolio's management during a difficult time for the family. Tenants in common, or TC, functions quite differently and is often the preferred structure for business partners or friends investing together. In a TIC arrangement, each owner holds a specific percentage of the account assets, which does not have to be an equal split between the parties. If one tenant dies, their specific percentage is not absorbed by the surviving owners, but is instead transferred to the deceased person's estate. This structure provides a layer of protection to ensure that an individual's heirs receive their intended share of the investment. Regardless of the specific type of joint account, any of the owners can typically initiate trades, but significant actions usually require the consent of all parties involved. Corporate accounts introduce a layer of legal complexity because the account owner is a legal entity rather than a natural person. To open such an account, a firm must obtain a copy of the corporate charter and, more importantly, a corporate resolution. The corporate resolution is a document passed by the corporation's board of directors that specifies which individuals are authorized to trade on the corporation's behalf. This prevents unauthorized employees from putting the company's capital at risk without the board's explicit permission. If the corporation intends to trade on margin, the firm must also examine the corporate charter to ensure that such activity is not explicitly prohibited. Accounts for other legal entities, such as partnerships, follow a similar logic to corporate accounts, but with different documentation. A partnership account requires a partnership agreement, which outlines exactly who has the authority to act for the partnership and any limitations on their power. Much like the corporate resolution, this agreement acts as a safeguard for the brokerage firm, ensuring they are taking instructions from the legally recognized representatives of the business. Both corporate and partnership accounts are distinct from the personal assets of the individuals who run the organizations. This separation is critical for tax reporting and legal liability purposes, ensuring that business activities remain isolated from personal finances. Trust accounts are established by a grantor who places assets into a trust for the benefit of one or more beneficiaries, managed by a trustee. The trustee has a fiduciary responsibility to manage the assets in the best interest of the beneficiaries, following the specific instructions laid out in the trust agreement. There are many variations, such as revocable trusts where the grantor can change the terms, and irrevocable trusts where the terms are essentially permanent. The broker-dealer must obtain the trust agreement to verify the trustee's identity and their specific powers regarding investment decisions. This ensures that the person making the trades is legally empowered to do so under the terms of the trust. I will see you in the next lesson. Hello. It is good to have you back as we continue our look into specialized account structures. When a miner needs to own securities, they cannot do so directly because they lack the legal capacity to enter into binding contracts. To solve this problem, we use custodial accounts, which are established under either the Uniform Gifts to Minors Act, known as UGMA, or the Uniform Transfers to Minors Act, known as UTMA. These accounts allow an adult to manage assets on behalf of a minor until a minor reaches the age of majority. While both acts serve the same general purpose, they differ primarily in the types of assets they can hold and the timing of the asset transfer. It is important to remember that these are not joint accounts. There is always exactly one custodian and exactly one minor beneficiary. The minor is the legal owner of the assets from the moment the gift is made, and the custodian merely exercises fiduciary responsibility over those assets. The fundamental rule of a custodial account is that any gift made to the account is irrevocable, meaning the donor cannot take the money back once it is deposited. Because the assets belong to the minor's Social Security number is used for tax reporting purposes, even though the custodian makes all the investment decisions. The custodian has a fiduciary duty to manage the account in a prudent manner, focusing on the benefit of the minor rather than personal gain. Unlike a standard brokerage account, custodial accounts cannot be margin accounts. They must be cash accounts because the minor cannot legally take on debt. Furthermore, the custodian is prohibited from using the account assets to pay for basic legal obligations of support, such as food or clothing, that the parent is already required to provide. The funds must instead be used for the minor's additional benefit, such as education or specialized camps. Between the two types of accounts, UTMA is the more modern and flexible standard adopted by most states. While UGMA accounts are generally limited to bank deposits, stocks, bonds, and mutual funds, UTMA accounts can hold almost any type of asset, including real estate and partnership interests. Another distinction lies in the age at which the minor gains control of the assets, which is often referred to as the age of majority. In an UGMA, the assets must typically be transferred to the minor as soon as they reach the legal age of majority in their state, which is often 18. UTMA allows the state to set a later date for the transfer of assets, sometimes as late as age 25. You should be aware that the beneficiary can sue the custodian if the custodian fails to act in the beneficiary's best interest or fails to transfer the assets on time. Opening a custodial account requires specific registration information that identifies both the custodian and the minor. The account title will typically read something like John Doe as custodian for Jane Doe under the New York UTMA. Only one individual can be named as the custodian, although a donor does not necessarily have to be the custodian. If the custodian dies, a successor custodian must be appointed, which is usually handled by a court or through the designation of the previous custodian's will. Since the minor is the owner, if the minor passes away, the assets in the custodial account become part of the minor's estate rather than reverting to the custodian. This reinforces the principle that the assets are no longer the property of the donor once the account is funded. Taxes on custodial accounts are also a point of frequent discussion because the minor is the taxpayer of record. Any income produced by the account, such as dividends or interest, is reported under the minor's Social Security number and is taxed at the minor's rate up to a certain threshold. However, due to what is often called the kiddie tax, any unearned income above a specific limit may be taxed at the parent's marginal tax rate. This prevents wealthy individuals from shifting large amounts of investment income to their children simply to avoid higher tax brackets. Even though the custodian receives the statements and makes the trades, the tax liability remains with the child. It is the responsibility of the custodian to ensure that taxes are paid out of the account assets or by the minor's legal guardians. Finally, we must consider what happens when a minor reaches the age at which the account must be terminated. At this point, the custodian is required to transfer the registration of the securities into the minor's name. The former minor now has full legal control over the assets and can use them for any purpose they choose, regardless of the custodian's wishes. The firm where the account is held will generally require updated paperwork to transition the account from a custodial format to an individual brokerage account. Failure to execute this transfer in a timely manner is a breach of the custodian's fiduciary duty. You should now have a clear understanding of the roles, limitations, and legal nature of these accounts. I look forward to seeing you in our next session on retirement accounts. Welcome back. We are now going to examine the mechanics of retirement accounts, specifically looking at how the individual and the employer interact with the tax code. Individual retirement accounts, or IRAs, serve as the primary vehicle for personal retirement savings and come in two distinct tax treatments: traditional and Roth. A traditional IRA allows individuals with earned income to make contributions that are often tax-deductible, depending on their income level and participation in employer plans. The core mechanic here is tax deferral, where the investor avoids paying taxes on the principal and growth today in exchange for paying ordinary income tax on all withdrawals during retirement. If an individual withdraws funds before reaching age 59 and a half, they generally face a 10% penalty in addition to the applicable income tax. Conversely, the Internal Revenue Code mandates that participants begin taking required minimum distributions once they reach age 73, ensuring the government eventually collects its deferred tax revenue. Understanding the distinction between the immediate tax break of a traditional IRA and the long-term tax liability is fundamental for the exam. The Roth IRA operates on an inverted tax logic compared to the traditional model, where contributions are made with after-tax dollars. Since no tax deduction is taken up front, the primary benefit is that qualified distributions are entirely tax-free, including all capital gains and dividends accumulated over the years. To qualify for this tax-free status, the account holder must have held the Roth IRA for at least 5 years and be at least 59 and a half years old. Unlike its traditional counterpart, the Roth IRA does not require the owner to take distributions during their lifetime, making it an effective tool for wealth transfer. However, eligibility to contribute to a Roth IRA is subject to income limitations. If an individual earns above a certain threshold, they are legally prohibited from contributing directly. This makes the Roth IRA a specific strategic choice for those who anticipate being in a higher tax bracket in the future. Moving beyond individual accounts, we encounter employer-sponsored plans, which are classified as either qualified or non-qualified under the Employee Retirement Income Security Act, or ERISA. Qualified plans, such as the 401k, must meet strict federal requirements regarding participation, vesting, and communication. In a 401k plan, employees elect to defer a portion of their salary into the plan, often receiving a matching contribution from the employer, which serves as a significant incentive. These contributions are made on a pre-tax basis, effectively lowering the employee's current taxable income while allowing the investments to grow tax-deferred. For the SIE exam, it is important to remember that these plans are intended to be non-discriminatory, meaning they cannot favor only highly compensated employees. The portability of these plans also allows workers to roll over their balances into an IRA if they change employers, maintaining the tax-advantaged status of the assets. Defined benefit and defined contribution plans represent the two major architectural styles of employer-sponsored retirement programs. A defined benefit plan, commonly known as a pension, promises a specific monthly payout upon retirement based on many factors like years of service and salary history. In this arrangement, the investment risk falls entirely on the employer, who must ensure the plan is sufficiently funded to meet future obligations. On the other hand, defined contribution plans, like the 401k or 403b, define only what goes into the account today, not what comes out later. Here, the investment risk shifts to the employee as the final retirement balance depends entirely on the performance of the chosen investments. You should recognize that the modern trend has seen a substantial shift away from defined benefit plans toward defined contribution plans. Finally, we must distinguish between qualified plans and non-qualified plans, as the regulatory and tax implications differ significantly. Non-qualified plans do not have to meet the rigorous participation or non-discrimination rules of ERISA, allowing employers to offer them exclusively to key executives. While they provide tax-deferred growth, the employer cannot claim a tax deduction for contributions until the employee actually receives the benefits. Examples include deferred compensation plans or payroll deduction plans that do not qualify for broader tax advantages. For the purposes of the exam, the key takeaway is that qualified plans offer immediate tax benefits to the employer and broad protections for the employee, whereas non-qualified plans offer flexibility but fewer tax advantages. We will also touch upon 403b plans, which are essentially 401k equivalents designed specifically for employees of public schools and nonprofit organizations. That covers the essential framework for retirement accounts. I will see you in the next lesson. Hello, it is good to see you again as we continue our look into customer account regulations. Anti-money laundering, or AML, is a critical regulatory framework designed to prevent criminals from disguising the origins of illegally obtained funds. In the financial services industry, firms are required by the Bank Secrecy Act to establish internal policies and procedures to detect and report suspicious activity. This is not merely a suggestion, but a legal requirement that places significant responsibility on broker-dealers and their associated persons. The process of money laundering is generally recognized as occurring in three distinct stages: placement, layering, and integration. Understanding these stages is essential because the regulatory reporting requirements often trigger based on activities occurring within these specific phases. When a firm fails to implement a robust AML program, it faces severe legal consequences and poses a systemic risk to the integrity of the capital markets. The first stage of money laundering is placement, which involves the initial entry of dirty money into the financial system. This is often the point where the launderer is most vulnerable to detection because they are attempting to move large amounts of physical cash into a legitimate account. Examples of placement include depositing cash into a brokerage account, purchasing money orders, or using currency to buy sensitive financial instruments. Regulators focus heavily on this stage because it represents the bridge between criminal activity and the financial institution. Firms must monitor for unusual deposit patterns, such as multiple small deposits that seem designed to avoid specific reporting thresholds. If the placement is successful, the illicit funds are no longer sitting in a basement, but are safely held within a regulated institution. Once the funds are in the system, the launderer moves to the second stage, known as layering. The objective of layering is to distance the funds from their original source through a complex series of financial transactions. This might involve moving money between different accounts, purchasing and selling various securities, or transferring funds across international borders. By creating multiple layers of transactions, the launderer hopes to make the audit trail so convoluted that it becomes nearly impossible for investigators to trace the money back to the original crime. For a broker-dealer, Layering might look like a customer frequently switching between unrelated investment products with no clear economic purpose. It is the complexity and frequency of these domestic and international shifts that define the layering process. The final stage of money laundering is integration, where the now processed funds are reintroduced into the economy to appear as perfectly legitimate wealth. At this point, the money is withdrawn from the financial accounts and used to purchase high-value assets like real estate, luxury vehicles, or business investments. Because the funds have been layered through several accounts or instruments, they appear to be sourced from legal investment gains or business dealings. Integration makes it very difficult for law enforcement to distinguish between legitimate capital and laundered funds without an existing lead or an extremely detailed forensic audit. The goal of the criminal is reached when they can spend the money freely without raising suspicion from tax authorities or regulators. Financial professionals must remain vigilant even at this stage, checking for third-party transfers that don't seem to align with a client's stated profile. To assist in the detection of money laundering, the Department of the Treasury requires firms to file specific reports, the most common of which is the Currency Transaction Report, or CTR. A CTR must be filed on FINRA SIE Form 111 whenever a customer deposits or withdraws more than $10,000 in physical currency within a single business day. It is important to note that this rule applies specifically to currency, which includes paper money and coins, rather than personal checks or wire transfers. If a client attempts to circumvent this limit by making multiple smaller deposits that total more than $10,000, this is known as structuring. Firm employees are strictly prohibited from informing a customer that a CTR is being filed or helping them structure transactions to avoid the reporting requirement. Failure to file a CTR or participating in structuring can lead to heavy fines and imprisonment for the individuals involved. While the CTR is triggered by a specific dollar amount of cash, the Suspicious Activity Report, or SAR, is triggered by any activity that seems questionable or lacks a clear business purpose. A firm must file an SAR if a transaction involves at least $5,000 and the firm suspects that the funds are derived from illegal activity or that the transaction is intended to evade regulations. Unlike the CTR, which is a matter of objective accounting, the SAR requires a degree of subjective judgment on the part of the firm's AML compliance officer. Examples of suspicious activity might include a customer providing false information, showing uncharacteristic concern for secrecy, or executing trades that result in consistent losses without concern. When an SAR is filed, the firm is legally forbidden from disclosing its existence to the customer or any party involved in the transaction. This no tipping off rule is vital to ensure that law enforcement can investigate the activity without the suspect being alerted. Every broker-dealer must designate an AML compliance officer who is responsible for overseeing the firm's program and ensuring all employees are properly trained. This program must be tested annually by independent personnel to ensure it remains effective and compliant with evolving FINRA SIE and SEC standards. The AML officer does not necessarily need to be a senior executive, but they must have the authority and resources to implement the necessary controls. Training for employees must occur regularly so that everyone from the front desk to the back office knows how to identify red flags. Documentation of this training and the results of the annual tests must be maintained for regulatory review. By maintaining these rigorous standards, the firm protects itself from being used as a conduit for criminal enterprise. We have touched on the mechanics of money laundering and the primary reports used to combat it. In the next lecture, we will examine more specific scenarios through a quiz. See you in the next one. Welcome back. Let us solidify our knowledge of customer accounts and compliance with a short quiz. A registered representative opens a new joint tenants with rights of survivorship, TROs, account for a married couple. If one spouse passes away, which of the following statements is correct? A. The account assets must be liquidated and the proceeds distributed to the estate. B. The surviving spouse assumes full ownership of the account assets by bypassing probate. C. The deceased spouse's interest in the account passes to their named beneficiaries in a will. D. The account is frozen until a court-appointed administrator determines the asset distribution. Please pause the video now to consider your answer before we proceed. The correct answer is B. The surviving spouse assumes full ownership of the account assets by bypassing probate. In a Stroh's account, all owners hold an undivided interest in the entire account balance, rather than owning specific percentages. When one party dies, their interest automatically transfers to the surviving owner without the need for the assets to pass through a probate court. This is distinct from a tenants in common (TC) arrangement, where a deceased owner's specified share would move to their estate and be distributed according to their will. The SIE exam frequently tests this distinction because it has significant legal and practical implications for how a broker-dealer handles a client's passing. Understanding this avoids the error of assuming all joint accounts are treated the same way under the law. We also must consider the regulatory framework surrounding the opening of such accounts, including the Bank Secrecy Act and anti-money laundering (AML) procedures. Every new account requires the firm to verify the customer's identity and determine if the individual appears on lists of known or suspected terrorists. If an account involves a minor under the Uniform Transfers to Minors Act (UTMA), the assets are owned by the minor but managed by a custodian. These rules, along with the tax implications of individual retirement accounts (IRAs), form the core of your responsibilities when managing customer assets. Remember that contributions to traditional IRAs may be tax-deductible depending on income levels and participation in employer-sponsored plans, whereas Roth IRAs offer tax-free distributions if certain conditions are met. I look forward to seeing you in the next lecture. Welcome back. In this chapter, we turn our attention to the mechanics of margin accounts, a topic that frequently challenges candidates due to its technical nature. You will learn the regulatory framework established by the Federal Reserve, the specific documentation required to open these accounts, and the ongoing maintenance requirements that protect firms from credit risk. Mastery of these concepts is non-negotiable for passing the SIE, as the exam identifies your ability to distinguish between cash transactions and those involving broker-dealer credit. By the end of this section, you'll be able to confidently calculate basic margin obligations and understand how short selling is facilitated through these accounts. Welcome to our discussion on the fundamentals of margin accounts, a critical component of brokerage operations that introduces the concept of financial leverage. When an investor opens a standard cash account, they must pay for all securities purchases in full using their own available funds. A margin account, however, allows a customer to purchase securities by paying only a portion of the total purchase price while borrowing the remainder from the broker-dealer. This arrangement transforms the broker-dealer into a lender, creating a creditor-debtor relationship that is governed by specific federal regulations and industry rules. The primary motivation for using margin is leverage, which enables an investor to control a larger position than their existing cash balance would otherwise allow. The capital used to fund the borrowed portion of a trade comes from the broker-dealer, but the firm itself often sources these funds from a bank. This process is known as rehypothecation, where the customer pledges their securities as collateral to the broker, and the broker, in turn, pledges those same securities to a bank to secure a loan. The interest rate charged to the customer is typically based on the broker call loan rate, which is the rate banks charge broker-dealers for these specific funds. It is important to realize that while leverage can magnify potential gains on an investment, it equally magnifies the potential for losses. If the value of the securities held in the account drops significantly, the investor still owes the full amount of the loan plus interest. Margin accounts are categorized into two primary types: long margin accounts, and short margin accounts. In a long margin account, the customer purchases securities with the intent of holding them, expecting the price to rise, and uses borrowed money to increase their buying power. Conversely, a short margin account is used for short selling, where an investor borrows shares they do not own, sells them at the current market price, and hopes to buy them back later at a lower price. Because short selling involves selling something the investor does not actually own, federal regulations require these trades to be conducted exclusively within a margin account. This ensures there is sufficient collateral and oversight to manage the unique risks associated with speculating on a price decline. Not all securities are eligible to be purchased on margin or used as collateral in a margin account. Generally, exchange-listed stocks and bonds, as well as certain over-the-counter securities, are considered marginable. However, new issues, such as initial public offerings, cannot be purchased on margin for at least 30 days after the offering date. Mutual fund shares are also subject to specific restrictions. While they cannot be purchased on margin, they can typically be used as collateral once they have been held in the account for 30 days. Understanding these distinctions is vital because it determines the liquidity and borrowing capacity of a client's portfolio. We will examine the specific percentages and regulatory limits governing these transactions as we move forward. I look forward to seeing you in the next lesson. Welcome back. When you deal with credit in the securities industry, you aren't looking at a free market of lending, but rather a strictly regulated environment overseen by the Federal Reserve. Regulation T, often simply called Reg T, is the specific rule that governs how much credit a broker-dealer can extend to a customer for the purchase of securities. You should view this as a safeguard designed to prevent the kind of excessive speculation that contributed to historical market crashes. By controlling the amount of leverage a retail investor can use, the Federal Reserve maintains a degree of stability in the financial system. It is important to remember that these rules apply specifically to non-exempt securities, which generally include stocks and bonds traded on national exchanges. The most fundamental aspect of Regulation T is the initial margin requirement, which is currently set at 50%. This means that if a customer wishes to purchase $10,000 worth of stock in a margin account, they must provide at least $5,000 in equity. The remaining $5,000 is effectively a loan from the broker-dealer to the client, for which the client will pay interest. While 50% is the standard established by the Fed, you should be aware that self-regulatory organizations or individual brokerage firms can impose stricter requirements. However, no firm is permitted to be more lenient than the standards set by Regulation T. Timing is an essential factor when discussing these regulations, as the industry differentiates between settlement dates and payment dates. Under standard industry rules, most trades settle on the second business day after the trade occurs, known as T+2. However, Regulation T provides a small buffer for the customer to actually get the funds to the broker-dealer. The official Reg T payment deadline is the fourth business day after the trade date, or T+4. If you think of this in terms of settlement, it is essentially settlement plus 2 additional business days. If a customer fails to meet this deadline, the broker-dealer is generally required to take specific action to rectify the deficit. When a customer does not pay for a trade by the T+4 deadline, the broker-dealer must liquidate the unpaid portion of the transaction. This isn't a discretionary choice for the firm. It is a regulatory obligation to sell out the securities to cover the debt. Furthermore, if such a liquidation occurs, the customer's account will be frozen for a period of 90 days. During this frozen period, the customer is not prohibited from trading entirely, but they are restricted in how they do so. They must have sufficient cash in the account to cover the full cost of any purchase before an order can be executed. This serves as a probationary period to ensure the client can meet their financial obligations without relying on unsettled funds. You should also consider that there are certain exceptions and nuances to how Regulation T is applied in daily practice. For instance, if the amount of money owed is insignificant, specifically $2,000 or less, a broker-dealer may choose not to take action. This is often referred to as the de minimis exception, allowing firms to skip the administrative burden of liquidating very small amounts. Additionally, if the customer has a valid reason for the delay, the broker-dealer can apply to a self-regulatory organization like FINRA for an extension of time. These extensions are not guaranteed and are typically only granted for circumstances beyond the customer's control, such as a physical mail delay or a technical banking error. It is also worth noting that not all securities are eligible for purchase on margin under Regulation T. Most exchange-listed stocks and bonds are marginable, meaning they have a loan value and can be used as collateral. Conversely, new issues, such as those being sold via an initial public offering, cannot be purchased on margin for at least 30 days. This also applies to mutual fund shares, which are always considered new issues since they are continuously offered by the fund. While you can eventually use mutual fund shares as collateral for a loan after holding them for 30 days, you cannot use credit to make the initial purchase. Understanding what can and cannot be used as collateral is as important as knowing the percentage requirements themselves. Finally, you must distinguish between the initial requirement of Regulation T and the ongoing maintenance requirements. Reg T only dictates the amount of money a customer must deposit at the time of the initial transaction in a margin account. Once the trade is established and the initial deposit is made, the Federal Reserve's primary role in that specific transaction concludes. The daily fluctuations of the account and the minimum levels of equity required to keep the position open are governed by different rules, specifically those from FINRA and the individual firms. Regulation T is the gatekeeper for the entry of credit into the transaction, ensuring that every leveraged position starts with a solid foundation of investor equity. See you in the next lesson. Hello, and welcome back to the course. When a customer decides to trade on margin, the relationship between the investor and the broker-dealer becomes more complex than a standard cash account arrangement. This complexity is formally managed through the margin agreement, which is not a single entity, but a collection of specific legal components that define the rights and obligations of both parties. To open a margin account, a customer must sign the margin agreement, which typically consists of 3 distinct sections: the credit agreement, the hypothecation agreement, and the loan consent form. Understanding the specific purpose of each document is necessary for navigating the regulatory landscape of leverage trading. You should view these documents as the structural framework that allows a broker-dealer to lend money while protecting its own financial interests and complying with federal regulations. The credit agreement serves as the primary instrument that outlines the terms of the loan provided by the broker-dealer to the customer. Since margin trading involves borrowing capital to purchase securities, the broker-dealer essentially acts as a lender, and like any lender, they charge interest on the borrowed funds. This document discloses the method of interest computation and the circumstances under which interest rates may change over time. It is a mandatory component of the margin agreement because it ensures the customer is fully aware of the costs associated with maintaining a leveraged position. Without a signed credit agreement, a broker-dealer cannot legally extend credit to a retail client for the purpose of purchasing or carrying securities. The hypothecation agreement is the second mandatory component and relates specifically to the collateralization of the margin loan. When a customer buys securities on margin, those securities serve as collateral for the loan, and the hypothecation agreement gives the broker-dealer a lien on these assets. This agreement allows the broker-dealer to pledge the customer's securities to a bank as collateral for a loan, a process known as rehypothecation, which provides the broker-dealer with the liquidity needed to fund the customer's margin trades. Regulations strictly limit the amount of customer securities a broker-dealer can rehypothecate to 140% of the customer's debit balance. This legal structure ensures that while the customer holds beneficial ownership, The broker-dealer has the right to liquidate assets if the customer fails to meet a margin call or other financial obligations. The third component is the loan consent form, which is notably different from the first two because it is optional rather than mandatory. By signing this document, the customer authorizes the broker-dealer to lend the securities held in the margin account to other customers or broker-dealers. This is frequently used to facilitate short sales, where another investor needs to borrow shares to sell them in the open market with the hope of buying them back at a lower price. While a broker-dealer must obtain a signature for the credit and hypothecation agreements to open the account, they can still open a margin account if the customer chooses not to sign the loan consent form. Most firms include it in their standard margin disclosure package, but it remains a discretionary choice for the investor. Finally, investors must receive a margin disclosure document before or at the time of opening the account, and this must be provided annually thereafter. This disclosure serves to warn the investor about the inherent risks of margin trading, such as the potential to lose more money than originally deposited in the account. It explicitly states that the firm has the right to sell the customer's securities without notice to cover a margin deficiency, and that the customer is not entitled to an extension of time on a margin call. While the credit, hypothecation, and loan consent forms are the legal contracts, the disclosure document is the regulatory mechanism for ensuring informed consent. Mastery of these distinctions allows you to categorize the various legal requirements that govern the extension of credit in the securities industry. Thank you for your time, and I will see you in the next lecture. Hello, and welcome back. When an investor opens a margin account, they initially operate under the constraints of Regulation T. However, once a position is established, the regulatory focus shifts from the Federal Reserve's initial deposit rules to FINRA's ongoing maintenance requirements. These requirements ensure that a minimum level of equity is preserved in the account relative to the fluctuating market value of the securities. Equity is the difference between the current market value of the securities and the amount the customer owes the broker-dealer. As the market value of the securities changes, the equity fluctuates, and if it drops below a specific threshold, the account is subject to a maintenance call. This mechanism serves as a safeguard for the brokerage firm to ensure the loan is sufficiently collateralized at all times. For a long margin account, the FINRA minimum maintenance requirement is set at 25% of the current market value. This means that at any given point, the investor's equity must be at least 1/4 of what the securities are worth on the open market. For example, if a customer holds securities with a market value of $10,000 and has a debit balance of $7,000, their equity is $3,000. Since $3,000 is 30% of the market value, the account is above the 25% minimum. If the market value drops to $8,000 while the debt remains $7,000, the equity falls to $1,000. In this scenario, $1,000 is only 12.5% of the market value, which is below the 25% requirement, triggering an immediate obligation for the customer. Short margin accounts operate under a slightly more stringent set of maintenance rules due to the theoretically unlimited risk associated with rising stock prices. The FINRA minimum maintenance requirement for a short position is 30% of the current market value. Because the investor has borrowed shares to sell them, they want the stock price to decrease. If the price increases, the equity in the account decreases. The calculation of equity in a short account involves adding the initial proceeds of the sale to the Regulation T deposit, and then subtracting the current market value of the shorted stock. If the resulting equity figure falls below 30% of the current market value, the broker-dealer will issue a maintenance call to the investor. When an account falls below these minimum percentages, the broker-dealer issues what is formally known as a maintenance margin call, or sometimes a house call. This is a demand for the customer to deposit additional cash or marginable securities into the account to bring the equity back up to the required minimum. Unlike the initial Regulation T call, which usually allows for a settlement period of 2 business days. Maintenance calls are often due immediately. If the customer fails to meet the call promptly, the brokerage firm has the right to liquidate enough securities from the account to satisfy the deficiency. This liquidation happens at the firm's discretion, and the customer typically does not have the right to choose which securities are sold to cover the gap. It is important to distinguish between the FINRA minimums and what are known as house requirements. While FINRA sets the floor at 25% for long accounts and 30% for short accounts, many broker-dealers impose higher internal standards. A firm might require its clients to maintain 35 or 40% equity as a buffer against volatile market swings. These house requirements are legally enforceable and often lead to maintenance calls before the regulatory minimum is even reached. Investors must adhere to whichever standard is higher, as the firm's policy takes precedence over the lower regulatory baseline. Experience shows that firms rarely provide extensions for house calls, reinforcing the necessity of monitoring account equity daily. Market volatility is the primary driver of maintenance calls, as it directly impacts the denominator in the equity-to-market value equation. In a long account, a declining market value reduces equity dollar for dollar, while the debit balance remains fixed. In a short account, a rising market value increases the cost to repurchase the shares, which simultaneously reduces the equity. Practitioners often calculate the market value at maintenance by dividing the debit balance by 0.75 for long accounts. This formula helps determine the exact price point at which the account will hit the 25% threshold. Understanding these mathematical relationships is vital for managing the risks inherent in leveraged trading environments. In the next lesson, we will examine the specific mechanics and risks associated with short selling. Goodbye for now. Hello, and welcome back. Short selling represents a departure from the traditional approach of buying low and selling high. When an investor takes a long position, they purchase a security in the hope that its price will appreciate over time. Short selling reverses this chronological order, allowing an investor to sell a security first and purchase it later. This strategy is fundamentally bearish, meaning the investor expects the market price of the security to decline. To execute this, the investor must borrow the shares from a broker-dealer, sell them at the current market price, and eventually buy them back to return them to the lender. This closing transaction is known as covering the short position, and the investor profits if the purchase price is lower than the original sale price. The mechanics of borrowing shares involve several specific requirements and parties. Because the investor does not own the shares they are selling, the broker-dealer usually sources them from its own inventory, from another client's margin account, or from another financial institution. This process requires a margin account, as the broker-dealer is essentially extending credit in the form of securities rather than cash. The investor is also responsible for any dividends or interest payments made while the position is open. Since the lender is no longer the holder of record, the short seller must pay these amounts back to the lender to ensure the lender is made whole. This adds a layer of ongoing cost to the strategy that long-term investors do not typically face. Risk management is the most critical aspect to understand when discussing short sales, particularly regarding the potential for loss. In a long position, the maximum loss is limited to the initial investment because a stock price cannot drop below zero. Short selling does not enjoy this mathematical floor because there is no theoretical ceiling on how high a stock price can rise. If a stock price increases significantly, the short seller must still buy those shares back at the higher price to cover the loan. Therefore, the risk associated with a short sale is considered infinite. This is a fundamental concept for the exam, as it distinguishes short selling from almost every other basic investment strategy. Regulation SHO provides the regulatory framework that governs how these transactions must be handled by broker-dealers. One of the primary requirements under this regulation is the locate requirement, which mandates that a firm must have reasonable grounds to believe the security can be borrowed and delivered on the settlement date. A broker-dealer cannot simply execute a short sale without first ensuring the availability of the shares. If a firm fails to locate the shares, it could lead to a naked short sale, which is generally prohibited because it creates a high risk of failure to deliver. Properly managing these locations ensures the integrity of the secondary market and prevents artificial downward pressure on stock prices through shares that do not exist. The motivation for short selling isn't always purely speculative. It can also be used for hedging purposes. For example, an investor might hold a large long position in a specific stock but fear a temporary market downturn. While they may not want to sell their core holding due to tax consequences or long-term belief in the company, they might initiate a short position to offset potential losses. However, the SIE exam primarily focuses on the mechanics and the inherent risks of the bearish stance. You should always associate short selling with the expectation of a price decline and the requirement of using a margin account. Understanding that the investor is perpetually at risk until the shares are returned is vital for answering questions on this topic. I hope this clarification on short selling was useful. See you in the next lecture. Welcome back. Let's solidify our knowledge with a short quiz regarding the mechanics and regulations of margin accounts. An investor opens a new margin account and wishes to purchase 100 shares of XYZ stock at $30 per share, according to Regulation T, and assuming no other activity in the account. How much cash must the investor deposit? A. $750. B. $1,500. C. $2,000. D. $3,000. Please pause the video now to consider your answer before we proceed to the explanation. The correct answer is C. $2,000. The determination of the required deposit for a margin purchase relies on a hierarchy of rules established by the Federal Reserve and FINRA. Under Regulation T, the standard initial requirement is 50% of the purchase price, which in this case would be $1,500. However, FINRA imposes a minimum equity requirement for new accounts that often overrides the 50% calculation when the purchase is small. For any initial purchase in a margin account that is between $2,000 and $4,000, the investor must deposit at least $2,000. Since 50% of $3,000 is only $1,500, the $2,000 minimum equity rule takes precedence. If the purchase had been less than $2,000, the investor would have been required to pay for the securities in full. Understanding this hierarchy is essential for correctly calculating the leverage available to a client. We must distinguish between the initial margin requirement, which governs the first trade, and the maintenance margin, which governs the ongoing value of the account. Maintenance margin for a long position is typically 25% of the current market value, while Regulation T applies only to the initial transaction. Furthermore, margin accounts require specific documentation before any trading can occur. This includes the credit agreement, which details the terms of the loan, and the hypothecation agreement, which allows the broker-dealer to use the securities as collateral. In short selling, which must always occur in a margin account, the investor faces unique risks and requirements since they are borrowing shares rather than cash. I will see you in the next lecture. Hello, it is good to see you back. To understand how securities trade, we must first categorize the environments where these transactions occur. We typically divide the secondary market into 4 distinct tiers or markets. The first market refers to traditional stock exchanges, such as the New York Stock Exchange or NASDAQ, where listed securities are traded in an auction or negotiated format. These are centralized locations, whether physical or electronic, that provide a high degree of transparency and liquidity. When a company meets the specific listing requirements of an exchange, its shares trade here, and the exchange itself acts as a regulator to ensure fair and orderly markets. Operating within this tier requires strict adherence to reporting rules, ensuring that every trade is publicly documented almost instantly. The second market is the over-the-counter or OTC market, which handles unlisted securities. Unlike the first market, the OTC market is a decentralized inter-dealer network where trading happens over the phone or through computer networks. There is no physical floor. Instead, market makers compete by posting bid and ask prices for stocks that do not meet the stringent requirements for exchange listing. This includes a vast array of bonds, most notably municipal and corporate debt, as well as the pink sheets or OTC bulletin board stocks. Because it is a negotiated market rather than an auction market, the price discovery process is fundamentally different, relying on the quotes provided by individual dealer firms rather than a central order book. Moving beyond these traditional structures, we encounter the third and fourth markets, which serve specific institutional needs. The third market involves exchange-listed securities trading over the counter. This happens when institutional investors want to trade large blocks of listed stocks away from the exchange floor. By using a dealer in the OTC market to facilitate a trade of listed shares, participants can sometimes achieve better execution or lower costs. The fourth market is even more specialized, consisting of direct institution-to-institution trading without the mediation of a broker-dealer. This is often executed through electronic communications networks, or ECNs, which allow large entities like pension funds or insurance companies to trade anonymously and avoid the fees associated with traditional intermediaries. Electronic communications networks have fundamentally changed the landscape of modern market centers by automating the matching of buy and sell orders. An ECN is essentially a digital system that pairs subscribers' orders to execute trades, often operating 24 hours a day. These systems are highly efficient because they eliminate the middleman spread that a market maker would usually capture. Instead of buying from a dealer's inventory, a buyer on an ECN is matched directly with a seller who has a matching price. This structure provides significant benefits for high-volume traders, including increased speed of execution and a reduction in the market impact that a large, visible order might otherwise cause on a traditional exchange. Understanding these market centers requires recognizing the distinction between auction markets and negotiated markets. On the floor of an exchange like the NYSE, the process is driven by an auction where multiple parties compete publicly for the best price. In contrast, the OTC market is a negotiated environment where a buyer or seller deals directly with a market maker. Understanding which securities trade in which market center is vital for the SIE, as the regulatory requirements and the roles of the participants vary depending on the venue. While the boundaries between these markets have blurred due to technology, the fundamental definitions remain the basis for most regulatory questions regarding trade execution and market structure. I look forward to continuing this discussion with you in the next lesson. Hello. It is good to have you back for this discussion on the mechanics of secondary market participants. In a secondary market, liquidity does not simply materialize out of thin air. It requires specific participants who are willing to take the opposite side of a trade at any given moment. These participants are known as market makers, and they serve as the backbone of many exchange and over-the-counter environments. A market maker is a broker-dealer that has committed to maintaining an inventory of a particular security and providing continuous buy and sell prices for that security to the public. By standing ready to buy or sell from their own inventory, they ensure that a retail investor or an institution can execute a trade without waiting for another individual investor to appear with a matching interest. This commitment to hold a position and risk their own capital is what distinguishes them from a standard broker who merely facilitates a match between two third parties. The presence of a market maker is primarily measured by the liquidity they provide to the market which is the ease with which a security can be converted into cash without a significant impact on its price. In a highly liquid market, there are many market makers competing with one another, which typically results in narrower spreads and higher volume. If a market maker fails to provide these services or withdraws their quotes, the market for that specific security can become illiquid, making it difficult for investors to enter or exit positions. Market makers are obligated to display a two-sided quote, which consists of a bid price and an ask price. This continuous quoting requirement ensures that there is always a benchmark price available for the security, which provides essential transparency and stability to the broader financial ecosystem. To understand the economics of a market maker, we must examine the bid and the ask prices in detail. The bid price is the highest price the market maker is willing to pay to purchase a security from a seller, while the ask price, or the offer, is the lowest price at which the market maker is willing to sell that security to a buyer. A common point of confusion for those new to this field is whose perspective these prices represent. It is helpful to remember that the market maker always buys at the low price and sells at the high price. From the perspective of a retail investor looking to trade, you will sell your shares to the market maker at their bid price and buy shares from them at their ask price. The difference between these two figures is known as the bid-ask spread, and it represents the primary way a market maker earns a profit for providing liquidity. Because the market maker takes on the risk of holding securities that could decline in value and incurs the cost of maintaining a trading infrastructure, the spread acts as a fee for their services. For example, if a market maker quotes a stock at 20.10 bid and 20.15 ask, the spread is $0.05. If they buy 1,000 shares at the bid and immediately sell them at the ask, they capture that 5-cent difference per share. In a competitive market, market makers with the narrowest spreads are more likely to attract order flow, which naturally incentivizes them to keep the cost of trading low for the public. Market makers are also required to quote a size alongside their bid and ask prices, which indicates the number of shares they are willing to trade at those specific prices. This is typically expressed in round lots, where one lot represents 100 shares. If you see a quote of 25.50 to 25.60 with a size of 10 by 5, it means the market maker is willing to buy 1,000 shares at 25.50 and sell 500 shares at 25.60. These quotes are considered firm for the specified size, meaning the market maker is legally obligated to execute a trade at those prices up to the quoted amount. Failing to honor a firm quote is a violation of industry rules known as backing away, which can lead to significant regulatory penalties for the firm. The role of the market maker is fundamental to the efficiency of the capital markets, as they bridge the gap between disparate buying and selling interests. Without them, the market would rely entirely on spontaneous synchronization of buyers and sellers, which would lead to extreme price volatility and uncertainty. By acting as a principal in the transaction, the market maker absorbs the temporary imbalances in supply and demand. They do not act based on a long-term investment thesis like a retail investor might. Rather, they are focused on the rapid turnover of inventory and the collection of spread. This neutral, utility-like function allows the secondary market to operate predictably and provides the confidence necessary for participants to engage in frequent trading. Good luck with your studies, and I will see you in the next lesson. Hello, and welcome back. To understand how securities transactions are executed, we must first examine the capacity in which a financial institution operates. A broker-dealer can function in two distinct roles, as a broker or as a dealer. While the term broker-dealer suggests a single entity, the firm cannot act as both a broker and a dealer in the same transaction. This distinction is fundamental because it dictates how the firm interacts with the market whose inventory is being used and how the firm is compensated for its services. When a firm acts as a broker, it is acting as an agent, whereas acting as a dealer means it is acting as a principal. When a firm operates in an agency capacity, it functions as a middleman or a broker. In this scenario, the firm does not own the securities being traded. Instead, it locates a buyer for a seller or a seller for a buyer. You can think of this much like a real estate agent who facilitates a transaction between two private parties without ever taking ownership of the house. Because the firm is simply facilitating the trade between two other market participants, it does not take on any market risk. Its primary goal is to find the best price for its client and execute the trade efficiently. For this service, the firm charges a commission, which must be clearly disclosed to the customer. Operating as a principal is a fundamentally different arrangement where the firm acts as a dealer. In this capacity, the firm trades for its own account and maintains an inventory of securities. When a customer wants to buy a stock, the dealer sells it directly from its own inventory. When a customer wants to sell, the dealer buys the security to add to its inventory. This means the firm is taking on significant market risk because the value of the securities in its warehouse can fluctuate. Dealers provide liquidity to the market by being ready to buy or sell at any given time. Instead of a commission, a dealer earns a profit through a markup when selling to a customer or a markdown when buying from a customer. The mechanics of dealer pricing involve two specific quotes, the bid and the ask. The bid price is the highest price the dealer is willing to pay to buy a security from a seller. Conversely, the ask price, or the offer, is the lowest price at which the dealer is willing to sell that security to a buyer. The difference between these two prices is known as the spread, and this spread represents a portion of the dealer's potential profit margin. For example, if a dealer quotes a stock at $20 bid and $20.10 ask, they are willing to buy from you at $20 and sell to you at $20.10. As a principal, the firm's compensation is embedded in these prices rather than added as a separate line item fee. The distinction between these two roles is often abbreviated with the mnemonic ABC, which stands for agency, broker, and commission. This serves as a reminder that when a firm acts as an agent, it is a broker charging a commission. On the other side, you have principal, dealer, markup/markdown, or PDM. If you remember these two groupings, you can easily identify the firm's capacity and the associated compensation structure. It is also important to note that the firm's role must be disclosed on the trade confirmation sent to the customer after the trade occurs. This transparency ensures the client understands whether the firm was an intermediary or the actual counterparty to the trade. Choosing between acting as a broker or a dealer often depends on the liquidity of the security and the firm's specific business model. In highly liquid markets, firms may frequently act as brokers, simply matching orders in the marketplace. In less liquid markets, a firm may need to step in as a dealer to ensure that trades can actually happen, providing its own capital to facilitate the movement of securities. Regardless of the role chosen for a specific trade, the firm has a duty to provide best execution for its clients. Understanding these capacities allows you to see the underlying incentive structures that drive market behavior and firm profitability. See you in the next lecture. Hello, and welcome back. When we discuss secondary market trading, we often visualize a transparent exchange where every bid and offer is visible to the public in real time. While this describes the lit markets like the New York Stock Exchange, it does not account for the significant volume of trading that occurs away from public view. Dark pools are private platforms or forums for trading securities that do not provide a public order book. In these venues, the details of a trade are only made public after the transaction is executed, meaning that the pre-trade transparency found on traditional exchanges is absent. This lack of transparency is not a matter of trying to circumvent the law, but rather a structural feature designed to facilitate specific types of transactions for sophisticated participants. The primary users of dark pools are institutional investors, such as mutual funds, pension funds, and insurance companies, who frequently need to trade large blocks of stock. In the context of the securities industry, A block trade is typically defined as an order for at least 10,000 shares or a total market value of $200,000 or more. If an institutional manager attempted to sell 1 million shares of a liquid stock on a public exchange, the sudden appearance of such a massive sell order would likely cause the price to drop before the trade could be fully executed. By using a dark pool, the institution can seek a buyer for that large block without alerting the broader market to their intentions, thereby minimizing the negative price impact caused by their own trading activity. Execution within a dark pool operates differently than the continuous auction process of a traditional exchanges. Because there is no public quote, the prices in a dark pool are usually derived from the National Best Bid and Offer, or NBBO, provided by the lit markets. This ensures that even though the trade is hidden from the public eye during the matching process, the participants still receive a price that is pegged to the current fair market value. One of the common criticisms of this system is that it creates a fragmented market where price discovery becomes more difficult because a significant portion of the liquidity is not visible. However, for the institutions involved, the benefit of reduced transaction costs and less market impact outweighs the disadvantage of reduced transparency. Regulation plays a critical role in ensuring that these private venues do not become a detriment to the overall health of the financial system. While they are dark in terms of pre-trade visibility, they are still highly regulated by the SEC and must comply with reporting requirements once a trade occurs. Most dark pools are operated by large broker-dealers who match buy and sell orders internally or by independent companies providing an alternative trading system. These operators must ensure that they are providing fair access and that their operations do not disadvantage the public markets. Even though the initial order is hidden, the completed trade must be reported to the consolidated tape, ensuring that the post-trade data eventually integrates with the rest of the market. You should understand that dark pools represent a trade-off between market transparency and execution efficiency for large-scale participants. While a retail investor might never interact directly with a dark pool, the existence of these venues affects the overall liquidity and price stability of the stocks they own. By providing a hidden venue for block trades, dark pools prevent the volatility that would otherwise occur if every institutional move was broadcast to the world instantaneously. This segmentation of the market allows different types of participants to choose the venue that best fits their specific needs, whether that is the high transparency of an exchange or the privacy of a dark pool. Knowing the distinction between these venues is essential for understanding how capital flows through the secondary market. I will see you in the next lesson. Hello. Let's pick up where we left off and examine how the markets maintain order during periods of extreme volatility. Trading halts are regulatory interventions designed to provide a cooling-off period when prices move too far or too fast, ensuring that all participants have access to information before trading resumes. We can generally categorize these into market-wide circuit breakers and single stock pauses. The primary goal is not to stop a price decline indefinitely, but rather to prevent a flash crash or a panic-driven feedback loop that could undermine market integrity. When a halt is in effect, market makers are prohibited from executing trades, and new orders may be restricted depending on the specific rules of the exchange. You should view these mechanisms as safety valves that protect the underlying infrastructure of the secondary market from systemic failure. Market-wide circuit breakers are triggered based on the S&P 500 index, which serves as the benchmark for the overall health of the equity markets. There are 3 distinct levels of decline that trigger these halts, calculated daily based on the previous day's closing price of the index. A level 1 breach occurs if the S&P 500 drops by 7%, while a level 2 breach occurs at a 13% decline. In either of these scenarios, if the drop happens before 3:25 p.m. Eastern Time, all trading across all exchanges on the national market system is paused for exactly 15 minutes. If these thresholds are crossed at or after 3:25 p.m., trading is generally allowed to continue unless a Level 3 breach occurs. The Level 3 circuit breaker is the most severe and represents a total collapse of market stability for the remainder of the session. This is triggered by a massive 20% decline in the S&P 500 index at any time during the trading day. Unlike the 15-minute pauses seen in Level 1 and Level 2, a Level 3 breach results in the immediate suspension of trading for the rest of the day. This provides time for market participants, regulators, and clearing houses to assess the situation overnight before the next morning's opening. It is important to note that these rules apply to all NMS stocks, including those listed on the NYSE and NASDAQ, ensuring a coordinated response across the entire financial system. Beyond these broad market measures, individual securities are subject to their own specific volatility constraints, often referred to as limit up, limit down (LULD) rules. These rules prevent a single stock from trading outside of specific price bands, which are calculated as a percentage above and below the average price over the preceding 5 minutes. If a stock's price moves outside these bands and does not return within 15 seconds, a 5-minute trading pause is usually triggered. This mechanism addresses idiosyncratic risks, such as an erroneous large order or a sudden reaction to specific company news, without affecting the broader market. It ensures that prices remain somewhat tethered to recent historical data rather than spinning out of control in seconds. We must also distinguish between these automated volatility halts and regulatory halts initiated by the exchange or the SEC. An exchange might halt trading in a specific stock to allow for the dissemination of material news, such as a pending merger or a significant earnings report. This ensures that the public has a fair chance to digest the news before the price adjusts to the new information. The SEC also has the broader statutory authority to suspend trading in any stock for up to 10 business days if it deems such action necessary to protect investors. While volatility halts are mechanical and price-driven, these regulatory halts are discretionary and based on the quality and transparency of information available to the public. Understanding the nuances of these pauses is vital for any professional operating in the secondary markets. When a halt occurs, the flow of liquidity stops, and outstanding orders might be canceled or held, depending on the specific instructions attached to them. For the SIE exam, you should focus on the specific percentages of the S&P 500 circuit breakers and the duration of the resulting pauses. Knowing that Level 1 and 2 result in 15-minute halts, while Level 3 ends the day, provides the structural framework necessary for answering questions on market conduct. These rules are a fundamental component of market microstructure, designed to maintain a fair and orderly environment even under significant stress. See you in the next lecture. Hello again. Let's solidify our knowledge with a short quiz. A market participant acts in a principal capacity, maintaining an inventory of a specific security and standing ready to buy or sell at publicly quoted prices. Simultaneously, the broader market experiences a significant decline, triggering a 15-minute halt across all exchanges after a 7% drop in the S&P 500. Regarding these scenarios, which of the following statements is correct? A. The participant is acting as a broker, and the halt is a Level 3 circuit breaker. B. The participant is acting as a dealer, and the halt is a Level 1 circuit breaker. C. The participant is operating in a dark pool, and the halt is a Level 2 circuit breaker. D. The participant is an investment advisor, and the halt only applies to the NYSE. Please pause the video and think about the answer before continuing. The correct answer is B. The participant is acting as a dealer, and the halt is a Level 1 circuit breaker. To understand why B is the correct choice, we must distinguish between the two primary capacities in which a firm operates. When a firm acts as a dealer, it is acting in a principal capacity, meaning it trades for its own account and maintains an inventory of securities. This contrasts with a broker who acts in an agency capacity by simply connecting buyers and sellers without taking a position in the security itself. Market makers are essentially dealers. They provide liquidity to the market by publishing bid and ask prices and staying ready to trade against those quotes using their own capital. If a firm takes on the risk of holding the asset, it is charging a markup or markdown rather than a commission, which is the hallmark of dealer activity. The second part of the question addresses market-wide circuit breakers, which are regulatory tools designed to prevent panic selling and ensure a period of price discovery during extreme volatility. These triggers are based on the S&P 500 index and are categorized into 3 levels. A level 1 halt occurs when there is a 7% decline from the previous day's close, resulting in a mandatory 15-minute pause in trading across all listing venues. A level 2 halt is triggered by a 13% drop, also resulting in a 15-minute pause. Finally, a level 3 halt occurs at a 20% decline, which stops trading for the remainder of the day. In the scenario provided, the 7% drop clearly identifies this as a level 1 event, making B the only logically consistent answer. It is also worth noting why the other options fail to meet the criteria. Option A is incorrect because acting in a principal capacity with inventory is the definition of a dealer, not a broker, and a 7% drop is not a level 3 halt. Option C mentions dark pools, which are private exchanges for institutional orders that provide liquidity away from public view to minimize market impact. But the scenario describes a participant with publicly quoted prices, which is typical of an exchange or the over-the-counter market. Option D is incorrect because market-wide circuit breakers apply to all equity markets and exchanges simultaneously, not just the NYSE, to ensure the entire national market system remains synchronized. Understanding these distinctions is fundamental to understanding how liquidity is maintained and regulated in secondary markets. See you in the next lecture. Hello there. It is good to have you back as we continue through the mechanics of trading and market operations. When a client decides to transition from simply holding a perspective on a security to actually owning it, they must submit an instruction known as an order. The most fundamental of these instructions is the market order, which acts as a request for immediate execution at the best available current price. In a market order, the primary objective is the certainty of execution rather than the control of the specific price at which the trade occurs. While other order types allow an investor to set boundaries on price, the market order effectively tells the trading venue to fill the order as quickly as possible using whatever prices are currently being quoted by market makers or other participants. This makes market orders the most liquid and straightforward way to enter or exit a position in a highly active market. To understand how a market order functions, you must consider the relationship between the bid and the ask price. When an investor submits a market order to buy, that order will be executed at the lowest available offer, also known as the ask price, which represents the lowest price a seller is willing to accept. Conversely, a market order to sell will be executed at the highest available bid, which is the maximum price a buyer is currently offering to pay. Because these orders are designed for immediacy, they are executed ahead of limit orders that are not yet marketable. You can think of a market order as a tool for an investor who values time over a specific cent per share improvement in price. In fast-moving markets, the price a client sees 1 second might be different the next, but the market order ensures they do not miss the opportunity to trade entirely. The priority of execution for a market order is highest among all basic order types because it does not have a restrictive price trigger or limit attached to it. While this guarantees that the order will result in a trade, it carries the inherent risk of price slippage, particularly in volatile market conditions or for thinly traded securities. If a large market order is placed, it may exhaust the available shares at the best current price and sweep through the order book, filling the remainder of the order at progressively worse prices. For this reason, Market orders are typically most appropriate for large cap stocks with high trading volumes where the spread between the bid and the ask is very narrow. In such environments, the difference between the expected price and the actual execution price is usually negligible for the average retail investor. From a regulatory and operational standpoint, market orders are expected to be processed immediately upon receipt during standard market hours. If a market order is received while the exchanges are closed, it is typically held and executed at the opening of the next trading session, often resulting in an execution price that differs significantly from the previous day's close. Broker-dealers have a duty of best execution, which means they must route these orders to the venues that provide the most favorable conditions for the client, even if the order itself specifies no price. Even though the client hasn't set a price limit, the firm still has a responsibility to ensure the trade is handled fairly within the context of the prevailing market. Understanding the trade-off between speed and price is essential for anyone advising clients on how to interact with the secondary markets. That concludes our look at how market orders prioritize execution over price control. I look forward to seeing you in the next lesson. Welcome back. When we discuss how trades are executed in the secondary market, we often begin with market orders because they're the most straightforward. However, a market order lacks control over price, which introduces a specific type of risk for the investor. A limit order is the primary tool used to mitigate this risk by allowing an investor to specify a maximum purchase price or a minimum sale price. You should think of a limit order as a conditional instruction that priority shifts the focus from the speed of execution to the quality of the price. The trade will only occur if the market meets the investor's specific price criteria or provides a price that is even more favorable. A buy limit order is placed at a specific price or lower. For example, if a stock is currently trading at $52, an investor might place a buy limit order at $50. This instruction tells the broker-dealer that the investor is only willing to acquire the shares if the price drops to $50 or less. If the stock price stays at $51, the order will simply sit on the order book unexecuted. This protects the buyer from overpaying during a period of high volatility, but it introduces the risk that the order may never be filled if the market moves upward. Conversely, a sell limit order is placed at a specified price or higher. Imagine an investor who holds a position in a company and believes the shares are currently undervalued at $80. They might place a sell limit order at $85, instructing the firm to sell only if the market price reaches that level or exceeds it. If the stock price rises to $86, the limit order is satisfied and will be executed at that better price. The primary advantage here is the guarantee that the investor will not receive less than their stated minimum, ensuring they achieve their desired exit valuation. It is vital to understand the trade-off between price certainty and execution certainty. While market orders guarantee that the trade will happen quickly, they offer no guarantee on the price. Limit orders provide the exact opposite. They offer a guarantee on the price if the trade occurs, but they offer no guarantee that the trade will actually happen. In a fast-moving market, the price might touch the limit price for a fraction of a second and then move away before the order can be filled. Therefore, an investor using a limit order must be comfortable with the possibility of missing the trade entirely in exchange for price protection. In the context of market mechanics, limit orders are often viewed as providing liquidity to the marketplace. They are placed on the specialist's or market maker's book and remain there until they are either executed, canceled, or they expire. This is fundamentally different from a market order, which takes liquidity by demanding an immediate fill at whatever price is available. Because limit orders stay on the book, they help define the bid and ask spread that other market participants see. Understanding this relationship helps you see why limit orders are the building blocks of a transparent and orderly auction market. When a limit order is executed, it must follow the principle of price improvement. This means that if a broker receives a buy limit order for $10 and the market suddenly offers shares at $9.90, the broker is obligated to execute at the better price for the client. The limit price is the limit of the client's tolerance, not a fixed target that the broker must hit exactly if a better option exists. You should always remember that for a buy limit, better means a lower price, and for a sell limit, better means a higher price. We must also consider the chronological priority of these orders, often referred to as price time priority. If multiple investors place buy limit orders at the same price, the order that was entered into the system first will generally be filled first. This means that even if the market price hits your limit, your order might not be filled if there are many other orders ahead of yours in the queue. This reinforces the fact that a limit order is an expression of patience and specific valuation rather than an urgent demand for shares. Finally, keep in mind that limit orders can be subject to various time-in-force instructions, though they are most commonly treated as day orders unless specified otherwise. If a limit order is not filled by the end of the trading day, it will typically be canceled automatically by the system. Investors who wish to keep their price target active over a longer period must use a different designation, such as good till canceled. This distinction is important because it determines how long the price protection remains active in the face of changing market conditions. I will see you in the next lecture. Welcome back. We are now going to examine the mechanics and applications of stop orders in the secondary market. A stop order, often referred to as a stop-loss order, is a memorandum order that remains dormant until the market price of a security reaches a specified level. This level is known as the stop price or activation price. Unlike a market order that seeks immediate execution or a limit order that seeks a specific price, a stop order requires a two-step process to reach completion. The first step is the trigger, which occurs when a transaction at or through the stop price takes place on the exchange. Once the trigger occurs, the order is elected and becomes a live market order for immediate execution at the next available price. It is important to distinguish between the activation price and the final execution price because they are rarely the same. In a volatile market, the next available price after the trigger could be significantly higher or lower than the stop price. This is because a stop order, once elected, carries the same risk as any other market order. It guarantees execution but does not guarantee a specific price. You should view the stop price merely as a threshold that transforms a resting instruction into an active market requirement. Investors use these orders primarily to automate an exit strategy without having to monitor the ticker tape constantly. A buy-stop order is placed at a price above the current prevailing market price. This might seem counterintuitive since investors typically want to buy low, but the buy-stop serves specific strategic purposes. It is most commonly used by short sellers who wish to limit their potential losses if the stock price begins to rise. If an investor has borrowed and sold shares at $50, they might place a buy-stop at $55. If the stock reaches that level, the order triggers and buys the shares to close the position, preventing the loss from expanding indefinitely as the price climbs. Beyond protecting short positions, buy-stop orders are utilized by technical analysts to capitalize on a breakout. When a stock is trading within a specific range, an investor might believe that if it pierces a certain resistance level, it will continue to surge upward. By placing a buy-stop just above that resistance level, the investor ensures they enter the position as soon as the upward momentum is confirmed. In this context, the order acts as an entry tool rather than a protective exit tool. Regardless of the intent, the mechanism remains identical. Once the price is hit or exceeded, the order becomes a market order to buy. A sell-stop order is positioned below the current market price and is typically used to protect a long position. If an investor holds a stock that has appreciated from $40 to $80, they may wish to lock in a portion of those unrealized gains. By placing a sell stop at $75, The investor ensures that if the market turns bearish and the price drops to that level, the order will trigger. The security will then be sold at the next available market price, effectively automating the liquidation of the position before the profit evaporates. While the primary motivation for a sell stop is frequently the protection of profit, it is also used more fundamentally to limit a loss on a newly established position. An investor who buys a stock at $100 might place a sell stop at $90 to ensure they do not lose more than $10 per share. This provides a disciplined framework for risk management, removing the emotional difficulty of deciding when to sell a losing investment. It is crucial to remember that in a fast-moving market or a gap-down opening, the actual sale price could be much lower than the $90 trigger. The industry also recognizes a variation known as the stop limit order, which combines the features of a stop order with the constraints of a limit order. When this order is triggered at the stop price, it does not become a market order. Instead, it becomes a limit order. This means that after the trigger, the order will only be executed if the security can be traded at the specified limit price or better. While this prevents the investor from receiving an unexpectedly poor price in a volatile market, it introduces the risk that the order may never be executed at all if the price continues to move away from the limit. Understanding the placement of these orders is essential for exam preparation. You should remember that sell stops are placed below the market and buy stops are placed above the market. This creates a logical framework where stop orders act as tripwires that respond to market movement. If you can visualize the price movement required to hit these tripwires, you can easily determine which order type is appropriate for a given scenario. Mastery of these concepts ensures you understand how market participants manage risk and automate their trading strategies in a professional environment. I look forward to seeing you in the next session. Hello. When we place an order in the market, we define not only the price and the quantity, but also the duration for which that order remains valid. This duration is governed by time in force instructions, which are essential parameters that tell a broker-dealer how long to keep an order active before it expires. Without these instructions, the market would be cluttered with stale orders that no longer reflect the intent of the investor. Understanding these parameters is crucial because they dictate the life cycle of a trade and determine the urgency of execution. In the context of the SIE exam, you must distinguish between instructions that prioritize timing versus those that prioritize the completeness of the transaction. The most common default instruction is the day order. A day order is valid only for the remainder of the trading day on which it is placed. If the order is not executed by the close of the market, typically 4 p.m. Eastern Time, the system automatically cancels it. This is the standard behavior for most equity trades unless specified otherwise by the investor. It protects the investor from having an order filled the next morning at a price that might be disadvantageous due to overnight news or market shifts. You should assume an order is a day order unless the scenario explicitly mentions a different time in force parameter. Conversely, some investors prefer to keep an order active until they achieve their desired price, regardless of how long it takes. This is handled by a good till canceled instruction, commonly abbreviated as GTC. A GTC order remains on the broker's books until it is either executed or manually canceled by the customer. However, it is important to note that most brokerage firms have internal policies that automatically purge GTC orders after a specific period, such as 30, 60, or 90 days. Additionally, GTC orders are often adjusted for cash dividends or stock splits if they are placed below the current market price. When urgency is the primary concern, an investor might use a fill or kill instruction. An FOK order requires the immediate execution of the entire order quantity at the specified price or better. If the broker cannot fill the entire order immediately, the entire order is canceled instantly. There is no such thing as a partial fill with a fill or kill order. It is a binary outcome where the investor either gets everything they asked for right now or nothing at all. This is often used by institutional traders who need to move a specific block of shares without leaving a trail of unfilled partial orders. An alternative for those who want immediate action but can tolerate a partial fill is the immediate or cancel instruction. An IOC order mandates that any portion of the order that can be filled immediately at the specified price must be executed. Any remaining part of the order that cannot be filled right away is then canceled. Unlike the fill or kill instruction, the IOC allows the investor to walk away with whatever liquidity is currently available. This is useful when the investor wants to take advantage of a fleeting price point, but does not necessarily need the full quantity to satisfy their original investment objective. Finally, we have the all or none instruction, which is often confused with fill or kill. An AON order stipulates that the broker must fill the entire quantity, but unlike FOK, it does not require immediate execution. The broker can keep the order active as a day order or a GTC order while waiting for enough liquidity to satisfy the full amount. This removes the immediate requirement and focuses solely on preventing partial executions. When you're evaluating exam questions, pay close attention to whether the requirement specifies immediate or simply entire amount, as this distinguishes FOK from AON. Each of these instructions serves as a tool for managing the risk and execution quality of a trade. By choosing the correct time and force, an investor can automate their strategy and ensure their capital is not tied up in orders that no longer serve their interests. Whether prioritizing the price through a GTC order or prioritizing speed through an IOC order, these parameters are foundational to the mechanics of the secondary market. You'll find that mastering these distinctions allows for a much clearer understanding of how professional traders interact with the order book. I will see you in the next one. Hello, and welcome back to our survey of order execution mechanics. The best execution rule, codified under FINRA Rule 5310, establishes a rigorous standard for how broker-dealers must handle customer orders. It is not enough for a firm to simply execute a trade. They must exercise reasonable diligence to ensure that the execution occurs at the best possible price given the current market conditions. This responsibility is a fiduciary-like obligation that applies whether the firm is acting as an agent or a principal in the transaction. You should understand that the term best execution does not strictly mean the absolute lowest price for a buy or the absolute highest price for a sell in every single instance, although price is the most significant factor. Instead, the rule requires the firm to search for the most favorable terms for the customer among various venues. This involves a multifaceted evaluation of the market landscape to determine which path provides the most benefit to the client. The rule exists to prevent firms from routing orders based on their own convenience or profit motives at the expense of the investor. To satisfy the requirement of reasonable diligence, a broker-dealer must consider several specific factors when deciding where to route an order. First, the firm must look at the character of the market for the security, which includes aspects like price, volatility, and relative liquidity. Second, the size and type of the transaction play a major role, as larger orders may require different handling than small retail trades to avoid adverse price movements. Third, the firm must consider the number of markets they checked, ensuring they have surveyed enough venues to have a representative view of the best available pricing. Fourth, the accessibility of the quotation is vital, meaning the firm must ensure they can actually reach and execute against the prices displayed. Finally, the terms and conditions of the order itself must be weighed against these market factors to find the optimal match. These criteria ensure that firms do not simply default to a single exchange without considering if a better outcome exists elsewhere. An important distinction in the best execution rule is how it applies to different types of securities, specifically the difference between listed securities and those traded over the counter. For securities that are not regularly quoted, such as certain thinly traded OTC stocks, the broker-dealer must exert even more effort to find a fair price. In such cases, the rule typically expects the firm to obtain quotes from at least 3 different dealers or market makers to determine the prevailing market price. If 3 dealers are not available, the firm must contact as many as reasonably exist to prove they have acted in the customer's best interest. This requirement prevents a firm from executing a trade against a single, potentially skewed quote in a fragmented or a liquid market. The overarching goal is to create a paper trail of diligence that justifies the final execution price. Modern trading environments often involve complex relationships between broker-dealers and execution venues, leading to specific prohibitions and requirements. One such prohibition is interpositioning, which occurs when a broker-dealer introduces a third party between themselves and the best available market for a security. This practice is strictly forbidden if it results in a worse price for the customer, as it adds an unnecessary layer of cost or profit for an intermediary. Furthermore, the best execution rule applies to both the initial routing of the order and the ongoing review of the firm's execution quality. Firms are required to conduct regular and rigorous internal reviews of the execution quality provided by the venues they use. If a firm discovers that a particular market center is consistently providing inferior fills, the firm is obligated to adjust its routing practices accordingly. While price is often the primary driver of best execution, the speed of execution and the likelihood of the trade being completed are also relevant variables. In fast-moving markets, a slightly worse price that is guaranteed and immediate might be preferable to a better price that is unlikely to be captured due to high volatility. Broker-dealers must balance these trade-offs based on the specific instructions provided by the customer, such as the use of limit orders or market orders. The firm's obligation is consistent. They must act as an advocate for the client in the marketplace. This duty cannot be waived by the customer, meaning a firm cannot ask a client to sign a document consenting to inferior execution. It is a fundamental regulatory pillar designed to maintain the integrity of the secondary markets and ensure that retail investors are treated fairly regardless of their sophistication. I will see you in the next lesson. Welcome back. Let's solidify our knowledge with a short quiz regarding the mechanics of order execution and the regulatory obligations of broker-dealers. A client wants to purchase 500 shares of a highly volatile technology stock, but is unwilling to pay more than $150 per share. Additionally, the client specifies that the order must be executed immediately in its entirety or not at all. Which of the following order types and qualifiers should the registered representative use? A. Market order with GTC instructions. B. Limit order with FOK instructions. C. Stop order with AON instructions. D. Limit order with IOC instructions. Please pause the video now to consider the correct answer before we continue. The correct answer is B, limit order with FOK instructions. To arrive at the correct answer, we must decompose the client's requirements into specific order attributes. The first requirement is a price constraint, as the client is unwilling to pay more than $150 per share. This necessitates a limit order rather than a market order, which would execute immediately at whatever price is available. We can therefore eliminate any answer choice involving a market order or a stop order, as the latter only becomes a market order once a specific price trigger is hit. The second requirement involves 2 specific conditions. The order must be executed immediately, and it must be executed in its entirety. This is the definition of a fill or kill, FOK, qualifier. Understanding the nuances between these qualifiers is essential for the SIE exam. An immediate or cancel, IOC, order requires immediate execution but allows for partial fills, meaning if only 200 shares were available at the limit price, those would be bought and the remaining 300 canceled. An all or none, AON, Order requires the full amount of shares to be traded, but does not require that execution to happen immediately. The FOK instruction combines the immediate requirement of an IOC with the entirety requirement of an AON. Regarding the broader regulatory context, firms must always adhere to the best execution rule, which mandates that broker-dealers use reasonable diligence to find the best market for a security to ensure the most favorable price for the customer. Until next time, welcome back. When we discuss trade settlement, we are essentially defining the point at which the ownership of a security is legally transferred from the seller to the buyer and the payment is exchanged. It is a common misconception among novice investors that a trade is finalized the moment an order is executed on an exchange. Execution is merely the agreement on price and quantity, whereas settlement is the actual fulfillment of the contract. In the context of the SIE exam, understanding the specific timelines for this process is vital because these rules have recently undergone significant changes to reduce systemic risk. The primary authority governing these timelines is the industry-wide adoption of standardized cycles, which ensures that all participants operate under the same temporal constraints. If a trade fails to settle on time, it creates a chain reaction of financial exposure that the regulatory framework is designed to prevent. The current standard for most securities is known as T+1 settlement, often referred to as regular way settlement. The T represents the transaction date, which is the day the trade was executed, while the +1 indicates that the settlement must occur on the first business day following that trade. This cycle applies to a broad range of instruments, including corporate stocks, corporate bonds, and municipal bonds. Previously, the industry operated on a T+2 cycle, but the shift to T+1 was implemented to shorten the window of time in which a counterparty might default. By accelerating this process, the financial system reduces the amount of margin required to back these trades and lowers the overall volatility risk. You should internalize that for the purposes of your exam, nearly every equity or corporate debt instrument you encounter will follow this one business day rule. While T+1 is the general rule for equities and corporate debt, government securities and certain derivatives have distinct characteristics regarding their settlement. For instance, U.S. Treasury bills, notes, and bonds settle on T+1 when traded in the secondary market, matching the equity standard. However, it is important to distinguish between the settlement of the security itself and the settlement of the trade when exercising options. When an investor trades the actual option contract, the settlement is T+1, just like a stock. However, if an equity option is exercised, the resulting stock transaction follows the standard T+1 regular way cycle for equities. Financial professionals must keep these timelines synchronized to ensure that capital is available in the client's account when the obligation becomes due. Failure to meet these deadlines can lead to violations of Regulation T, which governs the payment periods for securities. Business days are an essential component of the settlement calculation, meaning you must exclude weekends and federal holidays from your count. If a trade occurs on a Friday, a T+1 settlement date would fall on the following Monday, provided that Monday is not a public holiday. This distinction is important because the legal obligation to deliver the security or the funds is based strictly on days the banking and clearing systems are operational. The Depository Trust and Clearing Corporation, or DTCC, acts as the central intermediary that automates this process through book entry settlement. Most modern trades do not involve the physical movement of paper certificates. Instead, ownership is moved electronically across ledger lines. This electronic centralization is what allows the industry to move toward even shorter settlement cycles, potentially reaching same-day settlement in the future. Another variation you might encounter is cash settlement, which is distinct from the regular way settlement process. Cash settlement requires that the delivery of securities and the payment of funds happen on the same day the trade is executed. This is typically reserved for institutional trades or specific situations where a buyer needs immediate ownership of a security. It is a manually intensive process compared to the automated regular way cycle and usually requires the trade to occur before a certain time of day, such as 2 p.m. Eastern. While it is not the standard for retail investors, understanding that it exists helps clarify that settlement dates can be negotiated under specific circumstances. For the exam, always assume T plus 1 unless the question explicitly mentions a cash settlement or a different underlying instrument that deviates from the norm. Finally, we must consider the implications of a trade that does not settle, commonly known as a fail to deliver. A fail occurs when the selling broker-dealer does not provide the securities in a transferable form by the settlement date. This triggers a range of regulatory consequences and potential buy-in procedures, where the buying firm purchases the shares in the open market and charges the defaulting firm. Maintaining the integrity of the settlement cycle is what allows the secondary markets to function with high liquidity and narrow spreads. If participants could not rely on the T plus 1 delivery guarantee, the risk premium on every trade would increase, making the markets less efficient for everyone involved. As you study these timelines, remember that they are the mechanical backbone of the entire trading infrastructure. I look forward to seeing you in the next lesson. Hello. It is good to have you back as we continue our look into the mechanics of the secondary market. When a trade occurs, the process does not end with the execution of the order. Rather, the seller must fulfill their obligation to provide the security in a form that allows the buyer to take ownership without unnecessary administrative friction. This concept is known as good delivery, and it represents a set of standardized requirements that ensure a security is in the proper legal and physical condition for transfer to the new owner. If a security is delivered but fails to meet these specific criteria, the buying broker-dealer may reject the delivery through a process known as reclamation. It is important to distinguish this from a simple trade error, as good delivery focuses entirely on the physical or electronic state of the asset being moved between firms. We are essentially ensuring that the paperwork and the digital records align perfectly so that the transfer of title is indisputable. For physical certificates to meet the requirements of good delivery, they must be in such a condition that they are easily transferable. This means the certificates must not be mutilated beyond recognition. If a certificate is damaged, it must typically be authenticated by the issuer or a transfer agent before it can be considered valid for delivery. Additionally, the certificates must be accompanied by a proper assignment, which is usually found on the back of the certificate or provided via a separate document called a stock power or bond power. This assignment must be signed by the owner exactly as the name appears on the face of the certificate. If the signature is not an exact match, or if the endorsement is missing, the delivery will likely be rejected by the receiving firm. In the modern financial landscape, the majority of securities are no longer handled as physical pieces of paper, but the rules of good delivery still apply to electronic transfers. Most securities are held in book entry form, meaning the ownership is recorded on the books of the issuer or a central depository like the depository trust company. For these digital assets, good delivery is achieved when the delivering firm initiates an electronic transfer that accurately reflects the quantity and type of security sold. Even though we lack a physical signature to inspect, the electronic instructions must be verified and must match the clearing corporation's records. Failure to transmit the correct CUSIP number or the correct number of shares will result in a failed delivery just as surely as a torn paper certificate would. The denominations of the certificates being delivered also play a critical role in determining whether a delivery is considered good. For equity securities, the certificates must be delivered in units that can be easily aggregated into round lots of 100 shares. For example, if a seller is delivering 300 shares, they could provide 3 certificates of 100 shares each, or 6 certificates of 50 shares each, as these can be grouped into stacks of 100. However, delivering a single certificate for 80 shares and another for 20 shares would also be acceptable if they total 100. A delivery that results in an odd lot that cannot be neatly bundled into 100 share units may be rejected unless the trade itself was for an odd lot. For debt securities, the rules for denominations differ from those governing equities because bonds are typically traded based on their par value rather than share count. Good delivery for bonds generally requires that the certificates be in denominations of $1,000 or multiples thereof, such as $5,000 or $10,000. In some cases, denominations as small as $100 are acceptable, but they must always aggregate to the total face value of the trade. If a bond is in registered form, it must be properly endorsed. If it is a bearer bond, which is increasingly rare in the current market, it must have all unpaid future interest coupons still attached. The absence of a required coupon would immediately disqualify the bond from being considered a good delivery. Legal documentation and endorsements are the final hurdles in ensuring a security is ready for transfer. If a security is held in the name of a deceased individual, a minor, or a trust, specific legal papers must accompany the certificate to prove the person signing the assignment has the authority to do so. A signature guarantee is often required as well, which is a validation provided by a financial institution, such as a bank or a broker-dealer, vouching for the authenticity of the signature. This medallion signature guarantee protects the transfer agent and the buying firm from potential fraud. Without these specific markings and the correct supporting documentation, the chain of ownership is considered broken and the delivery will be deemed deficient by the receiving party. I hope this clarifies the logistical expectations required for a successful trade settlement. See you in the next lecture. Welcome back. When a corporation generates a profit, it faces a fundamental decision regarding capital allocation. It can either reinvest those earnings back into the business to fuel future growth or distribute a portion of that value to its shareholders in the form of dividends. For the purposes of the SIE exam, you must understand that these distributions are typically paid in cash, though they can also be issued as additional shares of stock. Dividends represent a tangible return on investment for equity holders, and the process of distributing them follows a strictly regulated timeline. This timeline is governed by a sequence of 4 specific dates, often abbreviated as DRP, which stands for declaration, ex-dividend, record, and payable. The process begins with the declaration date, which is the day the company's board of directors officially announces the dividend payment. At this moment, the company creates a legal liability on its balance sheet because it has publicly committed to paying out a specific amount per share. Along with the amount, the board also specifies the record date and the payable date during this announcement. It is important to realize that the corporation does not have a legal obligation to pay dividends until this formal declaration occurs. Common stockholders do not have a right to dividends simply by owning the stock. They only have a right to receive them if and when the board deems it appropriate to share profits. The record date is the point in time when a shareholder must officially appear on the company's books to be eligible for the declared dividend. Because the secondary market involves a settlement process, simply buying a stock on the record date is not sufficient to be considered an owner of record. You must have completed the settlement process by this date, which leads us to the most tested concept in this sequence, the ex-dividend date. Under the standard T+1 settlement cycle used in today's markets, the ex-dividend date is typically the same business day as the record date. If an investor purchases the security on or after the ex-dividend date, they are buying it ex-dividend, meaning without the right to receive the upcoming payment. To receive the dividend, an investor must execute their trade at least 1 business day before the record date. This ensures that when the trade settles 1 business day later, the investor's name is properly recorded on the company's books as the owner. If you buy the stock on the ex-dividend date, the seller, not you, will remain the owner of record for that specific dividend cycle. On the morning of the ex-dividend date, the market price of a stock is typically reduced by the amount of the dividend. This adjustment reflects the fact that the company's assets have decreased by the total amount of cash being sent to shareholders, and new buyers are no longer entitled to that cash. The final step in the sequence is the payable date, which is the day the company actually distributes the checks or credits the brokerage accounts of the eligible shareholders. This usually occurs a few weeks after the record date to allow the company's transfer agent time to process the payments. While the declaration, record, and payable dates are set by the corporation's board of directors, the ex-dividend date is dictated by the rules of the secondary market exchange. Understanding this distinction is vital because it separates the internal corporate action from the external market mechanics. Taxes are also a factor, as cash dividends are generally taxable to the investor in the year they are received, even if they are automatically reinvested. Beyond the mechanics of the payment schedule, we must consider how to measure the value of these dividends through the lens of dividend yield. The dividend yield, often called the current yield, is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. To calculate this, you take the annual dividend per share and divide it by the current market price of the stock. For example, if a stock pays a quarterly dividend of 25 cents, its annual dividend is $1. If that stock is currently trading at $20, the dividend yield is 5%, which provides a standardized way to compare the income potential of different securities. Investors often use the dividend yield to assess whether a stock fits their specific investment objectives, such as a need for regular income. It is important to note that the yield is inversely related to the stock price. If the stock price drops while the dividend remains constant, the yield increases. Conversely, if the stock price rises, the yield falls. High yields can sometimes be a warning sign that the market expects a dividend cut or that the company is in financial distress. In your studies, always ensure you're using the annual dividend figure for yield calculations, as the exam may provide only the quarterly amount to test your attention to detail. I will see you in the next lesson. Hello, and welcome back to our discussion on corporate actions. A stock split is a corporate action in which a company divides its existing shares into multiple shares to boost the liquidity of shares. Although the number of shares outstanding increases by a specific multiple, the total dollar value of the shares remains the same compared to pre-split amounts, because the split does not add any real value. To understand this, you must distinguish between the quantity of shares and the proportional ownership of the company. When a corporation declares a stock split, it is merely changing the denominator of the ownership fraction. As an investor, you own the same percentage of the company before and after the event. The most common reason for a forward split is to make the stock more affordable to small investors by lowering the market price per share. In a forward stock split, the number of shares increases while the price per share decreases proportionately. For example, in a 2-for-1 forward split, every shareholder receives an additional share for each share they already own. If you previously held 100 shares at a market price of $100 per share, your total investment value was $10,000. Following the split, you now hold 200 shares, but the market price is adjusted downward to $50 per share. Your total equity remains $10,000, demonstrating that the split is a neutral event regarding the total value of the account. It is helpful to think of this as changing a $10 bill for 10 $1 bills. You have more units, but your purchasing power is unchanged. The mechanics of these calculations always follow a specific mathematical relationship based on the split ratio provided by the issuer. To find the new number of shares, you multiply the original number of shares by the first number in the ratio and divide by the second number. Conversely, to find a new price, you multiply the original price by the second number in the ratio and divide by the first number. If a company announces a 3-for-2 split and an investor owns 200 shares at $60, the new share count becomes 300 and the new price becomes $40. Because the total value is conserved, you can always check your math by ensuring the pre-split total value matches the post-split total value. The SIE exam often tests your ability to perform these adjustments accurately, so practicing the ratio application is essential. A reverse stock split is the opposite of a forward split, where the number of outstanding shares decreases and the price per share increases. This action is frequently taken by companies whose share price has dropped to a level that might lead to a delisting from exchange or to improve the stock's perception among institutional investors. In a 1-4-5 reverse split, an investor who owned 500 shares at $2 per share would find themselves owning 100 shares at $10 per share. Just like the forward split, the total value of the investment remains exactly the same at $1,000. It is a common misconception that a reverse split indicates a company is in financial trouble, and while often true, the exam focuses primarily on the numerical outcome. Taxation is another critical aspect of stock splits that you must grasp for the exam. A stock split is generally not considered a taxable event by the IRS because the investor's total value in the position has not changed. Instead, the investor must adjust their cost basis per share to reflect the change in the number of shares held. If you bought 100 shares at $50 and the stock undergoes a 2-4-1 split, your new cost basis is $25 per share for 200 shares. The original purchase date, or the holding period, remains the same as the original shares for capital gains purposes. This adjustment ensures that when you eventually sell the shares, your gain or loss is calculated correctly relative to your original investment. When a stock split occurs, the issuer must notify the appropriate regulatory bodies and the exchange where the stock is traded. Shareholders do not need to take any manual action to receive their new shares, as the adjustment typically happens automatically in the brokerage account. It is also important to note that the par value of the stock is adjusted proportionately during a split. In a 2-4-1 split, if the par value was originally $1, it would be reduced to 50 cents post-split. This maintains the accounting balance on the company's balance sheet regarding the common stock account. Understanding these secondary effects helps build a complete picture of the corporate action scope beyond just the price and share count. I hope this clarified how stock splits function and how to approach the math behind them. See you in the next lesson. Welcome back. When corporations undergo structural changes like mergers or acquisitions, they're engaging in significant corporate actions that fundamentally alter the ownership and capital structure of the entities involved. In a merger, two distinct companies agree to combine into a single new legal entity, whereas an acquisition involves one company purchasing another to absorb it into its existing operations. From the perspective of the securities industry, these events are not just business decisions, but triggers for specific regulatory and administrative procedures. Shareholders of the companies involved often have their existing shares canceled and replaced with shares of the new entity, where they might receive a cash payment, or perhaps a combination of both. Because these actions can dilute ownership or change the nature of an investment, they usually require formal notification to the regulators and the investors. The mechanics of how these deals are executed involve complex coordination between transfer agents, clearing corporations, and brokerage firms to ensure that every beneficial owner is properly accounted for. Understanding these mechanics is vital for your work in the industry because you will often be the point of contact for clients when their holdings suddenly change in value or ticker symbol. One of the most critical aspects of these major corporate events is the requirement for shareholder approval, which is manifested through the proxy voting process. Since it is impractical for thousands of individual shareholders to attend a physical meeting to vote on a merger, corporations issue proxy statements to solicit the authority to vote on the shareholders' behalf. These documents are regulated by the SEC and must provide all material facts concerning the matters to be voted on, ensuring that investors are making an informed decision. As a registered representative, you should understand that the firm holding the securities in street name has a responsibility to forward these proxy materials to the beneficial owners. Shareholders can then cast their votes electronically, by mail, or by phone, influencing the outcome of major decisions such as board elections or the approval of a takeover bid. The integrity of the proxy process is what maintains the balance of power between corporate management and the actual owners of the business. If a shareholder fails to return their proxy, their shares are typically not voted on major matters, which can sometimes make it difficult for a corporation to reach the necessary quorum for a merger to proceed. Another common mechanism in corporate restructuring is the tender offer, which is an open invitation by an acquirer to all shareholders of a target corporation to purchase their stock. These offers are usually made at a premium to the current market price to incentivize shareholders to sell their holdings quickly. A tender offer is often contingent upon the acquirer obtaining a specific minimum number of shares, such as a majority stake, to ensure they gain control of the target. These offers remain open for a specific period, typically a minimum of 20 business days, and if the terms of the offer are changed, the offer must usually remain open for additional time. Shareholders who wish to participate must tender their shares by notifying their broker or the transfer agent of their intent to sell under the proposed terms. It is important to note that investors can only tender shares they actually own. They cannot tender shares they have borrowed in a short sale, a rule designed to prevent manipulative practices during a takeover. Once the offer expires, the acquirer either accepts the tendered shares and pays the investors or returns the shares if the minimum threshold was not met. The SEC maintains strict oversight of these activities to ensure transparency and fairness in the marketplace. For instance, according to the Williams Act, any person or group that acquires more than 5% of a company's outstanding price must file a disclosure with the SEC to alert the public of a potential change in control. This prevents creeping takeovers where an entity quietly buys up enough stock to seize control without paying a fair premium to all shareholders. Furthermore, when a tender offer is initiated, the target company's management must also state their position on the offer, advising shareholders whether they recommend accepting or rejecting it. This ensures that investors have access to multiple viewpoints before deciding the fate of their investment. All of these rules are designed to protect the retail investor from being disadvantaged by information asymmetry during complex corporate maneuvers. By maintaining a level playing field, the regulatory framework ensures that the capital markets function efficiently even when the corporate landscape is shifting rapidly. I'll see you in the next one. Hello. We have covered the mechanics of how trades move from execution to completion, so now it is time to verify your understanding of these synchronization points. Let's solidify our knowledge with a short quiz. A retail investor owns 400 shares of a company trading at $60 per share. The company has announced a 3-4-2 stock split. On the morning of the X date, which of the following best describes the investor's position, assuming no other market movement has occurred? A. 600 shares at $40 per share. B. 266.66 shares at $90 per share. C. 600 shares at $90 per share. D. 400 shares at $40 per share. Please pause the video now and think about the answer before proceeding. The correct answer is A. 600 shares at $40 per share. When dealing with stock splits, you must remember that the total value of the investor's position remains unchanged immediately following the action. To calculate the new number of shares, you multiply the original share count by the first number in the split ratio and divide by the second. In this case, 400 multiplied by 3 and divided by 2 equals 600 shares. To find the new price per share, you perform the inverse operation by multiplying the original price of $60 by 2 and dividing by 3, which results in $40. If you multiply the new share count of 600 by the new price of $40, you arrive back at the original total position value of $24,000, confirming the math is correct. Answer B represents the result of a reverse split, which would happen if the ratio were 2-4-3, while answers C and D fail to adjust both sides of the equation to maintain the total value. Understanding this relationship is vital for the exam because you will see variations involving forward splits, reverse splits, and stock dividends. In every case, the adjustment ensures that the proportional ownership of the investor stays the same, even though the number of units and the price per unit change. This same logic applies to dividend dates, where the price of the security is reduced by the amount of the dividend on the ex-dividend date to account for the fact that new buyers are no longer entitled to that distribution. Beyond the math, ensure you are comfortable with the good delivery requirements, specifically that securities must be in the proper denomination and accompanied by the necessary legal power to transfer ownership. Clear delivery is only achieved when these technical criteria are met alongside the settlement timeline of T+2 for most corporate securities. I will see you in the next one. Welcome back to your SIE preparation. The integrity of the financial markets relies on the assumption that all participants have access to the same information at the same time. Insider trading constitutes a significant breach of this principle, as it involves the misuse of material, non-public information to gain an unfair advantage in the securities markets. For the purposes of the SIE exam, we must rigorously define what makes information material and what makes it non-public. Information is considered material if a reasonable investor would view it as significant when making an investment decision. This might include impending mergers, earnings reports that differ substantially from market expectations, or significant changes in corporate leadership. If the disclosure of this information is likely to move the price of a security, it is almost certainly material. Non-public information is any data that has not been broadly disseminated to the general investing public. Broad dissemination typically occurs through recognized channels such as press releases, SEC filings, or major news wires. Even if a piece of information is known by a small group of people, it remains non-public until it is available to everyone simultaneously. The Insider Trading and Securities Fraud Enforcement Act of 1988 established the current framework for identifying and punishing these violations. It is important to realize that the law applies not just to corporate officers or directors, but to anyone who possesses and trades on such information. Liability extends to those who misappropriate information from their employers or who receive tips from insiders. The legal framework distinguishes between the person who provides the information, known as the tipper, and the person who receives it, known as the tippee. A violation occurs when the tipper communicates material, non-public information in breach of a fiduciary duty, and the tippee subsequently trades on that information. It is a common misconception that only the person who executes the trade is liable. In reality, both the tipper and the tippee can be held liable for the misconduct, regardless of whether the tipper personally profited from the trade. The mere act of passing along confidential information with the expectation of a personal benefit, even if that benefit is just a gift to a friend, is enough to trigger legal consequences. Broker-dealers are required by law to establish, maintain, and enforce written policies and procedures to prevent the misuse of material non-public information. A primary mechanism for this is the creation of information barriers, historically referred to as Chinese walls. These barriers are designed to prevent the flow of sensitive information between a firm's departments. For example, the investment banking division might have knowledge of a client's upcoming acquisition, but this information must not reach the retail, brokerage, or research departments. If an analyst in the research department were to issue a buy recommendation based on leaked information from the investment bankers, the firm would be in direct violation of regulatory requirements. Penalties for insider trading are severe and are intended to serve as a deterrent. On the civil side, the SEC can seek disgorgement of profits and impose fines of up to 3 times the profit gained or loss avoided, often referred to as treble damages. Criminal penalties are even more substantial, potentially involving millions of dollars in fines and significant prison sentences for individuals. For business entities, the fines can reach up to $25 million. Registered representatives must also be aware that their firms can be held liable if they failed to supervise the employee or lacked adequate procedures to prevent the violation. This reinforces the need for strict internal controls and constant vigilance regarding sensitive corporate data. Understanding the timeline of when information becomes public is critical for compliance. A person in possession of material non-public information must abstain or disclose. This means they must either disclose the information to the public before trading or refrain from trading altogether until the information is properly disseminated. Even after a press release is issued, insiders often must wait for a specific period to ensure the market has had time to absorb and react to the news. For a candidate preparing for the SIE, the takeaway is clear. Any trade executed while in possession of information that is both significant to a stock's price and not yet public is a violation of federal law. See you in the next lecture. Hello, and welcome back. Market manipulation refers to deliberate attempts to interfere with the free and fair operation of the market and create artificial, false, or misleading appearances regarding the price of, or market for, a security. At its core, the integrity of the secondary market depends on the principle that prices are determined by independent supply and demand rather than through deceptive practices. When an individual or a firm engages in manipulation, they are essentially trying to trick other market participants into making investment decisions based on faulty data. The Securities Exchange Act of 1934 provides the regulatory foundation for preventing these behaviors, and the industry takes these violations quite seriously. You will find that most manipulative practices involve some form of collusion or the use of deceptive orders to move prices in a favorable direction for the manipulator. Understanding these specific prohibited actions is not just about memorizing definitions. It is about recognizing the mechanisms used to distort true market value. One specific form of manipulation is known as painting the tape, which occurs when participants buy and sell a security among themselves to create the illusion of high trading volume. To an outside observer, a security that appears to be actively traded might seem more attractive or liquid than it actually is, potentially drawing in unsuspecting investors. This increased interest can drive the price up, allowing the manipulators to sell their holdings at a profit. The term comes from the old ticker tapes that recorded transactions. By repeatedly trading the same shares back and forth, the manipulators literally painted more activity onto the tape. Even if no fundamental change in the company's value has occurred, the artificial activity creates a false narrative. Regulators monitor for sudden spikes in volume that do not coincide with news or earnings reports, as these are often red flags for this type of activity. Another closely related concept is the use of matched orders, which involves a prearranged agreement between different parties to place buy and sell orders for the same security. In this scenario, one party places an order to sell shares at a specific price with the knowledge that another party will simultaneously place an order to buy that exact same number of shares. This is not a legitimate transfer of risk or ownership based on market conviction, but rather a coordinated effort to control the price or volume. Unlike painting the tape, which often focuses on the appearance of volume, matched orders are frequently used to set a specific price floor or ceiling for a stock. This practice undermines the auction process of the exchanges, as the trade is not actually open to the public in a meaningful way. Since the buyers and sellers are acting in concert, the resulting price is effectively manufactured. Capping and supporting are also strategies used to unfairly influence the price of security, often in connection with options contracts or new offerings. Capping involves selling a security in large quantities to keep its price from rising above a certain level, usually to ensure that out-of-the-money call options remain worthless through expiration. Conversely, supporting is the practice of placing buy orders to prevent a security's price from falling. often to protect a long position or a specific strike price. While these might seem like standard trading activities, the intent is what makes them manipulative. The goal is to artificially pin a price to a specific target rather than letting the market find its own level. If a broker-dealer or a trader acts with a specific intent to peg the price, they are in direct violation of fair practice rules. It is a subtle but firm line between legitimate hedging and prohibited price manipulation. Wash sales represent another area of concern, though they are often discussed in the context of tax strategy as well as market manipulation. A wash sale occurs when an investor sells a security at a loss and then purchases the same or a substantially identical security within 30 days before or after the sale. From a manipulation standpoint, a wash sale involves no real change in beneficial ownership. The investor is effectively trading with themselves to create a loss for tax purposes or to simulate trading activity. While the tax code disallows the deduction of such losses, the act of doing this repeatedly to influence price discovery is a regulatory violation. The primary takeaway is that any transaction that does not result in a genuine change in ownership or exposure, while appearing to be a market trade, is viewed with extreme skepticism. Consistency in volume and price should come from disparate parties with different interests, not from coordinated or circular transactions. I look forward to seeing you in the next session. Welcome back. In the financial industry, the integrity of the market depends on the principle that customer orders must be treated with priority and fairness. Front-running is a specific type of unethical behavior that occurs when a broker-dealer or an associated person place trades for their own benefit based on non-public information regarding an impending large customer order. When a professional has advanced knowledge of a significant block trade, which is typically defined as an order for 10,000 shares or more, they're prohibited from acting on that information before the customer's order is executed. This is because a large order is likely to move the market price of a security once it becomes public. By entering a personal trade first, the broker attempts to capitalize on the price movement that the customer's trade will inevitably cause. The prohibition against front-running applies primarily to the practice of trading ahead of customer orders. To understand why this is a violation, consider the mechanics of supply and demand in a secondary market. If an institutional client intends to buy 50,000 shares of a stock, that surge in demand will likely drive the share price up. If a registered representative learns of this order and immediately buys shares for their personal account before entering the client's order, they are essentially stealing the potential price advantage from the client. The representative gets the lower price, and the customer is forced to buy at a higher price because the representative's own trade contributed to the upward price pressure. This rule is not limited solely to the person who directly handles the customer's order, but extends to anyone in the firm who has knowledge of the impending block trade. This includes traders, research analysts, and other institutional sales personnel who might be privy to the information during the course of their duties. FINRA Rule 5270 explicitly states that no member or person associated with a member shall cause to be executed an order to buy or sell a security when they have material, non-public information concerning an imminent block transaction in that security. This prohibition covers the security itself, as well as related securities, such as options or convertible bonds, that could benefit from the price movement of the underlying stock. The scope of the front-running prohibition is quite broad to prevent firms from finding loopholes through related financial instruments. If a firm knows that a large sell order for a specific stock is coming, they cannot buy put options on that stock for the firm's proprietary account to profit from the expected price drop. This type of activity is considered a fraudulent practice because it exploits information that belongs to the customer for the firm's private gain. Regulatory bodies view this as a breach of fiduciary-like duty, where the professional places their own interests above the interests of the client. Even if the customer's trade is eventually executed at a fair price, the act of trading ahead is a violation of industry conduct rules. It is important to distinguish front-running from legitimate market-making activities or trades that are unrelated to the customer order. If a firm can demonstrably prove that a trade was part of their normal course of business and that the individuals making the decision had no knowledge of the pending block trade, they may have a defense. However, firms must maintain strict internal controls, often referred to as information barriers or Chinese walls, to prevent the flow of sensitive order information between departments. Without these controls, the assumption is often that the firm acted on the information, leading to significant disciplinary actions, including fines and suspensions. These rules ensure that the playing field remains level for all market participants. Ethical conduct in the securities industry requires that the customer's interest always comes first. Front-running undermines the public's trust in the fairness of the markets, which is why it is strictly monitored by both the SEC and FINRA. By preventing professionals from profiting at the expense of their clients, regulators aim to maintain a transparent environment where prices are determined by public information rather than inside knowledge of order flows. As you prepare for the exam, remember that the core of this violation is the exploitation of non-public knowledge about a large trade before that trade is made known to the rest of the market. I hope this clarifies the mechanics and prohibitions surrounding front-running. See you in the next lecture. Welcome back. When we discuss the operational integrity of a broker-dealer, we must address the strict administrative boundaries required between the firm's assets and those of its clients. The concept of commingling refers to the act of mixing customer-owned securities or funds with the firm's own capital or proprietary holdings. In the eyes of regulatory bodies like the SEC and FINRA, this is not merely a bookkeeping error. It is a fundamental violation of the duty to safeguard client property. The core requirement is physical and legal segregation, ensuring that a client's assets are always identifiable and protected from the firm's creditors. If a firm were to face insolvency, the inability to distinguish between what belongs to the company and what belongs to the customer would lead to a catastrophic failure of the financial system's trust. To prevent such scenarios, broker-dealers are required to maintain separate accounts for customer funds and securities. This means that when a client deposits money into a brokerage account, those funds must either be used for the client's transactions or kept in a segregated reserve account. A firm cannot use a client's cash to pay for its own corporate expenses, such as rent, salaries, or proprietary trading activities. This distinction remains firm regardless of whether the customer is a retail investor or a sophisticated institutional entity. The prohibition on commingling serves as a functional firewall that keeps the firm's operational risks from bleeding into the client's investment portfolio. The rules surrounding the hypothecation of securities provide a clear framework for how these assets must be handled in a margin environment. While a firm may pledge a customer's securities as collateral for a bank loan, a process known as rehypothecation, the firm must still ensure that customer securities are not commingled with the firm's proprietary securities. Even when securities are held in street name, meaning they are registered in the name of the broker-dealer for the sake of efficiency, they must be marked on the firm's books as belonging to the customer. This ensures that the beneficial owner remains the client and that the assets are not treated as part of the firm's general assets. Failure to maintain these clean lines constitutes a breach of the SEC's Customer Protection Rule, specifically Rule 15C3-3. The consequences of commingling reach beyond simple administrative fines and can result in severe disciplinary actions, including the revocation of a firm's registration. From a practical standpoint, the prohibition also extends to the behavior of individual registered representatives who might be tempted to move funds between their personal accounts and client accounts. Even with a client's explicit permission, a representative is generally forbidden from mixing their personal money with a customer's investment. This strictness is necessary because once assets are commingled, the legal protections provided by the Securities Investor Protection Corporation, SIPC, become much more difficult to apply. Segregation is the primary mechanism that allows for the orderly return of assets in the event of a firm's liquidation. You should also understand that this principle applies to both fully paid securities and the excess margin securities held in a customer's account. Fully paid securities must be kept in a control location, which means they are under the firm's possession but are strictly earmarked for the client. The firm is required to perform a daily calculation to ensure that they have possession or control of all such securities. Any deficiency in these holdings must be addressed immediately to ensure that the firm is not inadvertently using client assets for its own purposes. By maintaining this continuous accounting, the firm provides the transparency required to prove that no commingling has occurred. Finally, it is worth noting that while firms can combine one customer's margin securities with those of another customer for hypothecation purposes, they can never mix customer securities with firm securities for those same purposes. This subtle distinction allows for the efficient functioning of the margin system while still upholding the foundational rule of segregation. The firm's proprietary inventory is always treated as a separate pool of capital with a different risk profile and legal standing. This discipline ensures that if the firm's own investments fail, the client's assets remain untouched and independent. See you in the next lecture. Hello, and welcome back to our discussion on prohibited activities. In the world of professional finance, we often deal with uncertainty, yet clients naturally seek certainty. As a registered representative, you might feel a professional urge to reassure a nervous investor that their principal is safe or that a specific return is inevitable. However, the regulatory framework established by FINRA and the SEC is very clear on this matter. You may never guarantee a customer against financial loss. This prohibition is absolute and applies regardless of the product being sold, the sophistication of the client, or the sincerity of your belief in the investment's performance. When we talk about an improper guarantee, we are referring to any statement, written or oral, that suggests a security will perform in a specific way or that the broker-dealer will absorb losses if the investment fails. The rationale behind this rule is tied back to the fundamental nature of securities. By definition, investing involves the assumption of risk in exchange for the potential of reward. If you remove the risk through a guarantee, you are fundamentally misrepresenting the instrument being sold. Regulations specifically prohibit a representative from telling a client that the firm will buy back a security at its original purchase price if the price drops. Likewise, you cannot promise to reimburse a client for losses incurred in their account. Such promises create a false sense of security and can lead investors to take on more risk than they actually understand or can afford. Even if you are personally willing to cover a loss for a friend or family member, doing so in a professional capacity is a violation of industry conduct rules. It is important to distinguish between the structural characteristics of a security and a guarantee made by a representative. For instance, a U.S. Treasury bond is backed by the full faith and credit of the United States government, and a corporate bond has a legal obligation to pay interest. Stating these facts is not a prohibited guarantee. Rather, it is a description of the security's legal and financial structure. The violation occurs when a representative adds their own layer of assurance, such as promising that a bond's market price will never fall below par. You must always clarify that while certain entities have obligations to pay, market factors like interest rate risk and credit risk still exist. Your role is to present the investment's features accurately without implying that the external market forces have been neutralized. Sharing in accounts is another area where the lines of improper guarantees can become blurred. Under specific circumstances and with prior written approval from a firm, a representative may share in the profits and losses of a customer's account. However, this is only permissible if the sharing is proportionate to the financial contribution the representative has made to the account. This does not mean the representative is guaranteeing the account against loss. It means they are effectively becoming a co-investor. Even in this scenario, the representative cannot tell the client, Don't worry, if the account loses money, I will pay for your half of the losses. That would still constitute a guarantee against loss, which remains prohibited. The representative and the customer must share in both the gains and the losses based on their respective stakes. The prohibition also extends to the use of collateral and third-party guarantees. You might encounter a situation where a client asks if a certain dividend is guaranteed. While a preferred stock might have a stated dividend rate, that dividend is only paid if the board of directors declares it. Telling a client that the dividend is guaranteed is a violation because the board has the discretion to omit it if the company's financial situation changes. Only certain insurance-wrapped products or specific government-backed securities carry what could be legally described as a guarantee, and even then, the guarantee is only as strong as the guarantor. As a representative, you should avoid using the word guaranteed entirely when discussing the future performance or safety of security to ensure you remain compliant with conduct rules. Regulatory authorities take these violations seriously because they strike at the heart of market integrity. If representatives were allowed to offer guarantees, the entire mechanism of price discovery and risk assessment would be distorted. From a practical standpoint, no broker-dealer has the capital to truly insure all their clients' market losses, so such a guarantee is essentially a lie. When preparing for the exam, remember that any scenario where a representative promises to make the client whole or protect the principal through personal or firm intervention is an improper guarantee. Stick to the facts of the offering and ensure the client understands that the potential for loss is an inherent part of the investment process. I'll see you in the next lecture. Hello, it is good to have you back for this assessment. Let's see if we can solidify your knowledge of market integrity and prohibited conduct with a short quiz. A registered representative receives a call from a research analyst at their firm who mentions that an upcoming, unpublished report will significantly upgrade a specific technology stock's rating. Shortly after, the representative executes an order to buy that stock for a customer's discretionary account and then for their own personal account. Which of the following best describes this set of actions? A. Only the personal trade is a violation of insider trading rules. B. These actions constitute both insider trading and front-running. C. The representative is protected by the safe harbor rules for discretionary accounts. D. Market manipulation has occurred because the analyst provided false information. Please pause the video now to consider your answer before we proceed to the explanation. The correct answer is B, as these actions constitute both insider trading and front-running. The scenario identifies two distinct violations that frequently appear on the SIE exam, both centered on the misuse of non-public information. Insider trading occurs here because the representative acted upon material, non-public information, the unpublished research report, to gain an unfair advantage in the market for both the client and themselves. It does not matter that the information came from within the same firm. The fact that it was not yet available to the general investing public makes it inside information. Furthermore, front-running is specifically present because the representative placed a personal trade after receiving information about a pending action that would likely move the market or in anticipation of a large client order. While the question focuses on the research report, the act of placing a personal trade to benefit from an impending price move caused by others is a clear breach of fiduciary duty. We also need to look at why the other options do not hold up under regulatory scrutiny. Option A is incorrect because insider trading liability extends to any party that trades on the information, regardless of whose account is used. Providing the tip to the customer's account is just as illicit as the personal trade. Option C describes a safe harbor that simply does not exist for prohibited activities. Having discretionary authority over an account gives a representative the power to choose assets, but it never grants them the right to use illegal information. Option D is a distraction, as there is no evidence that the analyst's information was false or intended to stimulate an artificial price through deception, which is the hallmark of market manipulation. In the regulatory framework, true but non-public information is what triggers insider trading rules, while false information or wash sales trigger market manipulation rules. You should also be comfortable identifying other prohibited activities like commingling, which involves the illegal mixing of customer funds with the broker-dealer's proprietary funds. Additionally, remember that a representative can never guarantee a customer against a loss or promise a specific investment performance, as market risk cannot be contractually waived. These rules are in place to ensure that the relationship between the firm and the client remains transparent and that the market operates on a level playing field. Understanding the nuances between misusing information and physically mishandling assets will be vital for your success on the exam. I will see you in the next session. Hello, and welcome back to our survey of regulatory compliance. When a broker-dealer interacts with the public, FINRA categorizes these interactions into specific buckets based on the recipient's identity and the volume of the communication. Retail communications represent the most strictly regulated category because they're directed at a broad audience of individuals who may lack sophisticated financial knowledge. By definition, retail communication is any written or electronic communication distributed or made available to more than 25 retail investors within any 30 calendar day period. It is important to note that the count resets every 30 days, so a single message sent to 26 people on Tuesday is handled differently than the same message sent to 24 people on Monday and another 2 the following month. The threshold exists to ensure that mass marketing efforts receive a higher level of scrutiny than individualized notes or institutional exchanges. The classification of a retail investor is surprisingly broad in this context. A retail investor is defined essentially as anyone who does not meet the criteria for an institutional investor. This includes both existing customers of the firm and prospective clients who have no prior relationship with the broker-dealer. Because the recipient might be someone with very little investment experience, the regulations require that these communications provide a fair and balanced view of the risks and benefits. You cannot emphasize potential gains while burying the risks in a footnote. The goal is to prevent misleading statements from reaching the general public at scale. A fundamental requirement for retail communication is the necessity of internal oversight. Before a retail communication is used for the first time, it must be reviewed and approved by a qualified registered principal of the firm. This principal is typically a supervisor who holds the appropriate licenses to oversee the firm's business activities. The approval must be in writing and must happen before the material is distributed to the public. This serves as a defensive layer to catch potential compliance violations before they result in regulatory fines or client harm. The firm must also maintain records of these approvals and the communications themselves for a period of 3 years. There are specific exceptions to the pre-approval rule, though they are limited in scope. For instance, if another firm has already filed the communication with FINRA and received a letter stating it appears consistent with applicable standards, and the current firm has not materially altered the content, then a new approval might not be necessary. Additionally, retail communications that do not make a financial or investment recommendation and do not promote a product or service of the firm may be exempt from the principal's prior approval. However, the vast majority of marketing materials, brochures, and website content that you will encounter in a professional setting will require this formal sign-off. The internal principal must ensure that the communication is not only accurate, but also appropriate for the intended audience. Beyond internal approval, certain retail communications must be filed with FINRA for external review. For a new member firm, this filing requirement is particularly stringent during its first year of operation, where virtually all retail communications must be filed at least 10 business days prior to use. For established firms, materials concerning highly regulated products like options, volatile investment companies, or certain complex securities have their own specific filing timelines. Some materials are filed post-use, while others must be submitted before they ever reach a client's inbox. Understanding that retail communication is defined by the volume of more than 25 retail recipients is the key to identifying which rules apply in a given scenario. I hope this clarifies how the industry manages its outbound messaging to the public. See you in the next lecture. Hello, it is good to have you back. When we discuss communication with the public in a regulatory context, we must distinguish between different audience types because the level of oversight required by FINRA changes based on the recipient's perceived sophistication. Institutional communications represent a specific category of written or electronic information distributed or made available only to institutional investors. The rationale behind this distinction is straightforward. Large financial entities possess the resources and expertise to evaluate investment risks without the same level of hand-holding required by a retail investor. Consequently, the rules governing how a member firm interacts with these entities are noticeably less restrictive than those applied to retail communications. This does not mean the standards of truthfulness are lower, but rather that the administrative burden of pre-approval is significantly reduced to allow for more efficient business operations. To correctly identify institutional communications, we must first understand who qualifies as an institutional investor under FINRA Rule 2210. This list includes banks, savings and loan associations, insurance companies, and registered investment companies like mutual funds. It also encompasses registered investment advisors, government entities, and employee benefit plans that meet specific participant or asset thresholds. Furthermore, any person or entity with total assets of at least $50 million falls into this category. If a communication is sent to even one person who does not meet these criteria, the entire piece of communication generally defaults to being treated as retail communication. You must ensure that the firm has a reasonable expectation that the communication will not be redirected to retail customers, as that would invalidate its status as institutional. The regulatory oversight for institutional communications is characterized by a high degree of internal flexibility compared to the rigid mandates of retail distribution. Unlike retail communications, which often require approval by a qualified principal prior to use, or even filing with FINRA, institutional communications do not require prior principal approval. This exception exists because the recipients are expected to perform their own due diligence on the materials provided. However, the lack of pre-approval does not imply a lack of supervision altogether. Firms must still establish written procedures for the review of institutional communications to ensure they are not misleading or fraudulent. These procedures typically involve some form of post-use review or training to ensure that the employees generating these materials are adhering to the firm's internal standards and industry ethics. Documentation and record-keeping remain a fundamental requirement for institutional communications despite the leaner approval process. A firm must maintain files containing the communication, the name of the person who prepared it, and evidence that it was handled according to the firm's supervisory procedures. These records must be kept for a period of 3 years from the date of last use, with the first 2 years of records being easily accessible for regulatory inspection. If a firm's internal procedures do not require prior principal approval, they must instead provide education and training to the associated persons who communicate with institutional investors. This training is intended to prevent the dissemination of material that could be construed as unfair, unbalanced, or containing exaggerated claims, which are prohibited regardless of the audience. It is important to emphasize that the content within institutional communications is still subject to the overarching fair and balanced standard. Even though you're dealing with sophisticated entities like pension funds or hedge funds, you cannot omit material facts or make false statements about a security's potential performance. The primary benefit of the institutional classification is the speed at which a firm can move. In the fast-paced environment of capital markets, Requiring a principal to sign off on every data sheet or portfolio analysis sent to a professional counterparty would create unnecessary friction. By allowing firms to use a regime of supervision and review rather than pre-approval, regulators strike a balance between market efficiency and investor protection. One nuance to watch for is the intended recipient rule, which dictates how a firm must control the flow of information. If a member firm has any reason to believe that an institutional communication or any part of it will be forwarded to a retail investor, the underlying communication must be treated as retail. This means the firm must exercise caution when providing materials to institutional intermediaries who might share those materials with their own retail clients. To mitigate this risk, many firms include prominent legends or disclaimers stating that the material is for institutional use only. If those safeguards are ignored and the firm becomes aware of the breach, they are obligated to upgrade their oversight of those specific communications to meet retail standards immediately. Ultimately, your grasp of this topic depends on your ability to separate the audience from a medium. Whether it is an email, a printed brochure, or a slide deck, the classification depends entirely on the status of the person receiving it and the firm's ability to prevent its spread to the general public. While you are exempt from the more onerous filing requirements and pre-approval mandates, you are never exempt from the requirement to be honest. The SEC and FINRA maintain the authority to penalize firms for institutional communications that are deceptive or fail to provide a basis for evaluating the facts of an investment. Understanding this leaner yet still regulated framework is a core component of compliant behavior within a broker-dealer. I will see you in the next one. Hello, it is good to have you back for this discussion. In the realm of financial regulation, specifically under FINRA Rule 2210, we categorize communications based on the recipient's identity and the quantity of people reached. Correspondence is a distinct category of communication that requires a precise understanding of its boundaries to ensure compliance. It is defined as any written or electronic communication that is distributed or made available to 25 or fewer retail investors within any 30 calendar day period. This quantitative threshold is the most critical factor in distinguishing correspondence from other forms of outreach. If you exceed this number by even one person, the communication shifts into a different regulatory category with more stringent oversight requirements. You must keep this specific number in mind because it dictates the level of internal review necessary before a message leaves the firm. The definition applies regardless of whether the retail investors are current clients or prospective ones. A retail investor, in this context, is any person other than an institutional investor. This means that if you send a personalized email to 20 existing clients and 5 potential leads, you have stayed within the 25-person limit for correspondence. The 30-day window is a rolling period, meaning you cannot simply reset your count on the first day of every month. You must be diligent in tracking how many individuals receive a specific piece of information or a template-based message. If the same content is sent to a larger group, the firm is no longer dealing with correspondence, but rather with retail communication. One of the primary benefits of classifying a message as correspondence resides in the flexibility of the review process. Unlike retail communications, which generally require approval by a registered principal before use, correspondence does not strictly mandate pre-approval. Instead, FINRA allows firms to implement post-use review procedures. This means a principal can review the outgoing messages after they have been sent, provided the firm has established written procedures and conducts regular training for its representatives. This allowance recognizes the need for timely, individual interactions that characterize the daily workflow of a broker-dealer. However, the lack of a pre-approval requirement does not absolve the firm or the representative of the responsibility to ensure the content is fair, balanced, and not misleading. While the rules for correspondence are less rigid regarding timing, They're just as strict regarding record keeping and content standards. Every piece of correspondence must be retained by the member firm for a period of 3 years, and it must be readily accessible for the first 2 years of that period. This retention policy ensures that regulators can audit past communications to verify that representatives are not making unsubstantiated claims or omitting material facts. Even a simple text message or a direct message on a social platform, if used for business purposes with retail investors, falls under these record-keeping requirements. You cannot circumvent these rules by using personal devices if those devices are used to conduct the firm's business. It is important to understand that the content of correspondence is still subject to the general standards of truthfulness and clarity. You are prohibited from making false claims, promising specific returns, or using technical jargon that is likely to confuse the recipient. Even if you're only communicating with 5 people, you must provide a balanced view of risks and benefits. If a piece of correspondence includes a recommendation, the firm must ensure that the recommendation is suitable for the recipients based on their financial profiles. The regulatory framework assumes that retail investors lack the sophisticated analysis tools available to institutions, and thus, the oversight of these 25 or fewer individuals remains a priority for the firm's compliance department. Confusion often arises when comparing correspondence to institutional communications. Institutional communications are sent only to institutional investors, such as banks, insurance companies, or registered investment advisors, regardless of the number of recipients. Correspondence is specifically aimed at retail investors, which includes any individual or entity that does not meet the high assets under management threshold of an institution. If a message is sent to 100 institutional investors, it is an institutional communication, not correspondence. Conversely, if that same message is sent to 26 retail investors, it becomes retail communication. Mastering these distinctions is essential for navigating the regulatory landscape and protecting the firm from avoidable disciplinary actions. Finally, you should consider the implications of static versus interactive content in the digital age. While correspondence often takes the form of direct emails or letters, it can also encompass certain types of social media interactions. If you post an update that is only viewable by a small, controlled group of 25 or fewer retail people, it may be treated as correspondence. However, most public-facing social media posts are considered retail communications because they are available to an unlimited audience. The firm's supervisory system must be robust enough to identify which category a digital interaction falls into. Understanding the 25-person limit is the first step in maintaining a compliant communication strategy. I will see you in the next lecture. Welcome back. Telemarketing remains a standard method for broker-dealers to solicit new business. And because it involves direct outreach to the public, it is governed by strict FINRA and Telephone Consumer Protection Act rules. The core principle is that professional solicitation must not be intrusive or deceptive, leading to specific constraints on when and how a registered representative can contact a prospect. One of the most fundamental rules concerns the time of day during which calls can be placed. Outbound solicitations are permitted only between 8 a.m. and 9 p.m. in the time zone of the person being called. If you're in New York and calling a prospect in California, you must wait until it is at least 8 a.m. on the West Coast, which would be 11 a.m. your time. This restriction applies regardless of whether the prospect is at home or at their place of business. Although calls to a place of business are generally less sensitive to these specific hours if the business is open. While the time of day rule is a baseline, there are specific exceptions where these hours do not apply. If you have an established business relationship with a person, you're generally not restricted by the 8 a.m. to 9 p.m. window. An established business relationship exists if the person has made a transaction or had account activity with your firm within the previous 18 months, or if they have contacted your firm to inquire about a product or service within the last 3 months. Additionally, if you have received prior express written consent from the individual, you are free to call them at any time they have agreed to. These exceptions recognize that a pre-existing relationship changes the nature of the communication from a cold call to a service-oriented or expected interaction. Without such a relationship or consent, the representative must strictly adhere to the local time zone of the recipient. Another pillar of telemarketing regulation is the maintenance and honoring of do not call lists, which exist at both the firm level and the national level. Every broker-dealer is required to maintain an internal do not call list, which is a record of individuals who have specifically asked that your firm no longer contact them. When a person makes this request, their name must be placed on the list immediately, and the firm must ensure that no representative contacts them again for solicitation purposes. This internal list does not expire. Once a person is on it, they stay on it unless they later provide consent to be removed. It is a violation of FINRA rules to ignore this request, and firms must have robust systems in place to cross-reference every lead against this internal database before a call is ever initiated. Beyond the internal list, firms must also consult the National Do Not Call Registry managed by the Federal Trade Commission. Before making any outbound solicitation calls, a representative must ensure the prospect's number is not listed on this national registry. While the internal list is specific to your firm, the national list applies to all telemarketers across all industries. There are exceptions for the national registry that mirror those of the time of day rules, such as having an established business relationship or written consent. However, it is important to distinguish that even if an exception allows you to bypass the national registry, you can never bypass your firm's internal do not call list. If a current client with an established business relationship asks to be put on your firm's do not call list, you must honor that request despite the active account. When a representative makes a permitted call, they must follow certain disclosure requirements immediately upon beginning the conversation. You must clearly state your name, the name of your broker-dealer firm, and the address or telephone number where the firm can be contacted. Furthermore, the purpose of the call must be disclosed as being for solicitation or to provide information about a professional service. Using a blocked caller ID is strictly prohibited, as the recipient has the right to see the originating number. It is also worth noting that these rules apply to all forms of telemarketing, including those conducted via automated dialing systems or pre-recorded messages. Compliance with these rules is not optional, as they are designed to protect the privacy of the public and the reputation of the financial services industry. See you in the next lecture. Welcome back. When we discuss communication in a regulated environment, we must treat digital interactions with the same rigor as traditional paper correspondence. Social media poses a specific challenge because it blends personal expression with professional representation, often in real time. For the purpose of the SIE exam, the most critical distinction you need to master is the difference between static and interactive content. Regulators care about this distinction because it determines the level of oversight, approval, and record-keeping required by a broker-dealer. If you use a platform to promote a financial service or product, you are effectively engaging in public communication, and the rules of the Financial Industry Regulatory Authority, FINRA, apply immediately to that activity. Static content is best understood as digital material that remains posted for an extended period and is accessible to a broad audience without much change. Examples of this include your profile page, background information, or a blog post that stays on a site until it is manually edited or removed. Because this content is planned and durable, regulators treat it similarly to retail communication. This means that a registered principal of the firm must review and approve the static content before it is ever published to the public. You should think of a LinkedIn profile or a permanent professional landing page as a digital brochure that requires a formal stamp of approval from your compliance department. Interactive content, by contrast, flows more like a conversation and occurs in real-time or near real-time environments. This includes things like tweets, status updates, or comments on a social media thread where the exchange is dynamic. because it would be impractical to require a principal to approve every individual tweet before a representative hits the send button. These communications are generally treated as correspondence. They are subject to post-use review and supervision rather than pre-approval. However, the firm must still have robust institutional controls in place to monitor these interactions and ensure that no misleading claims are being made during the digital dialogue. The classification of content can shift based on how it is used, which is a nuance that often appears in regulatory discussions. If a representative reposts an old blog entry or brings a piece of static content back into the spotlight, that act itself might be seen as a new instance of communication. It is also important to remember that firms are responsible for the record keeping of all business-related social media, regardless of the device used. If you're discussing securities or providing financial advice on a personal mobile phone via a social app, those records must be captured and archived for at least 3 years. Failing to maintain these records is a common point of failure for firms that do not have clear social media policies. Another vital concept is the notion of entanglement and adoption regarding third-party content. Entanglement occurs if a firm or its representative has participated in the development of the content that a third party posts. Adoption happens when a firm explicitly or implicitly endorses a third party post, such as liking or sharing a client's testimonial on their own page. In both cases, the firm becomes responsible for the accuracy and compliance of that content, as if they had written it themselves. You must be extremely cautious when interacting with public comments, as a simple retweet can be interpreted as the firm adopting the message contained within that post. Finally, you should be aware that the content of the communication always dictates the rule, more so than the platform itself. It does not matter if you're using Facebook, Instagram, or a professional forum. If the subject matter involves the investment business, it is regulated. Representatives must maintain a clear line between purely personal posts and professional outreach to avoid accidental compliance breaches. All firms are required to provide training and written procedures that outline what is permissible for their employees on these platforms. Without these guardrails, the risk of distributing unapproved or misleading information to the retail public becomes unacceptably high in the eyes of the regulators. I hope this clarifies how the industry manages digital footprints. See you in the next lesson. Welcome back. Let's solidify our knowledge with a short quiz regarding the regulatory requirements for various forms of communication with the public. A broker-dealer is preparing a new marketing brochure regarding its investment services that it intends to send to a targeted list of 40 individual investors over the next 30 days. According to FINRA rules, how is this communication classified, and what is the approval requirement? A. Correspondence does not require prior principal approval. B. Retail communication requires prior principal approval. C. Institutional communication requires prior principal approval. D. Retail communication does not require prior principal approval. Please pause the video now to consider your answer before we proceed. The correct answer is B. Retail communication requires prior principal approval. This question tests your ability to distinguish between communication categories based on the number of recipients and the nature of those recipients. FINRA defines retail communication as any written or electronic communication distributed or made available to more than 25 retail investors within any 30 calendar day period. Because the firm is sending this brochure to 40 individual investors, it exceeds the 25-person threshold, moving it out of the category of correspondence and into retail communication. Retail investors include any person other than an institutional investor, regardless of whether they are existing or prospective clients of the firm. The approval process is a critical distinction in regulatory compliance. Most retail communications must be approved by a qualified registered principal of the member firm before the earlier of its use or filing with FINRA's Advertising Regulation Department. Correspondence, which is distributed to 25 or fewer retail investors, typically only requires post-use review rather than pre-approval, provided the firm has a training program in place. Institutional communication is also subject to different standards. But since these 40 individuals are described as individual investors rather than banks, insurance companies, or large entities with assets over $50 million, the institutional classification does not apply here. Telemarketing and digital engagement also follow specific scripts and patterns that must align with these definitions. National Do Not Call registry rules prohibit calls to residential numbers before 8 a.m. or after 9 p.m. in the recipient's time zone, and firms must maintain their own internal lists as well. When using digital platforms or social media, the content determines the category. If a post is static and viewed by more than 25 retail investors, it is a retail communication requiring principal approval. If the interaction is real-time and spontaneous, it may be treated as a public appearance, though firms must still monitor these for compliance with fair and balanced standards. I will see you in the next one. Hello, and welcome back. Registration in the securities industry is not merely a matter of passing an exam. It is a formal process of becoming an associated person of a member firm. Central to this process is the uniform application for securities industry registration or transfer, commonly referred to as the Form U-4. When you seek to become a registered representative, your firm will file this document electronically via the Central Registration Depository, or CRD. This system acts as a centralized database for the licensing and registration of financial professionals across the United States. The information provided on the Form U-4 is comprehensive and stays with you throughout your career in the industry. It is a mandatory requirement for anyone performing functions that necessitate registration under FINRA rules. The Form U-4 requires an extensive amount of personal information to establish your identity and professional history. You must provide your legal name, any aliases or nicknames used, and a residential history covering the past 5 years. Employment history is even more rigorous, requiring a detailed account of the last 10 years of your professional life. For the purposes of the background check, the firm must verify at least the most recent 3 years of this employment history. These disclosures allow regulators and firms to identify potential conflicts of interest or gaps in your timeline that might indicate undisclosed activities. Providing inaccurate or incomplete information on these sections can lead to significant regulatory consequences, including the denial of your registration. Beyond simple biographical data, the Form U-4 contains a series of disclosure questions regarding your legal and financial past. You are required to disclose any felony convictions and certain types of misdemeanor convictions, specifically those involving securities, investment-related businesses, fraud, or even the misappropriation of funds. Financial disclosures, such as personal bankruptcies within the past 10 years, or unsatisfied judgments and liens, are also mandatory. These disclosures are vital because they provide the transparency necessary for the firm and FINRA to determine your fitness for duty. If you have been involved in any civil litigation, or if you have been the subject of customer complaints or disciplinary actions by other regulators, those facts must be recorded on this form as well. A critical component of the Form U-4 that often surprises newcomers is the pre-dispute arbitration agreement. By signing the Form U-4, you agree to resolve certain disputes through arbitration rather than through the traditional court system. This agreement applies to disagreements between you and your firm, as well as disputes involving other registered representatives or customers. Arbitration is generally seen as a more efficient and less costly way to settle industry conflicts, but also means you are waiving your right to a jury trial. There are specific exceptions to this requirement, such as claims involving employment discrimination or sexual harassment, which may still be heard in a court of law. However, for the vast majority of securities-related professional disputes, Arbitration is the mandatory venue established by the U4 signature. Ownership of the information on the Form U4 does not end once the initial filing is complete. As a registered representative, you have an ongoing obligation to keep this information current and accurate. If any of the disclosed facts change, such as a change of address, a new legal proceeding, or a financial event like a tax lien, the Form U4 must be updated. Generally, an amendment must be filed within 30 days of the event occurring. If the change involves a matter that could lead to statutory disqualification, the window for reporting is even narrower, requiring an update within 10 days. Failing to maintain the accuracy of your CRD record is considered a serious violation of industry rules and can result in fines or suspension. Finally, the registration process includes a physical identification requirement. Every applicant for registration must submit a set of fingerprints to the U.S. Attorney General, typically handled through the FBI, for a criminal background check. This rule applies to all associated persons of the broker-dealer who are involved in the sale of securities, handle customer funds or securities, or have access to books and records of original entry. This fingerprinting requirement ensures that the disclosures made on the Form U4 match the actual criminal record of the individual. It serves as a back-end verification to protect the integrity of the industry and the safety of the investing public. By synthesizing all these elements, biographical data, employment history, legal disclosures, and physical verification, the U4 creates a high barrier to entry that ensures only qualified individuals represent the firm. I will see you in the next lecture. Hello, and welcome back. The integrity of the financial markets depends heavily on the character and history of the people working within them. Statutory disqualification is a mechanism used by regulators to ensure that individuals who have demonstrated a lack of professional or personal integrity are prevented from participating in the securities industry. This is not a discretionary decision made by a firm based on a whim. Rather, it is a formal status triggered by specific events defined in the Securities Exchange Act of 1934. When an individual is subject to statutory disqualification, they are effectively barred from being associated with a FINRA member firm in any capacity unless a specific eligibility proceeding grants them relief. Understanding the triggers for this status is vital because it dictates who can and cannot enter or remain in the profession. One of the most common triggers for statutory disqualification is a criminal conviction within the past 10 years. It is a common misconception that only financial crimes lead to disqualification. While any felony conviction within the last decade results in statutory disqualification, the rule also extends to certain types of misdemeanors. Specifically, misdemeanors involving securities, commodities, banking, insurance, or other financial services will trigger this status. Additionally, misdemeanors related to perjury, bribery, extortion, or the misappropriation of funds fall under this umbrella. Even if a person has the necessary technical skills for the job, a conviction for theft or forgery committed 7 years ago would legally prevent them from registering as a representative today. Beyond criminal convictions, civil and regulatory injunctions play a significant role in the disqualification process. If an individual is currently subject to an order from the SEC, a self-regulatory organization like FINRA, or a foreign financial regulator, they may be disqualified. This often occurs when a person has been expelled or suspended from membership in an SRO or has been barred from associating with a member. It also applies if an individual has been found to be the cause of another person's suspension or expulsion. Regulators look at the history of a person's behavior across different jurisdictions, meaning that an order from a state securities administrator or a commodities regulator can have the same weight as an SEC order. Another critical trigger involves the truthfulness of the individual during the registration process. Providing false or misleading information on an application for registration, such as the Form U4, is a standalone ground for statutory disqualification. This includes omitting material facts that the regulator needs to make an informed decision about the applicant's fitness for the industry. If an applicant fails to disclose a reportable event, such as a past bankruptcy or a settled customer dispute, and the regulator discovers this omission, the act of concealment itself can lead to a finding of statutory disqualification. The industry operates on a foundation of full disclosure, and regulators view dishonesty on official forms as a fundamental breach of that principle. It is important to understand that while statutory disqualification is a significant barrier, it does not always result in a permanent lifetime ban from the industry. A firm that wishes to hire or retain a disqualified person can apply for relief through a process known as an eligibility proceeding. During this process, FINRA's Member Regulation Department and the National Adjudicatory Council evaluate the circumstances of the disqualifying event and the firm's proposed plan for heightened supervision. If the regulator determines that the individual's participation would not jeopardize the public interest, they may permit the association. However, the burden of proof is high, and the firm must demonstrate that they can effectively manage the risks associated with employing a disqualified individual through rigorous oversight. Ultimately, the concept of statutory disqualification serves as a gatekeeping function to preserve the reputation of the capital markets. By identifying individuals with a history of financial misconduct or serious criminal behavior, the regulatory framework attempts to mitigate the risk of fraud and unethical behavior. You should remember that the 10-year window for convictions is the standard benchmark for testing purposes. Whether the issue is a felony, a specialized misdemeanor, or a history of regulatory sanctions, the result remains a restriction on the individual's ability to work. This ensures that only those who meet high standards of conduct are permitted to handle investor funds and provide financial advice. I look forward to seeing you in the next lesson. Welcome back. When a registered representative leaves a member firm, the relationship must be formally terminated through the filing of the Uniform Termination Notice for Securities Industry Registration, commonly known as Form U-5. This document is a critical component of the regulatory framework because it ensures that FINRA and other regulators maintain an accurate, up-to-date record of who is currently authorized to conduct securities business. The responsibility for filing this form rests solely with the firm that the individual is leaving, not the individual representative. It is a mandatory requirement regardless of whether the termination was voluntary, such as a resignation for a better opportunity, or involuntary, such as being fired for cause. By centralizing this data, the industry maintains transparency regarding the professional history and conduct of its practitioners. The temporal requirements for filing Form U-5 are strict and leave little room for administrative delay. A member firm must file the form within 30 days of the termination date to remain in compliance with regulatory standards. This 30-day window is the standard for most departures, but the timeline becomes significantly more sensitive if the termination involves certain types of misconduct or legal issues. If a representative is terminated for cause, or if there are pending allegations of rules violations, the firm must still adhere to the filing deadline while providing detailed disclosures. This ensures that the individual's central registration depository record accurately reflects the circumstances of their departure for the benefit of future employers and regulators. Accuracy in the reason for termination section is paramount, as firms must choose from several specific categories: voluntary, deceased, permitted to resign, discharged, or other. If the firm selects discharged or permitted to resign due to specific violations, they are required to provide a detailed explanation of the facts surrounding the event. Once the form is filed with FINRA, the firm is also legally obligated to provide a copy of the Form U-5 to the terminated individual within that same 30-day period. This allows the former employee to review the information reported about them and understand what will be visible to potential future employers during the background check process. If a firm later discovers that information on the form was inaccurate or incomplete, they are required to file an amended Form U-5 promptly. Even after a representative has left the industry, the regulatory authority of FINRA does not vanish immediately. FINRA retains jurisdiction over a terminated person for a period of 2 years following the effective date of their termination. During this 2-year window, the individual is still subject to FINRA's request for information and can be reached for disciplinary actions regarding conduct that occurred while they were registered. This prevents individuals from simply resigning to avoid the consequences of unethical behavior or pending investigations. Furthermore, if the individual decides to return to the securities industry within this 2-year period, they can re-register by filing a new Form U-4 without necessarily having to retake their qualification exams, provided their CE requirements are met. The Form U-5 also plays a defensive role within the industry by alerting new firms to potential red flags during the hiring process. When a representative applies to a new firm, the new employer will review the previous Form U-5 filings to verify the reasons for past departures and check for any disciplinary history. This creates a continuous chain of accountability that follows a professional throughout their entire career in finance. For the SIE exam, it is vital to remember that the firm handles the filing. The 30-day window is the standard time frame, and the 2-year jurisdictional rule applies to post-termination oversight. Understanding these mechanics is essential for grasping how the industry self-regulates and maintains its integrity through documentation. I will see you in the next lecture. Hello and welcome back. Continuing education is a foundational requirement for maintaining active status as a registered representative in the financial services industry. Within the framework defined by FINRA, this requirement is divided into 2 distinct components: the regulatory element and the firm element. The regulatory element is specifically designed to ensure that all registered persons stay current on matters related to federal securities laws, self-regulatory organization rules, and regulatory directives. Unlike internal training, this component is administered by FINRA through a centralized, computerized platform that delivers standardized content to everyone across the industry. It serves as a quality control mechanism to verify that professional knowledge does not atrophy over time. The timing of the regulatory element is governed by specific chronological triggers that you must memorize for the SIE exam. Initially, a registered person is required to complete their first regulatory element session on the 2nd anniversary of their initial registration. Following this first milestone, the cycle repeats every 3 years, meaning additional sessions must be completed on the 5th, 8th, 11th, and subsequent anniversaries of registration. This periodic structure ensures that even late career professionals are periodically exposed to the newest legal and ethical standards. You may find it helpful to think of this as a recurring obligation that tracks with your professional tenure rather than a one-time hurdle at the start of your career. When a registration anniversary occurs, a specific window opens during which the registered person must complete their computerized training module. This window lasts for 120 days, starting from the anniversary date of the individual's initial registration. While the technology allows for these modules to be completed at a firm's location or remotely, the time constraint remains rigid and non-negotiable. It is the responsibility of both the individual and their employing firm to ensure that the session is scheduled and concluded before the 120-day period expires. Failure to act within this time frame carries significant consequences for the individual's ability to conduct business, as the transition from active to inactive status is automated by FINRA systems. If a registered person fails to complete the regulatory element within the required 120-day window, their registration status is changed to inactive CE. While in this inactive state, the individual is strictly prohibited from performing any activities that require registration, such as soliciting new clients or executing trades. Furthermore, they are generally prohibited from receiving any commissions or compensation related to securities transactions that occur during the period of inactivity. This status remains until the individual successfully completes the required training module. The distinction here is important. The person is not technically fired or barred, but they are legally sidelined until they fulfill the administrative requirements of the regulatory element. The content within the regulatory element is not a one-size-fits-all curriculum, but is instead tailored to the specific registration category held by the individual. For example, a person registered only as a representative will encounter different scenarios and rule applications than someone registered in a supervisory capacity, such as a principal. This ensures that the time spent in training is relevant to the day-to-day functions and specific regulatory risks associated with the individual's role. On the SIE exam, however, the questions will focus more on the universal application of the timelines and the consequences of noncompliance rather than the specific details of the individual modules themselves. One nuance to bear in mind is that the regulatory element is entirely separate from any internal training sessions your broker-dealer may require you to attend annually. Even if your firm provides excellent internal education, it does not satisfy the FINRA requirement for the regulatory element. Conversely, completing the regulatory element does not exempt you from the firm's internal requirements, known as the firm element. You should view these as parallel requirements that serve different purposes. One provides a standardized regulatory baseline across the entire industry, while the other addresses the specific business needs and product offerings of your particular firm. It is also worth noting that if an individual leaves the industry and their registration is terminated via Form U5, the clock for the regulatory element effectively pauses. However, if that person decides to return to a registered role after a gap of more than 2 years, they're typically required to requalify by passing the appropriate exams again. If they return within the 2-year window, they simply pick up where they left off in the CE cycle. This policy emphasizes the industry's focus on current competency. If you have been out of the loop for too long, the regulator requires more than just a continuing education module to prove you are ready to serve the public. I'll see you in the next one. Hello, and welcome back. As we continue our exploration of the professional requirements for registered persons, we must distinguish between the two distinct branches of continuing education. While the regulatory element is a standardized program governed by FINRA, the firm element is a localized, internal responsibility that falls directly upon the broker-dealer. This requirement ensures that every covered person remains competent in the specific areas relevant to their firm's unique business model and the products they sell. It is not enough to simply pass an initial exam. The regulatory framework demands a systematic, ongoing commitment to professional growth. You should view the firm element as the industry's way of ensuring that practitioners stay current with evolving regulations and market complexities that a general exam might not cover. Every member firm must conduct a formal needs analysis at least once a year to determine the focus of its training program. This analysis is not a casual survey, but a rigorous evaluation of the firm's business activities, the types of customers it serves, and any recent regulatory changes that affect its operations. If a firm primarily deals in municipal bonds, its firm element training will look significantly different from a firm that focuses on options or variable annuities. The goal is to identify knowledge gaps within the workforce and address them through targeted education. This process ensures that the training provided is actually relevant to the representative's daily tasks and the risks associated with those specific activities. Once the needs analysis is complete, the firm must develop a written training plan that outlines how it intends to address the identified educational requirements. This plan must be documented and available for inspection by regulators during audits to prove that the firm is meeting its obligations. The training itself can cover a wide range of topics, including ethics, regulatory requirements, and the features of complex financial products. However, it is important to note that the firm element is not meant to be a preparation course for another registration exam. It is focused on the practical application of knowledge within the context of the firm's specific business practices and the protection of its clients. The scope of the firm element applies to all covered persons, which generally includes any registered individual who has direct contact with customers. This definition extends beyond just sales representatives to include those who manage or supervise the sales and trading functions, as well as those who handle customer funds or securities. Interestingly, the firm has the discretion to include other employees in the training if it deems it necessary for its risk management strategy. This flexibility allows the firm to create a culture of compliance that permeates different departments, not just the front office sales staff. You will find that these training sessions are often delivered via online modules, seminars, or internal workshops, depending on the scale of the organization. One of the most critical aspects of the firm element is the record-keeping requirement associated with its implementation. Regulators do not simply take a firm's word that training occurred. They require evidence that the plan was executed as described. Firms must maintain detailed records of the individuals who completed the training, the content of the sessions, and the dates on which the training took place. Failure to maintain these records or to provide the training altogether can result in disciplinary action against the firm. This underscores the reality that continuing education is a formal regulatory mandate, not an optional professional development exercise for the employees. While the firm has significant leeway in designing its curriculum, there are certain standards that the training must meet to be considered valid. The content must be accurate, up-to-date, and presented in a manner that is understandable to the participants. Because the financial industry is subject to frequent legal and structural shifts, the firm element serves as the primary mechanism for disseminating these changes to the workforce quickly. For instance, if a new anti-money laundering regulation is enacted, the firm element is the logical vehicle for ensuring all relevant staff understand their updated responsibilities. It acts as a safety net, ensuring that professional standards remain high even as the landscape changes. Finally, it is worth noting how the firm element interacts with the broader professional standing of a registered representative. If an individual fails to complete the required firm element training within the time frame established by their firm, the firm may take internal disciplinary measures. Unlike the regulatory element, which is tracked centrally by FINRA and can lead to an CE inactive status that prevents all registered activities, the firm element is managed at the member firm level. However, a representative who consistently ignores internal training requirements will likely find their career progression hindered. Total compliance requires a disciplined approach to both the external mandates of the regulators and the internal mandates of the employer. I'll see you in the next one. Welcome back. Let's solidify our knowledge with a short quiz regarding registration requirements and continuing education. An individual previously registered with a FINRA member firm is looking to re-enter the industry. Which of the following statements is true regarding their registration and continuing education requirements? A. A Form U-5 must be filed by the new firm within 30 days of the individual being hired. B. If the individual has been out of the industry for more than 2 years, they must re-qualify by examination. C. The regulatory element of continuing education is required only for individuals with less than 5 years of experience. D. Statutory disqualification only applies to felony convictions involving securities-related crimes within the last 5 years. Please pause the video now to consider the correct answer before we move forward. The correct answer is B. If the individual has been out of the industry for more than 2 years, they must re-qualify by examination. When a person's association with a firm is terminated, the firm must file a Form U-5 within 30 days of the termination date, not when they are hired by a new firm. If that individual remains out of the industry for more than 2 years, their licenses lapse, and they must sit for the exams again to regain their registration. Answer A is incorrect because the hiring firm files a Form U-4, while the former firm files the U-5. Answer C is incorrect because the regulatory element is a mandatory requirement for all registered persons, typically required on the second anniversary of their initial registration and every 3 years thereafter. Finally, answer D is incorrect because statutory disqualification covers any felony within the last 10 years, not just 5, as well as certain misdemeanors involving finance or dishonesty. Understanding these timelines is essential for maintaining a valid registration status throughout your career in the financial services industry. I'll see you in the next lecture. Welcome back. When you represent a broker-dealer as a registered person, your professional identity is intrinsically tied to your firm's regulatory standing. This brings us to the concept of outside business activities, commonly referred to as OBAs. The industry operates on the principle that an employer must be aware of any business-related activities its employees pursue away from a firm. This transparency is not merely a corporate preference, but a strict regulatory requirement under FINRA rules. It ensures that any potential conflicts of interest are identified before they can impact a client or the integrity of the firm. The fundamental requirement states that a registered person cannot be employed by or accept compensation from any person as a result of any business activity outside the scope of the relationship with their member firm. This restriction applies unless the individual has provided prior written notice to the member firm. It is important to distinguish this from many other regulatory processes that require explicit permission. For a standard OBA, the rule focuses on the act of notification rather than receiving a formal approval from a firm. However, most firms incorporate this into their internal compliance manuals, and as a practical matter, they may restrict or prohibit certain activities if they perceive a risk. Determining what qualifies as an OBA requires a look at the nature of the engagement and the expectation of compensation. Compensation is defined broadly in this context. It is not limited to a regular paycheck or a formal salary from a second employer. If you're serving as an independent contractor, a consultant, or even a sole proprietor of a small side venture, these fall under the OBA umbrella if there's an expectation of being paid. Even if the activity hasn't generated income yet, the potential for compensation dictates that you must notify your firm in writing before you begin the activity. A common point of confusion involves the difference between business activities and passive investments or personal activities. You do not typically need to provide notice for personal investments, such as holding shares in a publicly traded company or owning a rental property, provided you're not actively managing it as a business. Similarly, purely charitable or civic activities generally do not require notification if they are truly voluntary and involve no compensation. However, if you are appointed to the board of a nonprofit and receive a stipend or any form of payment for your service, the activity moves from a personal volunteer effort to an OBA. The line is drawn at the expectation of financial gain in exchange for your professional or personal services. The rationale behind this rule is primarily centered on protecting the investing public from confusion. Regulators want to ensure that a customer can clearly distinguish between the services offered by the broker-dealer and whatever else a registered representative might be doing on the side. If a representative is selling insurance privately or acting as a real estate agent without the firm's knowledge, a customer might mistakenly believe the broker-dealer backs those services. By requiring prior written notice, the firm has the opportunity to evaluate if the outside activity could be perceived as part of the firm's business or if it creates a conflict of interest that needs to be managed or disclosed to clients. From a compliance perspective, the firm must keep records of these notifications and review them to ensure they do not violate any existing laws or internal policies. While FINRA only mandates prior written notice for OBAs, some firms are more restrictive and may require a formal sign-off. If a firm determines that an employee's side business interferes with their duties or creates an unmanageable conflict, they have the right to demand the individual cease those activities. Ignoring these requirements is a serious violation that can lead to disciplinary action against both the individual and the firm. Staying compliant means being proactive and ensuring that any work done outside the firm's walls is documented properly in their records. See you in the next one. Hello, and welcome back. When an associated person of a member firm engages in securities transactions outside the regular scope of their employment, the industry refers to this as a private securities transaction. You might often hear this behavior described as selling away, a term that carries a negative connotation because it implies the activity is happening behind the back of the employing broker-dealer. FINRA Rule 3280 governs these activities to ensure that firms remain capable of supervising their employees and protecting the public from unvetted investment schemes. Because the firm is ultimately responsible for the conduct of its registered representatives, it must be informed of any securities trades that do not flow through its own execution systems. Failure to follow these rules is a serious regulatory violation that can lead to disciplinary action or permanent debarment from the industry. The first requirement for any representative considering a private securities transaction is to provide prior written notice to their employer. This notice must describe the proposed transaction in exhaustive detail and explicitly state whether the representative expects to receive compensation for the trade. You should distinguish this from outside business activities, which generally only require notification. Here, the level of scrutiny is higher because the activity involves the sale of securities. If the representative will receive any form of selling compensation, including commissions, finder's fees, or even the promise of future equity, the firm must provide written approval or disapproval. If the firm disapproves, the representative is strictly prohibited from participating in the transaction in any capacity. Should the firm grant approval for a compensated transaction, it essentially adopts that transaction as its own for the purposes of regulatory oversight. The firm must record the transaction on its books and records and supervise the representative's participation as if the trade were being executed through the firm's own platform. This means the firm assumes liability for the conduct of the representative and must ensure that all suitability and disclosure requirements are met. This level of oversight is necessary because the regulator views the representative as an agent of the firm regardless of where the trade physically occurs. Without this recording requirement, a firm might inadvertently facilitate fraudulent activity without being aware of the risks being introduced to the market. The rules differ slightly if the representative is participating in a private securities transaction for which no compensation will be received. In these instances, the representative still must provide written notice to the firm detailing the nature of the transaction and their role in it. While the firm does not necessarily need to formally approve the deal for record-keeping purposes in the same way it does for pay transactions, it still retains the right to restrict the representative's participation. This often happens with transactions involving family members or personal business ventures where the representative is not earning a commission. Even without compensation, the firm must acknowledge the notice and may still choose to supervise the activity to mitigate any potential conflicts of interest. Personal transactions in investment company shares or variable annuity contracts are generally excluded from the specific definition of private securities transactions under this rule. However, it is a mistake to assume any other investment type is exempt. Many candidates fail to realize that private placements, limited partnership interests, or even promissory notes often fall under the umbrella of securities. If you are ever in a position where you are facilitating a trade or introducing a client to a security not offered by your firm, you must treat it as a private securities transaction. Ignoring these boundaries often leads to selling away charges, as the firm cannot protect what it cannot see. Specific conditions apply to the documentation that must be maintained by the firm regarding these approved activities. The firm must keep a record of the representative's name, the date of approval, and the specific terms of the compensation involved. These records must be readily available for inspection by regulators during a routine firm audit. This creates a clear trail of accountability that prevents representatives from claiming they were acting as independent agents when things go wrong. By formalizing the relationship between the representatives outside trades and the firm's compliance department, the industry maintains a cohesive structure of investor protection. I hope this clarifies the distinctions regarding selling away and private securities transactions. See you in the next lecture. Welcome back. When we examine the integrity of the municipal securities market, we must inevitably address the potential for conflicts of interest arising from political contributions. The Municipal Securities Rulemaking Board, or MSRB, established Rule G 37 specifically to prevent what is commonly referred to as pay-to-play practices. In this context, pay-to-play describes a scenario where a firm makes political contributions to government officials in hopes of being rewarded with lucrative underwriting or advisory business. To maintain a level playing field, the rule imposes strict limitations and disclosure requirements on brokers, dealers, and municipal securities dealers. If a firm or certain of its employees cross these boundaries, the consequences are significant and objective. We are not looking at intent or soft variables here. We are looking at specific dollar amounts and roles. The core of Rule G 37 revolves around the municipal finance professional, often abbreviated as an MFP. An MFP is any person associated with a broker-dealer who is primarily engaged in municipal securities activities, such as underwriting, financial advisory, or even certain types of research and sales. This definition also extends to those who supervise such individuals or who are members of the firm's executive or management committees. It is important to distinguish MFPs from retail representatives who might occasionally sell a municipal bond to a client. The restrictions on political contributions apply most strictly to these MFPs because they are the individuals in a position to influence the awarding of municipal business. Understanding who qualifies as an MFP is the first step in identifying when a contribution might trigger a regulatory violation. The most critical provision of Rule G 37 is the 2-year ban on business that results from an improper contribution. If an MFP makes a contribution to an official of an issuer where they are entitled to vote, and that contribution exceeds the permitted threshold, the firm is prohibited from engaging in municipal securities business with that issuer for 2 years. This is an absolute prohibition that applies to negotiated underwritings and certain advisory services. The ban is designed to be a powerful deterrent, effectively removing the financial incentive for firms to use political donations as a tool for securing business. It is also important to note that the ban follows the MFP. If an individual makes a prohibited contribution at one firm and then moves to a different firm, the new firm may also be subject to the remaining term of the ban. There is, however, a specific de minimis exception that allows MFPs to contribute small amounts to candidates for whom they are legally eligible to vote. Under current regulations, an MFP can contribute up to $250 per election to a candidate for an office that represents the district where the MFP resides. The per election distinction means that the primary and the general elections are treated as 2 separate events, allowing for a total of $500 in some cases. However, this exception only applies if the MFP is actually entitled to vote for that official. If an MFP contributes any amount to a candidate in a district where they do not live, or if they contribute more than $250 to a candidate where they do live, the 2-year ban is triggered immediately. The reporting requirements under Rule G 37 ensure transparency by mandating periodic disclosures of political contributions and municipal business. Firms must file Form G37 with the MSRB on a quarterly basis, listing contributions made by the firm itself, its MFPs, and its political action committees. This public record allows regulators and the public to monitor whether there is a correlation between political spending and the awarding of municipal contracts. In addition to individual contributions, the rule prohibits firms and MFPs from soliciting others to make contributions or from bundling contributions to circumvent the limits. For example, an MFP cannot ask friends or clients to contribute to a candidate on the firm's behalf. These rules collectively ensure that the selection of municipal underwriters is based on merit rather than financial influence. I hope this clarifies how political contributions can impact professional conduct in the municipal industry. See you in the next lecture. Welcome back. The integrity of the financial industry relies heavily on the principle that business decisions should be made based on merit rather than personal gain or influence. To uphold this standard, FINRA maintains strict rules regarding the gifts and gratuities that associated persons can give to others in the industry. The primary regulation governing this area is Rule 3220, which establishes a clear boundary to prevent any appearance of impropriety or commercial bribery. When you work for a member firm, you cannot simply shower clients or employees of other firms with expensive items to win their favor. The industry operates on the assumption that even small tokens of appreciation can, if left unchecked, distort professional judgment and create conflicts of interest. Consequently, a specific dollar limit is enforced to ensure that professional relationships remain purely professional. The core of this regulation is the $100 annual limitation rule. Specifically, no member firm or person associated with a member firm may give anything of value exceeding $100 per individual per year if the gift is in relation to the business of the recipient's employer. This $100 limit is a cumulative total for the entire calendar year, meaning you cannot give multiple $50 gifts to the same person without violating the rule once the total hits $101. It is also important to note that this rule applies to gifts given to any person where the gift is related to the employer's business, which includes customers, employees of other broker-dealers, and financial institution personnel. The regulation is designed to be proactive, stopping potential influence peddling before it can manifest as a tangible problem in the market. When calculating the value of a gift, you must use the higher of the cost or the current market value at the time the gift is given. You cannot circumvent the rule by purchasing an item at a deep discount or claiming a lower valuation than what the item is actually worth on the open market. This valuation must include any taxes, shipping costs, or customization fees associated with the gift. Record keeping is another critical component of this rule, as firms are required to keep a separate record of all gifts and gratuities given to individuals. These records must be readily available for inspection and must clearly identify the recipient, the nature of the gift, and the total value provided during the year. If a gift is given by a group of people, the value must be prorated among those individuals to ensure transparency in the accounting process. There are specific exceptions to the $100 gift limit that you must understand for the exam, with the most notable being ordinary and usual business entertainment. This exception applies to items such as meals, sporting events, or theater tickets, provided that the associated person who gave the tickets actually attends the event with the recipient. If you give a client 2 tickets to a baseball game and do not go with them, that is considered a gift and is subject to the $100 limit. However, if you attend the game with a client, it is classified as business entertainment and does not count toward the annual limit. This distinction exists because the presence of the host suggests the event is an opportunity for business discussion rather than a simple transfer of wealth. Total entertainment expenses must still be reasonable and not so frequent as to raise questions of impropriety. Other exclusions from the $100 limit include items that are clearly intended for advertising or promotional purposes. Examples of these would be pens, umbrellas, or desk calendars that prominently display the firm's logo and have a value significantly below the limit. Similarly, gifts given to commemorate a life event, such as a wedding or the birth of a child, may be excluded provided they are personal in nature and not related to the business of the employer. Decorative items, such as plaques or trophies given in recognition of service, are also generally exempt from the dollar ceiling. However, you should always exercise caution. If an item appears to be an attempt to influence business dealings, it will likely be scrutinized regardless of the label you put on it. Compliance with these rules is not merely a suggestion, but a requirement for maintaining your registration and the reputation of your firm. Regulators look closely at gift-giving patterns because they serve as a leading indicator of other potential ethical breaches. Even if your intentions are noble, exceeding the limit or failing to document a gift properly can lead to disciplinary action against both the individual and the firm. Understanding where the line is drawn between a professional gesture and a prohibited gratuity is a foundational skill for any securities professional. By adhering to the $100 limit and the documentation requirements, you help maintain the level playing field that is necessary for a healthy and competitive financial market. I hope you found this helpful. I'll see you in the next lecture. Hello and welcome back. In the context of the financial services industry, a complaint is more than just a customer expressing dissatisfaction over the phone. For regulatory purposes, and specifically for the SIE exam, you must remember that a complaint is formally defined as any written statement by a customer or a person acting on behalf of a customer, alleging a grievance involving the activities of those persons under the control of a member firm. This definition is strict because it excludes verbal venting. If a client calls and yells at their representative, it is not yet a formal complaint under FINRA rules. However, the moment that grievance is committed to paper, an email, or even a text message, it triggers a specific set of regulatory requirements. You should treat the existence of a written document as the primary differentiator in your analysis of these scenarios. Once a written complaint is received by a member firm, the firm is obligated to follow a standardized procedure for handling and recording it. The representative who first receives the complaint should immediately notify their supervisor or the appropriate principal of the firm. It is never the responsibility of the individual representative to resolve the matter in isolation without notifying the compliance infrastructure of the firm. The firm must then conduct an investigation and provide a response to the client. Crucially, the firm is required to maintain a file of these complaints at the Office of Supervisory Jurisdiction. This file must contain a record of the complaint itself, any action taken by the firm in response, and a record of the final resolution. Reporting these events to regulators is an additional layer of compliance that you need to account for. FINRA requires member firms to submit a report of customer complaints on a quarterly basis. Specifically, firms must electronically file a summary and statistics regarding written customer complaints by the 15th day of the month following the end of each calendar quarter. This periodic reporting allows the self-regulatory organization to monitor patterns of behavior and identify potential systemic issues within a firm. While not every individual complaint needs to be reported immediately upon receipt, the quarterly summary is a non-negotiable requirement for ensuring transparency in the market. There are certain serious allegations that deviate from the standard quarterly reporting cycle and require immediate notification to FINRA. If a complaint involves allegations of theft, misappropriation of funds or securities, or forgery, the firm must report these to FINRA within 30 calendar days of the firm becoming aware of the event. This also applies if the complaint is part of a larger legal proceeding where the firm or an associated person is found to have violated securities laws. You must distinguish between the routine quarterly reporting of general grievances and this accelerated reporting for high-risk violations. Failing to recognize the severity of an allegation could lead to significant regulatory penalties for the member firm. Record keeping is another area where the SIE exam expects you to know specific durations. For the majority of records under the Securities Exchange Act of 1934, the retention period is either 3 or 6 years. However, customer complaints are an outlier in the FINRA rulebook, as they must be kept for 4 years. These records must be easily accessible for the first 2 years of that 4-year period. This specific time frame allows regulators to review the history of a firm's interactions with its clients during routine examinations. When you are presented with questions regarding record retention, you should pause and verify if the subject is a general transaction record or a formal customer complaint. The resolution of a complaint does not always happen through internal firm mediation. If the client and the firm cannot reach an agreement, the matter often moves toward arbitration or mediation through FINRA's dispute resolution forums. It is important to note that when a person becomes registered, they typically sign a U4 form that includes a pre-dispute arbitration clause. This clause generally mandates that disputes between the firm and the representative, or between the firm and other members, be handled via arbitration rather than in a public court. While customers are not always forced into arbitration unless they have signed an agreement to do so, the industry uses these mechanisms to handle grievances in a more specialized environment. I hope this clarifies how firms must manage and report grievances from their clients. Until the next lesson. Welcome back. Let's solidify our knowledge with a short quiz regarding the conduct rules we have recently explored. Which of the following actions requires a registered representative to provide prior written notice to their employing broker-dealer, but does not strictly require the firm's express written consent unless compensation is involved? A. Participating in a private securities transaction for a family member without remuneration. B. Starting a weekend job as a bartender at a local restaurant. C. Making a $500 political contribution to a local mayoral candidate. D. Giving a client a gold watch valued at $200 as a holiday thank you gift. Please pause the video now and take a moment to consider which answer is correct based on FINRA regulations. The correct answer is B. Starting a weekend job as a bartender at a local restaurant. The distinction between outside business activities and private securities transactions is fundamental to regulatory compliance. According to FINRA Rule 3270, a registered person cannot be employed by or receive compensation from any entity other than the member firm unless they provide prior written notice to the firm. An outside business activity, such as being a bartender, requires this notification so the firm can evaluate potential conflicts of interest, but it does not require the firm's formal permission in the same way private securities transactions do. The firm maintains the right to prohibit the activity if it creates a conflict, but the rule itself is framed as a notification requirement. This ensures transparency between the employee and the compliance department regarding any income-generating activity outside the scope of the broker-dealer. Private securities transactions, governed by Rule 3280, follow a more stringent protocol, particularly when compensation is involved. If a representative is to receive selling compensation for a transaction outside the firm's regular course of business, the firm must provide written approval and subsequently supervise the transaction as if it were its own. Option A describes a transaction without remuneration, which still requires written notice, but once compensation enters the equation, the firm must explicitly approve and record the trade. Political contributions, mentioned in Option C, are governed by MSRB Rule G 37 for municipal finance professionals, limiting contributions to $250 per election to avoid pay-to-play violations. A $500 contribution would likely trigger a ban on negotiated business. Finally, Option D violates the gift rule, which limits annual gifts to a single person to $100, making the $200 watch a regulatory infraction regardless of notification. Handling complaints is another area where strict procedural adherence is mandatory for the member firm. A formal complaint is defined specifically as a written communication from a customer expressing a grievance. While a representative might resolve a verbal complaint quickly, a written complaint must be forwarded to a principal and recorded in the firm's complaint file. These records must be maintained at the Office of Supervisory Jurisdiction for 4 years. Understanding these timelines and definitions is essential because the SIE exam often tests the specific threshold at which a casual interaction becomes a regulatory obligation. I hope this helps clarify these specific regulatory boundaries. See you in the next lecture. Hello, and welcome back for this final session. We have reached the conclusion of our journey through the Securities Industry Essentials curriculum, and it is now time to consolidate the vast array of concepts we have covered into a coherent mental model. Throughout this course, we have dissected the architecture of the capital markets, beginning with the fundamental roles of issuers and underwriters and moving through the various participants that facilitate liquidity. You should now understand how primary markets function as the mechanism for capital formation, while secondary markets provide the necessary environment for subsequent trading. We spent considerable time differentiating between the services provided by broker-dealers and those of investment advisors, a distinction that is vital for both the exam and professional practice. By now, the regulatory framework governed by the SEC, the various SROs like FINRA, and the protective layers of SIPC and FDIC should feel like familiar territory. Our exploration of economic factors moved from the broad strokes of the business cycle to the specific mechanics of monetary and fiscal policy. You have learned how interest rate fluctuations impact bond prices and how the Federal Reserve uses its tools to influence market conditions. When we turned our attention to specific asset classes, we decompose the attributes of equity and debt securities to understand their risk profiles and income characteristics. Whether it is the voting rights of common stockholders or the liquidation priority of secured corporate bondholders, these technical details form the backbone of the securities industry. You have also mastered more complex instruments, including the strategic use of options for hedging and the structural differences between packaged products like mutual funds, ETFs, and UITs. The latter half of our curriculum focused heavily on the operational and ethical standards expected of a registered representative. We navigated the complexities of margin accounts, the nuances of trade settlement, and the specific rules governing customer communications and accounts. You have seen how prohibited activities such as insider trading and front-running undermine market integrity, and how the industry's continuing education requirements ensure that professionals remain competent over time. Furthermore, the rules regarding employee conduct, including outside business activities and political contributions, illustrate the high standard of transparency required in this field. It is the combination of this product knowledge and regulatory awareness that ensures you are prepared to handle the diverse scenarios presented on the SIE exam. As you move forward to your test date, remember that success on the SIE is not merely about memorization, but about understanding the intent behind the regulations. The examiners are looking for your ability to apply these concepts to practical situations, so keep the big picture in mind while reviewing the technical details. You have completed the foundational work necessary to enter the financial services industry with confidence. Continue to review the core definitions and the relationships between different market entities to keep the information fresh in your mind. I wish you the very best of luck with your exam and your future career in finance. It has been a pleasure guiding you through this material, and I look forward to hearing about your success.